Completed almost a $28 billion deal, all cash, to acquire the data services company Splunk. Joining us now first on CNBC is Chuck Robbins. He's the chairman and CEO of Cisco. And Gary Steele, CEO of Splunk, was here when you guys announced the deal. Now Gary's going to be a part of Cisco's executive leadership team. Gentlemen, nice to have you.
It's great to be here.
Thanks for having us.
You know, all right, it's part of the company now. So, you know, you have some other products out there in security offerings, for example, I think AppDynamics, Thousand Eyes. How do you sort of address potential overlaps, redundancies? How do you go to market now with your product portfolio, given the ones you previously had and what you now have?
Yeah, well, first of all, thanks for having us. Sure. We're in a situation where we have zero overlap in security.
Right.
We have basically zero. We have slight overlap in what's called observability, which is basically monitoring the infrastructure for application performance and those kinds of things. And we've been working really hard over the last 6 months to actually address those and build an integration plan. Gary, you may want to talk a little bit about it. We're actually going to move the Cisco assets into Splunk in that particular part of the business. You want to talk about
no, I'm super excited about this. I think the combination of AppD plus Splunk's observability cloud gives us the best multi-cloud hybrid solution in the industry. So while there's some really good work that's going to happen, we think we can do a lot for our customers.
What does that mean, some really good work that's going to happen?
Simply bringing the AppD capabilities into Splunk, so driving that integration, and bringing the capabilities of AppD with the observability cloud. So customers can monitor their digital footprint and really understand their uptime and ensure that they don't have outages.
Chuck, I want to get Jim in, but just, you know, the bigger picture here in terms of what it means for the future of cybersecurity, observability, and how Splunk fits into the vision overall for Cisco.
Well, if you look at the combination of their data platform with our security portfolio, and particularly with our extended detection and response capabilities, you think about taking the data platform that they have for the customer, you apply high-end AI-based detection and response. What we believe we'll be able to do is give our customers the ability to identify threats and dynamically react to those threats in real time, because as the bad actors become better at utilizing AI to launch attacks, we think the real-time correlation of disparate events that together might indicate a security problem is a critical capability that our customers are going to need. And between our technologies, their data platform, we believe we can actually deliver that to our customers.
Right. Hour and there, you're the same now, you know.
That is true.
Yeah.
Hour and hour.
Yeah, hour and hour. Jim,
hey, it just happened in the last hour, you know.
It did. Yeah, the big wire transfer has been completed. Jim, I know you got a question.
Sure. First, congratulations, gentlemen. Successful at putting this together. I think it's really important. Gary, I'm going to go to you first. What is percentage of recurring revenue do you have? And now you're going to be part of the management team. What will your recurring revenue do for the whole mosaic that is Cisco? And what will it mean for the compound annual growth rate of the combined companies?
So Splunk brings basically $4.2 billion of annual recurring revenue to Cisco. We just wrapped up a very good year where ARR was growing 15%. And while we generated over $1 billion of cash flow on that ARR. And I'll let Chuck speak to how that comes together in terms of the overall ARR for the combined companies.
Hey, Jim, it's good to see you, and I hope you enjoy being on the West Coast. I'm sure you're going to have fun this week.
Thank you.
When you look at the combined ARR, I think we're approaching $29 billion now. So it's a meaningful amount of our business. It's been a journey we've been on since I became CEO. We actually, as you know, achieved 50% of our revenue last quarter came from recurring revenue, which has been another thing that we've been trying to achieve. And if you just do the math on adding, I mean, obviously in the first 4 quarters, Splunk's going to be a significant growth driver from a financial perspective. And then even beyond that, growing the $4+ billion, growing in the mid-teens on our business, layers a point of growth on just by that alone, even in the outbound years. So, and that's without any of the revenue synergies, which were really the things that drove this deal in the first place.
Okay, so Chuck, in the last time I spoke with you on Mad Money, you did talk about activation issues. You talked about the idea that you could be limited this quarter just because there was kind of a backup in the system that from your customers. Can we make it so that that's not the focal point of the discussion now that this deal's closed?
Yeah, Jim, I think we talked a lot about the fact that on the tail end of this supply chain problem, the customers now are sitting on the inventory that we've delivered, and they're trying to get all that installed, and so they've kind of slowed down their ordering patterns until they get that digested. And but I think the reality is that the transition that we've made to ARR and software and the recurring revenue is not fully appreciated because of that right now. And I think once we get through that, it will be fully appreciated. We're looking at a company now that has over $20 billion in software revenue. Over 50% of our revenue now is coming from recurring offers, and almost $29 billion of ARR. So we think over time it's going to be very positive, and we're looking forward to the future.
Okay, you have the luxury now with Splunk of the generative AI that they have, which is immersive chat experience. That's now you. That's one part of the puzzle. I know that Jensen Huang, obviously GTC this week, has his own networking capacity, but somehow you're part of it too. And could you explain how you, which I regard as having a competitor product, are also NVIDIA's partner?
Well, Jensen approached us, as I've talked about it, and he basically understands the relationships that we have with our enterprise customers and our understanding of how they deploy applications and how they build their infrastructure. And so he felt like we were the right partner for him to actually take his GPUs, create integrated stacks to help facilitate the simple deployment of advanced AI workloads for our customers. And that's what you're going to see from us over the next 3 to 6 months. But if you look at the Splunk acquisition also, we think that same infrastructure now can power some of these data platforms that Splunk built over the years. And as you know, the more data you have, the more powerful your AI capabilities are going to be. And so we think between their data platform and our technologies, we can bring the ability for customers to let the enterprise customer to actually deploy and gain benefit from AI workloads in a very unique way.
Gary, Chuck referred to threats obviously as a result of AI in particular, great advancements. I mean, how quickly are things moving in the threat environment? I'm just curious to get your perspective.
Yeah, I think we're in a pretty difficult time right now. I think the threat actors continue to use advanced technology to design more sophisticated threats, whether they're phishing-related threats or other kinds of sophisticated attacks. The good thing is we're the defenders. All of us are leveraging AI in a very constructive way to better defend the enterprise today. And so while the stakes get higher, I think we're doing a great job of continuing to defend.
And finally, Chuck, let me just end sort of, again, back to sort of Cisco overall.
Yeah.
You know, I was only on Feb 14 when you were talking about coming out of the quarter of guidance.
Yeah.
You were cautious. Our customers this quarter, you know, you said saw more caution than the prior quarter, which led your teams to express more caution in the forecast. Is that still the case a month later?
Well, we're in the middle of the quarter, but I'd say that the dynamics haven't changed meaningfully. I think the good news is the economy, I talked about this a couple weeks ago, I think the economy is good. It's not great, it's not bad. I think it's good. And I think that's what's going to be reflected in our customers' ordering over the next several quarters as we look forward.
Right, so unchanged at this point.
Unchanged, yes, I'd say.
Guys, thank you both. Chuck
Thank you.
Robbins, Gary Steele,
Thank you.
both of Cisco.
We are both in Cisco.
Yes,
We
you are.
And very happy to be part of Cisco.
All right, there you go. Coming up, it's a West Coast edition of Jim's Mad Dash. We're counting down to an opening bell as well, which is about 6.5 minutes from now. Stay with us. Our first cross-country mad dash of the week. You want to talk a little Hertz, is what I've been told.
Yeah. Steve Sherwood was a very successful, obviously, CFO at Goldman Sachs for a long time. Of course, we know him. It's 3 decades there. Then went to Hertz a couple of years ago. Had a vision that maybe what he could be doing is trading cars, just like you traded stocks, trading like you trade bonds. It didn't work. The strategy to be able to make it so you take down, and by the way, the company had put in big orders for EV. The EVs, maybe he was the first casualty, you tell me. The EVs depreciated rapidly, which therefore made it so that his fleet of Teslas was worth less than he thought. Maybe he thought that they would go up in value. Anyway, so he's leaving. Gil West is coming in. He's former COO of Delta, terrific guy. But it is, David, frankly, a defeat. It was initially very exciting, but the idea that you could somehow make it so you can trade cars like you can trade stocks and bonds did not work, and it was not fun for Steven. That did matter. He was hoping to have a great time. His skill set was not correct in the end. Saw a slowing in EVs, moving on. David, it's a shame because I thought Steve was going to do unbelievably well with this strategy. I, too, did not see the decline in value of the Teslas that hurt his company so much.
Yeah, well, you've talked about it. We have as well, of course. That was a fateful decision to go big in that area. And as to your point, when the values decline in the used car market, that had negative consequences. They've had so many different people run this company over the last 10 years, Jim.
Yeah. It's just not worked for anybody. Remember, it did go bankrupt, but it stayed. Yes. The stock continued to trade. David, I think it's just a very tough business. Because remember, travel has done well. We've seen cruise ships do very well. American Express obviously doing very well. Hotel chains doing very well. There's Expedia done okay. Bookings does really well. This did not take part in the great travel resurgence after COVID. And I think that maybe if you had just focused on that and not trading on cars, might have been fun. But that's not what he went there for. He didn't go there to run a travel company. He went there to do fleet management. That had been a great idea until the fleet depreciated, and then there was just not much of a strategy for him to, let's say, take advantage of.
Yeah, the fleet was not managed the way that he'd hoped.
No, it wasn't.
Didn't quite work out. All right, we got a minute until we get started with trading, and the sound picks up, and I can barely hear you, I'm sure, when that happens. So tell me what you think the key to this market is this morning before we get started with the week's trading.
I'm actually going to go with Alphabet because I think it was stunning. If it's true, the Bloomberg story true, it makes it so that Apple, which many people thought would fall behind in the race to the next $3 trillion, right? Because it fell down from Microsoft to $3 trillion. A lot of people felt that maybe Nvidia could pass it. I think that this says, wait a second, this could be the break that Apple needs, and suddenly Alphabet is far more relevant than we thought with Gemini, which a lot of people felt was a bust. Clearly not a bust. Maybe a resurgence for both.
All right, we've got to talk more about that as well.
What a stock.
Opening bell. Here's take a look at the field time exchange back at our headquarters, of course. Here at the big board, Elf Beauty celebrating the 20th anniversary of its founding. We're going to be talking to the company's CEO. That'll be in the next hour. At the NASDAQ.
David.
Yeah.
You got to ask Tarang. I mean, when some short seller went after him, he buried the guy alive. Man, the guy is just under like a lot of really bad cosmetics. I'm not kidding. He buried the guy alive. And that's because he's a great executive. The stock is up tenfold.
We'll make sure to talk about it. I'm sure Sarah's going to have a lot of questions. Over at the NASDAQ, that's Greek-based ship-owning company C3IS. That's what I'm going with. That's what it says. Who knows, though? You know, who knows?
We have no idea. We have no idea.
So where do you want to start now that we got things open, Jim?
Well, you know what, David? Can I just mention this Reddit deal that's coming? Mm-hmm. Because we don't know who it's going to be placed with. It should come tomorrow. It's very exciting because a whole new cohort of people might come into the stock market, but they are rebels. They're renegades. They don't like a lot of them don't like the big monetization advertising push that Reddit has made. But you know what, David? I find that if you're going to be a public company, you have to try to make money. It's just something I've discovered in 40 years. It's important. You don't see a lot of charities coming public. I don't know if you know that. But Reddit is a company that it's in a crossroads where they got to make more money. At the same time, they got to keep the Redditors. And that means they have to keep the people who were, let's say, game stoppers. Let's hope that group turns out and owns the stock and doesn't trade it. And then you'll have a very successful deal.
But it's not an unimportant IPO, though.
I think it's very important because, frankly, we kept thinking that we were going to have a good IPO market when Birkenstock came, and we don't. I mean, Birkenstock just turned out to be like Mattel. You know, it's like Barbie. Jeez.
Well, remember, we all got excited. Yeah, Birkenstock and Kava, which actually hung in there, did pretty fairly well.
David, may I comment that my wife, Lisa, whom we did have a Baconator by Wendy's, my wife has a pair of Birkenstocks. I think they're 30 times the price of my Crocs, but they look exactly the same.
Okay, so you're not a buyer of Birkenstocks, I guess, is what I'm hearing.
No, I'm not really a buyer of Crocs, but I think the fact is my Crocs hold up better than Birkenstock or cooler than Birkenstock. But you know what? There's no accounting for taste, David.
That is the case. That is often the case. But Reddit will be an important test. At least, I mean, again, to your point, we have not seen what we thought in terms of the IPOs, that especially given how many companies have been out there waiting for the window to open. How much more open could it be than this period of time?
I mean, people should be jumping out of the darn thing. David, just in AI alone, the companies that are going to be speaking at the conference, Nvidia's conference, there's got to be 50 that want to come public. I mean, did it change, David? Do people feel like if you're public, it's, I don't know, it's not fun? I mean, come on. Don't people want to make money anymore? What happened to that?
I know. I don't know. Given the momentum in the market, given where we came from last year, where the window seemed to be slightly opening at least, and we did get a number of them, ARM obviously being the most important perhaps,
right.
And certainly a great performer. We've talked about the fact that there are not many shares out, but nonetheless a great performer. One would have thought we would have seen more. And again, to your point, maybe it's a little early in the gestation for some of these companies that are specific to large language models, generative AI, and things of that nature. But there are plenty of other SaaS companies out there, Jim, that have been waiting.
Right, and that's why Birkenstock, ARM, we've got to get something going, and I'm hoping that Reddit gets people excited again. Right now, it's just, once again, people want that 5%. We didn't mention the Fed yet. Okay, the Fed. Now let's go back to NVIDIA for a second. NVIDIA's got a lot of partners. You heard Chuck Robbins. I mean, everyone wants the halo of Jensen Huang. Everyone wants to be associated with it, in part because it's been such a great performer. However, there are already naysayers, David. I am hearing people, including people on our network, who are saying this marks the peak. We've got the Fed talking tough. We're going to be finished with GTC. We're done with AI. I don't know. How can you say it marks the peak if you're talking about a multi-year transition from CPU to GPU? But I know short-termers are saying that this is the peak this week. Yeah, I'm hearing it. I'm hearing it from a lot of people.
There are, but there are also plenty who say that we are just at the very, very beginning. And the amount of compute power that we're going to need is staggering. And I've talked often, frankly, about one of the gating issues not even being the chips themselves, but the power that is going to be needed to actually have these data centers operating at full capacity.
I'm so glad you mentioned
which is not there.
We have, the grid have been moribund. There hadn't been more electricity used for many decades. Suddenly we're having a 5% increase over last year because of data centers. Next year forecast to be 5%. We're going to need solar. We're going to be needing wind. Nuke, I think you and I both know, is terrific, but it's not going to happen. But we are going to need so much generation that the natural gas business, which right now natural gas is very cheap, is going to go into high gear, which is why I keep saying this Vernova is very interesting, this GE spinoff that we have in April. I think Vernova could be interesting, and I hate it. I thought it would be a loser. But the need for power, as you correctly point out, is just humongous. And I know that Jensen's going to be talking about how much heat these generate. They obviously generate less heat than you'd think. But wow, David, this data center move is making it so our electric grid is being taxed severely. And no one's talking about it except for you.
Yeah, you know, I had some interesting conversations, as I think I'd said, with those who were in the data center business, and that's what struck me was that that's the key issue. And again, it doesn't mean we're going to be having blackouts or anything of that nature. It simply means that if you want to put shovels in the ground for the next data center, you've got to make sure you have a secure supply of power, and that may really begin to be an issue. We've discussed it.
Well, that's why I'm getting Prologis tonight.
But
They have
Jim,
$500 million in data centers.
A lot of these utilities and whatnot went up. The stock prices went up a lot, as though this is years to come in terms of being able to build the capacity that's needed. I mean, was that a justified move in many of those names?
No, not a justified move, because these companies have to find a lot of ways. They got to finance, and obviously rates went up. The stocks are not great buys. I think Semper is, because Semper's got a lot of very good natural gas. But, David, the country isn't ready for it. Eaton had a meeting last week, is owned by my Travel Trust. They're one of these companies that is done with trying to get the electrification grid going. The federal government obviously spending a lot of money on this too. But we're not ready. We're not ready for the demand. And it is going to be something to see where they put all the data centers, because they got to go where the power is cheapest. And right now, there's a hunt. One of the reasons why I want to talk to Prologis, they have 12,000 acres ready to put new data centers on. It may be the most important thing. Look at that. That stock's a horse. Wow. That's all data center. You're looking at a data center play. Vertiv, by the way, is the one that you and I know, Dave Cote, the chairman of. Vertiv is the pure play in terms of what's in the data center, and wow. And then don't forget Supermicro, added to the S&P. I mean, there's a good chart.
No,
Supermicro's got a chart.
Right. It all comes back to, of course, Nvidia in some ways. Dell is another name, right? I mean,
yes.
Hearing different things about just how profitable their servers that go into the data center that have the Nvidia chips are. But it helps, boy. I mean, look at the move that stock had after earnings, because they have access to the key here, which of course is those H100s.
Well, David, do you hear bubble? Do you hear people talk bubble?
Well, yeah, you hear it. You hear it, Jim, but I don't know that the comparisons are appropriate to the bubble that you and I both lived through. I reported through it. You invested through it in the late 90s. So this is very different.
No, I mean, Michael Dell, as you know, an incredibly serious business person, is making a fortune doing a little bit attenuated part of AI. Nvidia is able to charge what it can do because it's basically a monopoly, but it works. The total cost of ownership is not that bad. It's kind of like you got to think of it like a car. It performs very well after you buy it, but when you buy it initially, it's expensive. I just think, David, these companies are making fortunes, and that's why their stock. Well, AMD is making fortunes. That's why AMD's chart. If there was no Nvidia, you'd say AMD's the greatest stock in history. But we have just many, many companies that are making fortunes in this business, and I'm going to use a word that I'm just going to use it. Indispensable. These companies are indispensable.
Yeah, even though AMD is no match for Nvidia when it comes to actually powering accelerated computing, essentially.
Right. Well, AMD doesn't have the data, doesn't have the what you need to learn from. So therefore, it doesn't have the inference where you ask it something and it comes back with an answer. But it is a chip that's incredibly fast. And so I don't want to say that Lisa Su doesn't have something in the game. It's just that you need all the data already in before you can start asking it. And NVIDIA's got just tremendous data. They have, the large learning models are smart. And they know things, and they've combed the web, and you want to just plug in your questions. You don't want to wait around.
Jim, I want to come back to really what is we've mentioned a number of times, but it's the story powering two of the largest market cap companies, and that is this Bloomberg story again. Alphabet shares are up almost 7%. Now remember, there's a decent amount of people who are short this stock, in part because of the story we've been discussing, which is, will they move quickly enough to defend search as it changes from the Google search to what will become the new search, which is you just go to a large language model and use that, whether it's ChatGPT or Gemini, which of course is their entrant, or Copilot, or Perplexity, which actually allows you to use all of them. Perplexity is sort of almost like this Google for large language models. It is possible, isn't it, Jim? Again, it's early reporting here from, it would seem to a certain extent, from Bloomberg, and I'm just guessing, but it is possible that, isn't it, that Apple could be using all of them, right? I mean, do you have to sign up an exclusive deal with just Gemini?
That's a great question. I don't know. They do need to have something quickly. I think the Gemini is good. I mean, I guess you can make deals with everybody, but Gemini is good. I just think the problem with Gemini is exactly what you said, which is it going to take away from the ad revenue from search. When I think about Google these days, I was always just hoping that maybe YouTube would take up the vacuum and Google Cloud would take up the vacuum. I figured search has to go down because of all these new different systems, but this makes their search and their AI supreme again. David, this is huge. I mean, my travel trust owns it, and we have just been lamenting Alphabet for months. Well, no lamentation today.
Yeah, although again, I would caution early. Nothing says this is going to happen. We've made the point many times when it comes to Apple, they don't have to be first. They got 1.2 billion people with in their system. You know, they oftentimes are not necessarily. It's just that they have a better user experience than anybody else.
Right.
And that typically wins the day, at least certainly when you have 1.2 billion installed base, it can
Right,
win
you know, with touching 2 billion people. Remember, you got this great service revenue stream. Tim Cook has always said, look, we are a tech company first with a consumer that loves us and is very satisfied. You don't get that satisfaction, which is almost 100% satisfaction, by offering an inferior product. But, again, I keep going back to that Best Buy conference call where they just shocked me and said, look, the Samsung phone is the hottest phone. And the Samsung phone has a lot of AI.
Yeah, I know you've mentioned it any number of times.
Did I bore you with it? I mean, what the hell? I was the only person on the call.
No, I don't have one. I don't know. I haven't used it.
Were you on the Dick's call? I was on the Dick's call. That was a good call. You want to talk about that? Apparel? That great move of Under Armour, you know, to take the hotelier and can her and bring back a shoe guy. No, I mean, I could talk about a lot of companies. What would you like to talk about?
I don't know. You want to talk a little Disney so we can do a point-counterpoint on that, too?
Well, sure. I mean, Jim Stewart with a very big piece in the New York Times that I think concludes, if you get to the end, that maybe Nelson would be valuable. David, kind of a not that positive article in the Wall Street Journal about Nelson.
No, competing articles over the weekend, very interesting in the timing, as you say. One quite positive, I would argue, overall in terms of Nelson Peltz. And then the Journal focusing more on the internal goings-on at Trian itself. I was surprised the Times did not have any mention of Ed Garden, of course, who helped run that firm for many years. Certainly the author of, or at least behind many of the white papers. No mention at all in the New York Times story, but the Journal spent a good amount of time on it. The news this morning, Jim, is that these proxy advisory firms often do play an important role here. They advise many of the passive investors, namely the index funds, at least on how they should vote their shares. We do have one in so far that I'm aware of, which is Glass Lewis. That goes for Disney. I've got it here, I think, in terms of their recommendation. And, they will, ISS, I haven't seen yet. That's still to come. Both sides have been busy in meetings, as I pointed out last week. Of course, Bob Iger making the rounds in Boston and Baltimore and wherever the big institutions are, making their case in terms of why Peltz and Rizzullo should not be on the board.
Well, look, I do think that on the one hand, you've got a stock that is going down substantially, and just been miserable, of which some of that was Iger. On the other hand, you got a stock that's been red hot, and maybe that's Peltz, maybe that's this competition. But if Nelson's going to be defeated, he'll be defeated by the stock price being up so much, because people just say, hey, listen, it's fine. Maybe they've gotten more focused. I come back, David, and do say that the white paper that Nelson Peltz put out is really about how the board is dysfunctional, not how the company's dysfunctional. And the board seems to has so many powerful, fantastic people. It is a little surprising that they were really bad at succession. It is surprising that they were bad at guidance of the CEO. And I think there's this misperception that if you're on the board, you're supposed to be running the company. Nelson doesn't run the company. He wants the board to be more focused on costs and on what they produce. But, David, you look at that board, it's like, how could they have so many great people and not be more thoughtful?
Well, there's arguments to be made. Obviously, they are in the midst of a seminal transition in the industry, of which they're a part. We've talked about it many times. It's easy enough to say you could have done this or that, but
that's a good point.
When you do compare them to some of their competitors who've been similarly involved in that transition, they look better by comparison. Obviously, they have the parks to help fuel it, but not the easiest. When it comes to succession, there's no argument to be made there. They screwed it up.
I know.
Period.
But you have Jimmy Pitaro, the guy who runs ESPN. He's the smartest guy, one of the smartest guys I've ever met. He's a terrific guy. David, ESPN, they lost so many subscribers. I mean, it's a little bit like the Dutch boy with the dike. And yet they're very thoughtful about what they do. Pitaro's a really good piece about it. I mean, really smart guy. But you know what? The industry is a tough industry right now. You're absolutely right. And thank heavens for theme parks.
Yeah, listen, ESPN still generates $2.8 billion in operating profit. Not bad.
And they're a very good company.
Obviously, it's a cable network, and there are far fewer people out there available to watch. Those that are, watch us, of course.
Of course.
But there's
fewer. They watch us on Reddit. Oh, no, Reddit. No, they don't.
They're not on Reddit. I don't know. All right, we'll figure out Reddit. While we do that, let's give you a quick look at the bond market this morning. We call it the bond report. It's when we check out how treasuries are faring and what the yields are. You can see right now we are up across the board with that 10-year at 4.316, the 2-year note yielding 4.73. We're right back.
See.
Lockheed Martin's $6 billion Sikorsky helicopter business is at a critical juncture. Coming up, a rare look inside the maker of the Black Hawk. Literally. We're going to take to the skies in the next hour. Squawk on the street. Stay right there.
All right, let's get to it. Things have finally quieted a bit here, Jim. PepsiCo is the name you want to talk about?
Yeah, up almost 3% on an upgrade by a fellow. There's more than one Darrow on Wall Street, Darrow Mohsenian, who's really one of the best analysts who covers this consumer packaged goods group, Morgan Stanley, and it's a very cogent upgrade. This is a man who said, look, this company's slowing down. It's going to miss its targets. Gutsy thing, because Raymond LaGuardia doesn't miss targets. He's the CEO. Well, he did. And now Darrow comes back and say it's bottoming. It's about to inflect. I really like this call. The only reservation I have is that he really doesn't address the GLP-1. We haven't talked about Lilly at all today or Novo. He's saying, he's basically saying, look, this thing is so cheap and it's going to come back. I like the call, but I also want to keep one eye always on what people are doing with the Ozempics and the Mounjaros and the Zepbounds.
Yeah. All right. What does that tell you of late? Anything new on the old GLP-1 front? We actually didn't talk about Eli Lilly or Novo this morning.
No, I think there are people who are just saying, all right, let's see how big the numbers are. Now there's this, we're getting this backlash. Small companies that are picking away at some of what these companies might or may not be able to accomplish. I say use any weakness to buy Eli Lilly. It's a core position for Travel Trust, and I think it goes much higher.
You do?
Yeah, because I think that hypertension and heart attacks, they're big preventable illnesses.
You didn't even mention Alzheimer's.
Well, I was disappointed that Lilly didn't get its Alzheimer's review and that it's going to be a full bore review, and I don't think they thought that would happen either. Let's see what's good. That's going to be a very big drug, but people are very concerned how much it's going to cost the system. And but I thought that they were ready, and I was disappointed. There's no doubt about it. I'm not going to change my mind. That was just not great.
Yeah, but it's not as though it was cast aside. It's just going to take longer. They're giving it
right. It's just that there was a lot of talk that it would be done by this quarter, and a lot of people, the work I do with American Brain Foundation, everybody I talked to thought that this was a gimme, and not Lilly's fault. Lilly was never promotional. But let's watch. You're absolutely right. It's not going to sidetrack it. It's going to happen.
All right, what do you got on the big show tonight from One Market, our headquarters out in San Fran?
Okay, first I've got Prologis. Again, they're just a gigantic warehouse company, but they have been focused very much on data center. Let's find out how much power they use. David, CrowdStrike is now the acknowledged king of cybersecurity. We heard what Chuck Robbins was talking about with Gary Steele. These are the guys that are doing the best. 30% revenue growth for as far as the eye can see. It's a big company now. Then onsemi, which is a company that stumbled. Why? Because it's really related to auto, but it's got a solar business that I'm interested in because it converts solar energy into regular energy for electricity. And again, David, I think your focus of what's going to happen to the grid and 5% increase in the amount of power we need year for year, we're just not ready for it as a country.
Yeah, well, a story we'll continue to discuss. Jim, have a great rest of the day.
Thank you.
I'll see you tomorrow morning, but of course you'll see everybody else on Mad Money tonight. Coming up right here.
Thank you.
In the next hour, ExxonMobil CEO Darren Woods. He's live from CERAWeek. More Squawk on the Street straight ahead.
of income.
Good Monday morning. Welcome to another hour of Squawk on the Street. I'm Sarah Eisen with David Faber live, as always, from Post 9 of the New York Stock Exchange. Carl has the morning off. Take a look at stocks heading higher here in the early session and almost a full percent on the S&P 500. For the NASDAQ, up 1.3%. The only groups that are underperforming today, well, actually everybody's up, but utilities and industrials are at the bottom of the pack. Communication services and information technology are really leading the charge. Alphabet is part of the story there, up almost more than 6% right now. Some of the media names are rallying as well. Take a look at treasuries to kick off the week. It's been a story of higher yields lately, and the market has brushed that off, continues to do so today. The 10-year yield at 4.3%, two-year yield ahead of the Fed, 4.732%. So again, selling bonds, yields higher. 30 minutes into the trading session, here are three big movers we're watching. Shares of Alphabet rallying on these reports that's in talks with Apple to have its Gemini artificial intelligence engine in Apple's iPhones. Much more on that big story coming up. Super microcomputer shares keep pushing higher. The server maker joining the S&P 500 index today. The stock has been riding the AI boom, soaring more than tenfold over the last 12 months. And staying with the AI theme, Nvidia shares moving higher as well as the company kicks off its developers conference. The stock is up now more than 80% this year, going into CEO Jensen Huang's keynote speech today. We're going to head live to the big event later this hour.
Ooh, can't wait for that. But first, fresh clues this hour about the health of the housing market. Diane Olick has that for us. Diane.
Well, David, home builder sentiment in March rose 3 points to 51 on the National Association of Home Builders Index. The street was looking for unchanged, so that's a beat. That is the fourth consecutive monthly gain and the highest level since last July. It's also the first time sentiment has been in positive territory since July. 50 is the line between positive and negative. The builders report demand is, quote, brisk. Of the index's three components, current sales conditions rose 4 points to 56. Expectations of sales in the next 6 months rose 2 points to 62, and buyer traffic increased 2 points to 34. Regionally, on a 3-month moving average, sentiment rose most in the Midwest and in the West. Now, the report also said more builders are cutting back on lowering home prices in order to attract more buyers. In March, 24% of builders reported cutting home prices, down from 36% in December of last year, and the lowest share since July of last year. But the average price cut remains the same, around 6%. They are, however, still using sales incentives like buying down mortgage rates. Sarah?
So is housing picking back up again, Diana? Where do we stand?
Yeah, I mean, it appears to be picking back up despite the fact that mortgage rates have really been hovering around 7% for the last 2 months. And so the builders are obviously benefiting from the fact that the existing home market has so little for sale on it now. We are seeing more inventory come onto the market because it's spring and we usually do. But demand is still there. I think people are starting to get used to the 7% rate if they can afford it.
Got it. Diana Olick, thank you very much. Kicking off what is going to be a very busy week ahead for the markets. A lot of catalysts. The three main ones, the Fed, the BOJ, and Nvidia, I think are the biggest impacts of the market. Here's the calendar.
We got your BOJ, didn't we? That you were telling us about that on Friday.
It's going to come tonight.
Oh, it's tonight.
It's tonight.
Okay.
Tuesday is the BOJ meeting.
Oh, it's Tuesday.
Yeah, and it's also exciting for me because on Thursday, Nike and Lululemon both report. I don't think they've ever reported on the same day, which is just interesting because they're competitors. But it's earnings. It's Bank of Japan. Let's talk about Bank of Japan because this is a really big deal. So Bank of Japan is set to raise interest rates tonight. Maybe they'll push it to April, but increasingly economists think it's going to happen tonight. And that would be the first time in 17 years. And they would take it from negative 0.1% to 0%. The last man standing on negative interest rates. Here's the wage jump in Japan. And here's part of the reason why. They had these negotiations with the largest trade unions. It's called the Shunto on Friday, I believe, and you can see what's happened. Wages shot up. We got a big increase. And that's on top of the fact that their core, what they call when they strip out food and energy, has been above 2% for the last year or so. It's on top of the fact, David, that the Nikkei, their Japanese stock market, is at a record high. The Japanese yen is at a 30-year low. Like, now is the time. You had very easy financial conditions there and higher inflation to raise interest rates. And it will just be interesting because it is a big change, a fundamental change in the bond market. A lot of people say it's priced in already. We've seen Treasury sell off in anticipation to this, but one of the biggest central banks and one of the biggest buyers of bonds.
Yep.
So it's a big sea change.
And as you point out, a very long period of time. And way before it became fashionable, they were negative.
They were negative,
Yeah.
and they were buying ETFs. They were buying everything.
I
I mean,
know.
ballooning their balance sheet before it became the great experiment.
Right, and
for
trying to
everyone else.
generate some inflation that they finally have.
They finally have it. And so I think, they've got a dovish central bank governor in Ueda, and I don't think they're going to be in any rush. And they're going to be easier than the Fed and the ECB and most other central banks still when they raise interest rates. But that's one dynamic.
Okay.
The other's the Fed. And the views are changing a little bit on what to expect. Will Fed Chair Powell sound a little more hawkish than he did the last time we heard from him publicly, which was the Humphrey Hawkins testimony in Congress, because it was before the CPI and the PPI reports for February showed some firmness there, stickier inflation prices.
I don't remember any headlines coming out of either day of that testimony.
Nothing because he didn't change the script.
Right.
He basically just said we're patient, we're in data watching mode, and we like the inflation progress. But will he sound a little bit more like, okay, we have to, we've seen a few readings that make us wonder how quickly we can cut interest rates, for example. So the odds are changing. JP Morgan went from just over the weekend, they were expecting as much as 125 basis points in cuts this year. Now they're at 75. So they've caught up to where the Fed predicted it would be in September. And then that's going to be the big question on the dot plot, which gives you the projections of where each Fed official sees rates going this year. The median estimate was 3 cuts in September. They're going to update that forecast. Will they take it to 2 cuts and signal to the market, which is totally caught up with the Fed, that we're going to take it even slower? And will the market care about it? Looking at the odds this morning, Fed funds future, this tells you where the market expects the Fed to be at the end of the year, 4.6. We're at 425 to 450. 525 to 550 right now on the target rate. So they're expecting around 3 cuts, well, potentially by the end of the year. Will that change? Will it drive Treasury yields higher? And will equities be able to hang in there still? Because the stock market has been pretty resilient in the face of these rising bond yields. Also, inflation expectations in the TIPS market have been moving up as well.
Yeah, it has been a resilient market with the S&P up some 8.3% at this very moment.
We have AI, we have Google, we have Nvidia, we have this is what's dominating the equity market, and it's counteracting some of the potential trepidation that you might see in firmer inflation and higher Treasury yields. The only other chart I wanted to show is what's happened with commodities. It's kind of been this quiet rally we haven't talked about very much, but just in the last few weeks or so, oil prices are up.
Yep.
Gasoline prices, cattle prices, orange juice prices. Cocoa is a whole nother can of worms that's soared.
A real problem.
Copper has risen. They've come off the lows that we saw sort of toward the end of the last year. It's not a crazy surge, but it's worth watching because this field feeds into the real economy and into inflation.
Speaking of AI, of course, we do have a big story, at least the market's digesting this morning. Shares of Alphabet, for example, up almost 6%. This follows reports the company is in talks with Apple that would have its Gemini AI engine, that is Alphabet's, in Apple's iPhones. Steve Kovac joins us now. Give us perhaps some context on this story that everybody's sort of trying to grapple with so far this morning, Steve.
Yeah, this is a big and surprising one. So the report saying Apple is in talks to license Google's Gemini AI to power upcoming features in the iPhone. That's according to a Bloomberg report that broke overnight. Now, this comes ahead of an AI announcement from Apple later this year, which CEO Tim Cook has already teased would be a breakthrough for the company. Now, Apple reportedly going to expand the deal it already has with Google in search, in which Google pays as much as $19 billion a year to be the default search engine on Apple devices. It's unclear if Apple's going to be paying Google for the licensing here or if Google would just pay Apple so Gemini can deploy to billions of Apple devices. Also, it's a vote of confidence for Google's Gemini, which, as we've been reporting, has had a few high-profile blunders since it was announced late last year, forcing Google to temporarily remove Gemini's image generation feature. Report also says Apple explored partnering with OpenAI. By the way, that's the same technology that Microsoft uses for its Copilot product that it's been selling since last year. And it's also an admission that Apple hasn't been able to make its own AI model that's up to par with what Google and others have. And of course, there's this natural antitrust concern going on as well. Google and Apple are the only two mobile operating system platforms, and a partnership like this could raise fresh concerns over at the Department of Justice, which, by the way, is expected to file its antitrust lawsuit against Apple any day now, guys.
Yeah. Important to point out here, of course, this is all, at this point still being negotiated, according to Bloomberg. Things can change. I mean, I do wonder, Steve, is it possible that Apple's negotiating similarly with some of the other large language model operators, so to speak?
Yeah,
it's possible. That they could be sort of a platform in the way that Perplexity kind of offers you access to all of them?
That is the perfect example. Perplexity is that search engine. It's a startup funded by Jeff Bezos. It uses all of them, basically. It uses OpenAI, it uses Anthropic, another startup that's a rival to OpenAI. So, yes, you can also see a future in which they kind of stitch together all those different language models. But look, this is really going to come down to what they can show at their developers conference in June, which is when we're expecting to see the details of this AI announcement Apple has been teasing all along, David.
Right.
And they're going to have to really show that they can do more with this AI Gemini technology than Google has already done on its own phones. It can do stuff like erase parts of a photo. It can do some like live translation between languages and things like that. But it's nothing a breakthrough like what Tim Cook has been teasing.
Yeah, I know. Well, I wonder. So was it your expectation, and perhaps it still is, that Apple was going to have its own product, so to speak, its own large language model? I mean, clearly they have the ability to fund whatever is needed to do that.
Right. And it's not just their own ability. They hired this man named John Giannandrea from Google several years ago in order to run AI. So it's really interesting that if they do have this, by the way, they do have their own large language model. They've been putting out research reports and so forth on that. But if they don't feel confident about it, that it can be out there and put publicly, it's really interesting that they're going with a partnership instead of doing something in-house.
Yeah. Well, a story that bears close watching. Appreciate your context on it and insight. Thank you, Steve. We'll stay on it, obviously, given the move in both of those stocks. Apple shares up almost 2.5% as well. Moving on here, proxy advisory firm Glass Lewis is backing Disney's board of directors in a report out this morning. Sarah, it's obviously something we've been following closely. I'm sure you read both the New York Times story about Nelson Peltz, quite favorable, I would argue, and the Wall Street Journal story, perhaps not as favorable, about his firm Trian over the weekend. Interesting timing from both. We have been waiting for and will continue to get these proxy advisory firms. These are the firms that essentially recommend and oftentimes can be influential in terms of how a vote should go. And in this case, when it comes to Glass Lewis, they side with Bob Iger and the management team. I think we may have a bit of an excerpt here that we put together. They say, "We believe there exists adequate cause to suggest Mr. Iger's return to the role has been accompanied by an appropriately sober assessment of Disney's recent failings and a correlated series of programs intended to remediate the company's less favorable footing. Under these conditions, and absent further developments, we believe investors would best be served supporting all of Disney's nominees."
It's a very complicated explanation. But ISS will be interesting, too, because they usually back Peltz in his fights.
They have in the past. Institutional Shareholder Services, perhaps seen as still the most influential of these proxy advisory firms, yes. So we'll see. We're monitoring it. Both those guys have been meeting with investors, making their cases over the last couple of weeks.
I do wonder how influential. You said they're still pretty influential. Disney is in the 30% ownership of retail. That's a high percentage of retail ownership, not unlike P&G, which was another very close context for Peltz, and ultimately he prevailed and ended up on that board.
He did. I mean, those votes, it literally came down to...
They both claimed victory in Cincinnati that day.
I remember that. I remember it well. And obviously, Mr. Peltz will use his time on the P&G board to support what he says is the reason he should be on the Disney board.
But otherwise, it's hard for us to get a sense of how it's going, right?
You know, listen, people close to Disney, their advisors seem very confident they're going to win. But, of course, that's what you'd expect them to say.
Right. So does Peltz, probably.
Yeah, I'm sure. Yeah. Well, I haven't talked to Nelson in a little bit. Maybe you have. As we head to break, here's our roadmap for the rest of the hour. Energy rallying this month, the best sector, in fact, for March. ExxonMobil CEO Darren Woods is going to join us. It's a first on CNBC interview. We'll talk about the outlook for oil and the company.
Plus, it is a red-hot stock that's up almost 40% so far this year, up 175% in the past 1 year. The company CEO joins us with his profit picture.
And Nvidia, it is front and center today. That chip giant kicks off its AI Developers Conference. Jensen Huang's keynote speech. We're going to head there live. We got a big show ahead for you. Don't go anywhere.
Download the app.
Welcome back to Squawk on the Street, the world's top energy CEOs, so to speak, companies in that sector gathering in Houston. It's called CERAWeek. Our Brian Sullivan is there. He's got a first-time CNBC interview with ExxonMobil's chairman and CEO, Darren Woods. Brian.
Yes, David, thank you very much. A man that you know well, and I know David's got a lot of questions probably about Guyana as well, Darren, so we'll kind of tag team this.
Sounds
Welcome. Good to see you again.
Thank you.
I want to start just with oil. Oil's at $80. It's interesting because we always focus on supply. Supply. How much is OPEC pumping? How much is Exxon pumping? How much is the U.S. pumping? Are we underestimating demand? Because just the other day, the IEA, which had been more bearish, raised its oil demand estimates for this year and next year. How do you see demand?
Well, I think the amazing thing is, even with some of the challenges we're seeing around the world with global economies, the demand for petroleum products, gasoline, diesel, last year gasoline was at all-time record highs. Crude, as you know, is at all-time record highs. And so the demand, in my mind, is still very, very healthy. The margins that we're seeing in our refining business are much higher than they've traditionally been because of that extra demand. And I put that in the context of an economy it's doing okay, but it's not blowing and going. And so if economies around the world start to pick up, I think we're going to see a very tight supply-demand balance. So I think demand is a very important part of the equation and probably one of the most difficult things to predict in our business. Supply is a lot easier to get your hands around. Demand is the more challenging.
Can you help us understand demand a little bit more? Because we've got record EV, electric vehicle penetration in the United States. Sales, maybe not as strong as some had thought, but they're going up, and there's no sign that they're going to fall anytime soon. And yet, U.S. gasoline demand continues to rise as well. How do we square those two things?
People want to be out and driving, frankly, and if you look at as opportunities to, to get out, see things, and drive around the country. That starts to grow. So these miles traveled start to grow. And so while EVs are taking a place in that dynamic, that doesn't in itself cap the overall transportation industry. And then as you step away from the U.S. and look more broadly, the growth in developing nations around the world is picking up, and so we're seeing really high demand in places like India, and China's got very healthy demand. And so I think you got to break away from the U.S.-centric perspective and think globally. And when you start thinking about these economies that are still coming up the economic ladder and people's prosperity are growing, you see more and more travel, and I think more and more demand for traditional fuels.
Do you think there is a fundamental misunderstanding, even at fairly high levels, about how the energy transition will play out vis-a-vis fossil fuels, in a sense that as the transition occurs toward more electrification, there are some who predict maybe a steep drop-off in usage, but I've seen other models that suggest, like in Norway, record EV penetration, oil and gas use has not gone down at all, that we misunderstand where we might be in 5, 10, 50 years on that curve.
So I think one of the things, the policy to date and a lot of the narrative has been very focused on the supply side of the equation, haven't addressed the demand side of the equation, and the impact that price has on demand. And so I think as prices come off, demand tends to go up. It's very elastic on the edge there. And at the same time, the cost of converting and moving to a lower carbon society, if that cost is too high for consumers to bear, they won't pay. And we've seen that play itself out in Europe with some of the farm protests, the yellow vest protests a year or so ago. So I think the piece of the equation that's been missing is cost, price, and the impact it has on people's standards of living.
Well, how do we balance that out in the States? We can learn from Europe. I've been there many times reporting on this for CNBC, and we want a cleaner, we want a greener world. We want to lower carbon emissions. We want to reduce ozone in the atmosphere. We want to make sure that global temperatures don't rise. But yet, to your point, at the ground level, people have to heat their home. They've got to turn on the light, and they either need to have it work or not go bankrupt from that. We're seeing, are we going to start to see, or have we already started to see a little bit of a pushback here in the United States? In Europe, to your point, they're pushing back. Prices in the UK have doubled. 4 million people in what they call energy poverty. What's the right balance here in the United States, managing climate goals with making sure families can also afford it?
Yeah, I think you're starting to see an evolution where if you go back in time, we were very focused on a very narrow set of solutions, solar, wind, and electric vehicles. And that's all that people talked about around how we're going to solve the problem. With the IRA and the focus now on carbon intensity and reducing the carbon intensity of transportation in the different sectors, you're now starting to engage the market more broadly. And I think the answer is going to be how to strike that balance is get to a focus on reducing emissions intensity, and then incentivizing businesses in the markets to produce products that have lower carbon intensity. And that then engages all the players and opens up the aperture for as many solutions as people can come up with, helps drive technology in the right places to start bringing down the emissions and doing it in the most cost-effective way. So engaging markets through carbon intensity specifications, I think, is ultimately going to be a solution that we're going to have to use.
I have not been to Guyana, but my friend and colleague David Faber has been to Guyana, so I know there's a lot. I think there's something going on around Guyana with you and Chevron and Hess. David, you want to jump in here because you know the situation for the deal side and actually the Guyana side better than I do.
Well, sure, Brian, thank you. And Darren, good to see you. On Guyana, listen, you have a joint operating agreement with Hess, of course, in the operations outside on the shores of that country. And you're asserting a right of first refusal under that joint operating agreement. Darren, why are you doing this? And given we haven't seen the language, why are you confident that when you go to arbitration, as you are right now, that you will prevail?
Well, I think you make the point about the joint operating agreement. So we have a contract that defines the parameters in which that partnership operates. This area and the change of control and the rights that the existing partners have with respect to that change in control are spelled out in that document. We wrote the document along with Shell back in 2008. Hess joined that venture in 2014 and signed into that document, so we're pretty familiar with the intent and the objectives and the language of that document. Remember, David, that's, as you know, Guyana is one of the most successful deep water developments in the history of the industry. We've played a major role in that as the 45% shareholder in the operator. We want to make sure that the rights afforded us in the JOA are recognized and conformed with, and that's really what this is about, is making sure that, one, we have our rights secured, two, that we understand within this Chevron-Hess transaction, Guyana is a piece of it, that we understand what the value that that transaction is putting on the Guyana assets, and then it gives us the opportunity to evaluate that on behalf of the company and our shareholders to make sure that we're making a decision that's in the best interest of the company and our shareholders.
Chevron has made it clear that if you were to prevail in this arbitration and actually have that right of first refusal that they obviously say they do not believe you have, they'll pull out of the deal. So it's not like there's going to be an opportunity for you to buy Hess's ownership stake in Guyana. Again, given that, what would be the reason then to pursue this to its conclusion? Is it the potential value down the road for ExxonMobil? Is there option value, perhaps, that one day you might want to buy Hess?
So I would tell you that the horizon that we're evaluating and the opportunity set that we're evaluating isn't limited to just the Hess-Chevron deal. That is a specific transaction that was developed between Hess and Chevron that frankly circumvents our rights in this and deprives us of a value opportunity. If not this deal, then maybe some other deal in the future. I don't know what the future holds. We didn't construct the Chevron-Hess deal. We're just responding to it. And so the question is, I think more appropriately, what happens down the road in the future? What does Hess decide to do? We want to preserve the option, so no matter what, however the future plays out, that we've preserved the option and can do what's in the best interest of ExxonMobil shareholders.
How big can it be? If we could close the key to the NYSE, guys, thank you. I know it's tough to hear. Nicely done, though, by the way, on that. I couldn't hear anything. Bluefin, a new discovery in Guyana, just 1.2 million barrels a day, potentially by 2027. Is that a conservative estimate? You think you can get to 1.2 by 2027?
Listen, I think
whoever owns it,
we're developing it as expeditiously and efficiently as we can. And one of the outcomes of that, one of the consequences of that very expeditious development, one is the Guyana government benefits directly from that sooner, which is good for the Guyana and the people of Guyana. But at the same time, there's a lot of work that we're doing in parallel and trying to understand how big is the opportunity. So I would say our understanding of that resource continues to grow. Discoveries will continue to come, and we'll continue to evolve our thinking on that. So we're just basically giving our best estimate at the time, and we'll update that as we learn more and we develop it further.
All right, wrap it up with this. You might have heard about this pause that we have on U.S. LNG projects. Got a massive project in Texas. Is that full steam ahead? Even
yes.
with, is that going to, the pause will not impact your project?
The pause will not impact the project, that's right.
That's a nice, clean answer. We'll end it right there. Darren Woods, Chairman and CEO of ExxonMobil, kicking off our CERAWeek coverage. Really do appreciate it, Darren. Thank you very much.
Good seeing you.
Sarah.
All right, Brian, thank you. Looking forward to a lot more oil talk from you this week. Brian Sullivan and Darren Woods. Up next, check out this mystery chart. It's a consumer-related name that's up 40% this year and 175% in the past 12 months. We're going to talk to the company CEO, find out why investors are piling into the red-hot name. Plus, a closer look at the U.S. military's latest defense products. Our Morgan Brennan joins us live in the sky with a look at what is still ahead on the show. I think this is a first, Morgan.
Hey, Sarah. So I'm inside a UH-60 Alpha. This is a Black Hawk built by Lockheed Martin Sikorsky. It's about 40 years old. Also, the most advanced Black Hawk in the world. Why? It's fully autonomous. We're about to take to the skies. We're going to control the entire flight on this tablet. So coming up, we're going to do a deep dive on the $6 billion Sikorsky business. I'm going to push this button, execute right now, and we have takeoff. See you on the other side of this break.
Here we go.
C.
Welcome back to Squawk on the Street. I'm Contessa Brewer with your CNBC News update. A new United Nations-backed report warns famine is imminent in Gaza. A new report suggests almost half of Gaza's population of 2.2 million people are facing catastrophic levels of hunger as Israel continues to wage war with Hamas in the enclave. The most affected area is northern Gaza, which largely has been cut off from aid deliveries. The report found almost two-thirds of the households there have gone at least 10 days without eating in the last 30. The Supreme Court will consider today whether the Biden administration's attempts to combat social media misinformation violated the First Amendment. The administration's accused of coercing platforms to remove problematic posts on issues like COVID-19 and the presidential election. And Uber reached a $178 million settlement with Australian taxi drivers. Thousands of drivers launched a class action lawsuit against the rideshare company, accusing it of breaking the country's taxi licensing rules when it started operating there in 2012. The settlement is the fifth largest in Australia's history. Sarah?
All right, Contessa, thanks. Contessa Brewer. Well, we showed you that red-hot mystery chart before the break. Turns out it is Elf Beauty, the company ringing the opening bell this morning here at the New York Stock Exchange, celebrating 20 years. The stock has rallied over 2,000% over just the past 5 years. Chairman and CEO Tarang Amin joins us now. You have presided over this company for the last 10 years of its 20-year public life. Why has it been such a moonshot kind of performance in the stock price?
Well, I think it reflects our exceptional consistent category leading growth. We just finished our 20th consecutive quarter of net sales growth. Our third quarter was up 85%. We've more than doubled our market share, and I think investors are rewarding us for that consistency.
Is the growth driven by you entering new stores like a Walmart? I know you've been in Target for a while, and new channels, or is something else?
You know, we're seeing growth across the board. Our number one driver of growth is productivity and the customers we're already in. Our digital business was up over 100% in the quarter. Our international business is up over 100%. So we're seeing really great growth across the board, and it's really driven by three things. It's our exceptional value proposition, our powerhouse innovation, and our marketing engine. They're all working together to really continue to propel our growth.
Yeah, I mean, people don't realize that it costs $40 to buy, what, a YSL or Dior lipstick, and you're selling it for under 10.
Yeah, our lip oil is $8 versus a prestige item at $40, and consumers recognize the quality, and as soon as we launch it, we never make a direct comparison, but the products take off virally because everyone can't believe that they can get that quality.
Virally, like on social media?
All throughout social media, on TikTok, on the various platforms we're on, where we have our own channel on Twitch. We're pretty broad-based in terms of a lot of the social channels we're on.
So you're probably not rooting for TikTok to get banned in the U.S., which is under consideration now in the Senate.
Well, I'd say, you know, we live wherever our community lives. So if something happens to TikTok, we'll go to where our community is. We're the number one brand amongst Gen Z. We're growing amongst millennials, Gen X, and it really has to do with this unique engagement model of how we really engage and entertain our community. So we'll find them wherever they're at.
But would it be a material hit to the business in the short term?
No, I don't believe so. The reason for that is we're pretty broad. If you take a look at our strength on Instagram, on Facebook, on TikTok, on Reels, our platform's quite broad, including our digital advertising. So we're not a brand that's dependent on any one platform.
Are you growing customers, or is it mostly repeats?
No, we're definitely growing customers. If you take a look at our brand, just in the last few years, we've doubled our unaided awareness from 13% to 26%. And if you look at where that growth is coming from, certainly our strength in Gen Z, but we're also picking up Gen X, millennials, as well as now Gen Alpha. So we have pretty broad base.
We know that the category has been strong. I mean, it's been an outlier for other sort of consumer discretionary goods, say at Target. They always call out grocery and beauty. Those are the strong points. What happens to your products in this inflationary period that we've had over the last 2 years or so?
Well, I think one of the things that really comes through is our exceptional value proposition. So we have this incredible value every single day, and I think that's benefited us. Consumers realize they can get the high level of quality at these great prices. And you know, you mentioned Target is our longest standing national retail customer. We're their number one brand. In the last 4 weeks, we had almost a 23% share of their entire category, which really talks to strength of e.l.f. I think the next highest brand was 13%. So we feel that bodes well for us for the future.
But have your prices come up on products?
No, we haven't taken our prices up. We've only taken 2 price increases in our history, one in 2019 in response to tariffs on China goods, and one in 2022 when everyone was facing inflationary pressures. A number of our competitors recently took pricing. We decided not to. We want to hold it for an external.
Why? Aren't your input costs going up?
Not necessarily. We have this virtuous circle. Just because we have such strong top-line growth, it allows us to have leverage in our non-marketing SG&A, which in turn allows us to increase our margins and offer a great value every single day.
You mentioned the tariffs, and you do still do a lot of manufacturing in China. So have you gamed out what would happen, say, in another Trump administration where he has already threatened increased tariffs?
We have. We basically, we're already carrying 25% tariffs on our goods. So if they're in some of those scenarios, if it's 60% tariffs, we'd use a combination of pricing and our diversification of our supply chain. We have been diversifying with suppliers in the US, Thailand, Europe. And so we'll use a combination to be able to deal with that if that happened.
Do you want to move all the manufacturing out of China?
I wouldn't say necessarily. I would say we have a great advantage in terms of cost, quality, and speed, but we'll be prepared. We've been around 20 years. We're gearing up for the next 20 years.
We had Alex Karp was on bashing the short sellers last week from Palantir. You have had short sellers in your stock. You've managed, I guess, to smoke them all out with this performance. But what has been the biggest doubt that you have had to address as the stock has soared?
Well, I think, usually you have people who feel like, did I miss the party? The stock is up so much over the last few years, but I've been CEO for 10 years. I've heard that all 10 years, and we continue to perform. And I think part of the reason why is we have incredible white space. We know we can double our market share in color cosmetics. We have 2 incredible brands in skincare with Alpha Skin and Naturium, and we're just getting started internationally. So we have plenty of white space to continue to pursue.
Look at that chart. Tarang, thank you very much for joining us. It's great to see you
here
at the NYSE. Tarang Amin from ELF.
After the break, the latest in U.S. military and autonomous technology. Morgan Brennan is live from a chopper with a look at what is still ahead. Morgan.
The guys are just talking about geopolitical risks. As the world has become a more dangerous place, that means more demand for more defense. But the battlefield and what's needed is changing as more software, more AI, more autonomy comes to the battlefield. So right now I'm inside a Black Hawk helicopter that is autonomously flying. We are doing that off of this tablet right here. Coming up on the other side of the break, we're going to do a deep dive into Lockheed Martin's $6 billion Sikorsky business, which is at a critical juncture, and what new capabilities like this are going to mean to the future of growth. Stay with us.
Well, more conflict around the world has led to greater demand for defense products and weapons systems, but a rapidly changing battlefield means some of the long-standing and expensive military hardware is being reconsidered and reimagined. Morgan Brennan is taking to the skies. You've seen her up there already, and she has that story. Morgan.
Hey, David, that's right. I'm sitting inside a repurposed UH-60 Alpha Black Hawk helicopter. It's not just any Black Hawk. This one's fully autonomous, which means that the pilots, there's two of them in the front of this aircraft, they can sit back and basically the computer can fly this helicopter. That's what's happening right here on this tablet, unmanned. First, a little bit of background. Sikorsky is a $6 billion a year business for Lockheed Martin. It's 40% of rotary and mission system sales. That's according to Jefferies. It's a direct top-line contributor to sales growth for Lockheed overall. Now, Sikorsky makes helicopters. It actually invented them. It's busy ramping production on the Marines' new heavy lift helicopter, the CH-53K, but what it's perhaps best known for is a long-standing workhorse, and that is the Black Hawk. The Black Hawk, its many variants, have been in the service for 45 years. More than 5,000 have been delivered. 36 countries as customers. The largest operator, though, is the U.S. Army. That's really where investors have been focused lately, after the Army scrapped plans for a high-profile, big-ticket competition for a new attack helicopter called FARA. Sikorsky had been competing. Analysts had seen it as a needed win after the company had lost another high-profile Army competition back in late 2022 called FLRAA, which is actually to replace and supplement the Black Hawk. Now the Army is repurposing some of those funds, including back into Black Hawk, and it's focusing more of its efforts on a changing battlefield and what that's going to mean for the military of the future. Autonomy is a key part of that, which is why we're here inside this Black Hawk, and joining me now to discuss all of it is the president of Sikorsky, Paul Lemmo. Paul, it's great to be speaking with you while we're literally in the air.
You're doing a great job piloting.
Yes, I've been pressing some buttons with some expert help here. Why was it so necessary? This capability has been in the works for 6 years for this specific type of aircraft. Why was it so necessary to develop this?
You know, when you think about 21st century warfare, you really think about autonomy. It underpins a lot of the capabilities that'll be on the battlefield in the 21st century. We've been working this over a decade, as you've said, and we built a system that's really platform agnostic, meaning it can be put on any kind of aircraft. We put it on fixed-wing aircraft, helicopters, and it's a capability that allows the aircraft to either fly without anybody on it, and the military might use that in contested logistics situations where they don't want to put people in harm's way, but they have to deliver critical supplies to the troops. It also can be used as a safety feature. It's a capability that will allow the pilots to land in degraded visual environments, which is something that has caused a lot of accidents, particularly for helicopters.
So do you already have customers for this technology? And perhaps just as importantly, is it a nice to have or is it a need to have? Does it open up new avenues of growth?
We think it's a need to have for the future. And yes, we've been working with a number of different customers experimenting on how this can fulfill their capability needs.
So in light of that, how does it speak to where the growth in general comes for Sikorsky in the future? As we mentioned, $6 billion business for Lockheed, some changes at the Army, not involved in what is called future vertical lift, but money going back to Black Hawk. Walk me through it.
Yeah, so we're fortunate to have a very strong backlog at Sikorsky. We have 3 to 5 years worth of backlog for the CH-53K, Black Hawks, and the Army has said that with the cancellation of the FARA program, they're going to go to another multi-year contract for Black Hawk production. So that'll take us out through 2032. And then perhaps most importantly, they're committing to modernizing the Black Hawk to ensure that it's ready for 21st century battlefield, being able to interoperate with everything that's going to be out there. And then longer term, we think things like autonomy and hybrid electric aircraft are going to be critical to our future. Hybrid electric is certainly something that's coming to aircraft and aviation, just as it did for automobiles. And we're going to be at the forefront of that technology and continue to innovate as we have for the last 100 years at Sikorsky.
So you're getting into the eVTOL game, or at least the hybrid eVTOL game, it sounds like.
We are, but we're going to stick to what we're good at, which is typically the heavy or medium lift, long range type of missions, both for civil government and also for military.
Paul Lemo, thanks so much for joining me here and taking me up in this Blackhawk. Appreciate it.
Thank you.
Guys, the president of Sikorsky, we're going to have more on closing bell overtime later today, too, as we continue to deep dive into this portfolio.
Very cool to listen to and watch, Morgan. Thank you so much. Morgan Brennan from the sky above Connecticut. Up next, shares of Nvidia up 80% so far this year. The tech giant kicks off its AI Developers Conference today with a keynote from Jensen Huang. We're going to head live to the big event, find out what is at stake here, what investors are expecting to hear. Stay with us.
NBC.
Nvidia kicking off its annual GTC conference today, set to unveil its latest AI technology. There's a lot of hope and expectation, just given the stock price. Christina Partsinevelos live from San Jose, California. Christina, good morning with a look at what we can expect here.
Yeah, I'm in a parking lot right now because it is quite early. We're expecting 11,000 people at this big arena behind me. That's how big, how many people they're expecting for a 2-hour keynote from Jensen Huang. The stock, though, you mentioned that. The stock has soared over 80% in the last 3 months. Shares have been volatile as of late, moving at least 2% out of 8 out of the last 10 trading sessions on no particular news, which begs the question, what else can Nvidia say to excite investors, and how much is already priced into the stock. So to answer your question, Sarah, the first thing to expect is any new product updates and announcements, specifically specs of its latest AI GPU. You know, how much memory will it have? How does it compare with AMD's latest chip? And maybe some details on the price point. Is it actually going to be 30% more than the H100? You know, is it going to be anywhere between $40,000 and $50,000? The second point is partnerships and collaborations. Micron's earnings are out, for example, on Wednesday, but they alluded to a collaboration with Nvidia. Same for Oracle, Broadcom. TSMC makes Nvidia's chips, so we could hear more on that partnership. And you could expect, as you can see, a sea of green right now, but sizable moves should Nvidia have them on stage. Lastly, demand, sustainability, and visibility into 2025. Will inferencing, for example, be the next major driver for growth now that many large language models are trained? And how will that expansion into other sectors like finance, healthcare, government, sovereign wealth funds help keep up the pace of growth and potentially change NVIDIA's total addressable market, which we know Jensen Huang has previously said it's about $1 trillion. So will that go up? So you have this big event, AI Palooza, the Woodstock of AI, the Gossip Hole of AI, from the Godfather of AI, all of these terminologies. But NVIDIA is now one of the largest, or three largest stocks on the S&P 500. So any move or any sharp move in the stock will have an outsized impact on the NASDAQ and the S&P 500. Guys?
It kind of is hard to imagine that there's just so much, that the biggest event has become a semiconductors developers conference. I mean, I remember when it was Apple. I don't know. Do semiconductors usually do these? Because we've never really covered them before.
He does.
So this is the first one in 5 years in person, and previously, no, there was never this amount of attendees. 11,000 here, 16,000 over the course of 2 days. There's no hotels for miles. Everybody's walking around with a green lanyard. There's GTC green signage everywhere. It's so just based off of the few years I've been covering it, it's definitely nothing I've seen before. Even AMD was hosted in the same city, but did have a much smaller presence.
Yeah, well, listen, it's not to be unexpected, though, given the importance of Nvidia and the current economy that we have right now. Just think about how, I mean, we talk about it endlessly for any number of obvious reasons, right, Christina?
Yeah, exactly. And I guess the biggest point, too, is the impact on the markets right now. If you're, an investor that's watching, like, I don't care, I don't follow semiconductors, well, you got to care because it's probably in some type of index fund you're holding, or it's going to have an impact on the S&P 500. It's the third largest point impact for NASDAQ and S&P. So it affects everyone right now, those that are invested in the market.
Christina, thank you. And a reminder, of course, tomorrow on Squawk on the Street, there he is. Exclusive. Nvidia CEO Jensen Huang. That'll be live in the 10 a.m. hour with Jim Cramer, followed by a two-part interview later that day as well on Mad Money.
It's going to be good.
Oh, yeah.
Leather jacket and all. Check out shares of Hertz on the move. They've actually been hammered, down around 8%. CEO Stephen Scherr announcing that he is stepping down after just 2 years. The company says GM's former Cruise COO, Gil West, will be taking over. The change goes into effect on April 1st. I just want to, there's a lot about this being written, being discussed, about the failed EV strategy, and that's certainly part of it here. But from what I've learned, Stephen Scherr announced he wanted to resign. It was his own decision. He went to the board, and they actually wanted to keep him. He doesn't own the EV strategy. This company, 4 months before their IPO back in 2021, actually decided to go all in buying Teslas and made a lot of promises about that. He did preside over what happened since and leaned in and embraced the strategy, but also ultimately put a stop to buying Teslas in 2022 when the demand wasn't there, and then had to take a big financial hit when the prices got dropped and it weighed on Hertz. So that, from what I hear, he just decided this isn't kind of the growth story. It's going to take someone who knows operations to just turn it around from here and fix it and deal with some restructuring.
Yeah, a long line of leadership at Hertz, and yet still haven't quite figured it out. All right, our live market coverage, where are we? Here, where are we? Continues right after this.
GTC.
Good morning again, and welcome to Money Movers. I'm Sarah Eisen with David Faber, live on the floor of the New York Stock Exchange. Today, economist David Rosenberg on why the market isn't pricing in enough rate cuts ahead of the big Fed decision on Wednesday.
Plus, the CEO of Wheaton Precious Metals following strong earnings and with gold near all-time highs.
Then Alphabet helping to boost the market on a report that it's planning to team up with Apple to power AI technology on the iPhone. We're going to take a look at what it means for Alphabet, following a number of AI blunders. First up, though, in the markets right now, we're starting the day off pretty strong with the S&P up more than 1% now. It's just been pushing higher all morning long. The Nasdaq leads up 1.6% thanks to Alphabet today, but also Nvidia's higher ahead of its developers conference. We'll hear more about that later in the hour. And Treasury yields are higher again, 4.33, as bonds sell off into the Fed meeting. Expectations maybe the Fed will signal a more hawkish tone on inflation and rate cuts. Let's bring in CNBC senior markets commentator Mike Santoli. Last hour, we were talking about why the stock market has really been brushing off higher yields, because there was a time in the not too distant past where higher yields, firmer inflation spooked the market. But now we've got this AI story.
I think it's a big part of it. How much of the S&P 500 can we recast as an AI play, right? So today you had this nicely timed Alphabet, Apple news to say we're in this too. Nvidia is not the whole story. Market grabs onto that. Those were two stocks also that were big laggards, oversold. So that works as far as it goes. But I also think that so far yields are still in the range. Yes, they're higher. Last week was a big jump, actually in yields, one of the bigger one-week jumps. But it's still kind of below 4.5, 4.4 on the 10-year. I think it's still allowing people to say maybe nothing much has changed. And finally, I mean, it's because the economy has been relatively strong. So yes, inflation expectations and inflation data have been firmer than expected or hoped, but it's also coming with a better economy. And I think the market can try to look through that. On the other hand, if you take away the AI stuff, you really do have a market that's more in grind mode than in soaring mode. I mean, over the last month, you've really had kind of a lot of chopping around and rotation as opposed to up and away.
Yeah, but we don't take away the AI.
And you don't have to.
And we don't have to.
If you're an index investor,
you got two of the
helping.
largest market cap companies in the world today that are both up substantially. Obviously, Alphabet more so than Apple, but nonetheless adding a lot of market value.
And for now, all you seem to need is that you're going to be participating in the investment cycle and the rollout cycle, and Alphabet's cheaper than it's been for most of its history, so you can also make the case that people turned on it a little too much. I am focused, though, on, it's another 50-50 up-down market breadth day. It's not as if we're buying everything today. Energy, not so sneakily anymore, is performing pretty well, not just the stocks, but crude. Yeah, exactly. So you've seen this like reflation move globally as well. We'll see where that leads us.
What's driving that?
It's a really good question. I think part of it is just reversion to the mean stuff. We are going after the laggards. I think global growth expectations have improved in general, so there is a little bit of a demand story, and the
supply is tight.
Obviously, you sort of have some awareness of the supply challenges for oil in the near term.
All right, Mike, thank you. Good setup. Mike Santoli, as always. We're going to stay on the economy. Our next guest is still expecting a recession this year. It says may already be starting. Joining us now is Rosenberg Research President David Rosenberg. It's always good to have you. David, a lot of people would have thought maybe you would have thrown in the towel on the recession view because it just has not happened, and we've seen this persistent strength. And the economy, that's been part of the market story over the last year or two. Why are you not abandoning that call?
Well, because of the memories of 2007 when I was told the same thing and everybody was throwing in the recession towel, except for, I think, me and Dick Berner over at Morgan Stanley at the time. So I was quite content in holding my ground in 07, and I think that I'm going to be in good stead this time around, too. I just want to make the point that everybody seems to think that the economy is doing great. And I just heard Mike Santoli say that we have a pretty good economy in our hands because everybody is reliving last year's fourth quarter. But, we got some data last week, and with the big downward revisions that we've seen with almost all the economic data over the course of the past couple of months, we have real retail sales so far in the first quarter. There's 1 month left to go. Real retail sales, that's volumes, are running at negative 1.8% annualized in Q1. Industrial production is running at minus 5.6%. You have real sales and production contracting at the same time. And historically, when that's happening, unless it's an aberration, you have a 4 times greater chance of being in a recession than in an expansion. So it's just a matter of time before, if the data flow continues the way it has the past couple of months, I think the recession narrative is going to come back, in a fuller view, shall we say.
Yeah, we're definitely watching retail sales on the weakness and even industrial production. But David, both of those data points aren't reflecting where the strength in the economy has been, which is in the services sector. And that's what's been hot on the inflation side, and that's what's been surprising, I think, on the growth side as well.
Well, that's 100% true that the services side, you had the reopening of the economy, then bumping against, all the stimulus checks being spent, and that certainly provided a lot of impetus for service sector spending. But, when you go back to the most recent Fed Beige Book and you take a look at what's happening in terms of spending on travel and leisure, accommodation, restaurants, that's really starting to cool off. So I would tend to agree with you that in the hard data, it hasn't shown up yet, but anecdotally, it certainly is.
So where do you see recession? I mean, besides in the manufacturing sector and in some of the spending data, where and when do you actually see recession taking shape? I know you always say unemployment is a lagging indicator, but we're still below 4%, and the jobless claims are not lagging, and every week they continue to point to strength. So as people have jobs and they get wages, how does that add up to recession?
Well, there's a huge dichotomy, Sarah, in almost all the data, and that includes the claims numbers. So the spot claim numbers have remained exceptionally low, and what it's telling you is that companies are not firing people. However, look at the backlog of continuing claims. They've continued to rise, and what that's telling you is that it's getting tougher and tougher for the backlog of unemployed to find a new job. And keep in mind something else, that we have a bull market in the part-time economy. So when you go to the household survey, you're going to see that all the jobs and then some that have been created in the past year have been in part-time work. So if you're trying to answer the question, why have claims remained so low? Well, if you're a part-time employee and let's say you do get laid off, you're not really eligible for unemployment insurance. So there might be just some sort of, downward skew happening from that development. But I'm still scratching my head that we would have a narrative, because of course people think the stock market and the economy are one and the same. And the stock market, it's not been an earnings story. The forward multiple has gone from 18 a year ago to 21 right now. 3 points of multiple expansion in a year is a 1 in 10 event. But how can we be talking about a buoyant labor market when there has not been one net new full-time job created in the United States over the 12 months to February? How do you square that circle to a narrative that we really have a robust labor market on our hands? I know that's the narrative, but I almost feel like I'm Christopher Columbus in 1492, standing in front of Isabella and Ferdinand, trying to tell them, no, the world isn't flat. So I know that, I don't know, we keep on reliving last year. Last year's GDP growth, 2/3 of that 3% growth came from the fact that the fiscal deficit, in the context of a sub 4% unemployment rate, the fiscal deficit should have come down last year. It expanded 25%. Yeah. But that's not recurring this year. We're running fiscal policy on a set of continuing resolutions. There's no fiscal stimulus this year. So that comes out. But
not infrastructure? Not infrastructure
fiscal,
chips? Isn't that still coming through?
What, the AI craze?
No, just the infrastructure spending from the federal government, the CHIPS Act.
Yes, that's what I'm talking about, Sarah. We had the biggest number last year in the economy was that the construction of manufacturing facilities in the U.S. was up 60%. And so there's your subsidies for expanding chip capacity in the U.S. That's already started. But what was industrial production last year? It was 0. So it's almost like a Potemkin economy. We're creating these facades. So we have 60% growth in the construction of manufacturing production facilities with no growth in actual industrial production. So interesting dichotomy. But that when I said that the 2/3 of the growth from fiscal, it was both the actual expansion of the deficit and all the multiplier indirect impacts that gave you that 3% GDP. 2/3 of that growth last year was fiscal policy, pure and simple.
So here's my final question relating to the market question and the event of the week, which is the Fed. If the economy is as weak as you describe, why isn't inflation coming down faster and further in a more decisive way where we don't have to wonder, is it now going to be 2 cuts instead of 3 cuts, and maybe they're going to push that out even longer?
Well, again, I don't know why you say that, but I know that's, again, a popular narrative. We've hit a couple of months of a roadblock, but nothing moves in a straight line, not even inflation. But when you strip the shelter component, for example, out of the CPI, and we know that that is a flawed statistic. I mean, 27% of the CPI is owner's equivalent rent, which is one question to a sample of households. What can you rent what do you think you can rent your house out for? When you strip out shelter out of the CPI, Sarah, the inflation rate's running at 1.8. A year ago, it was running at 5. The core X shelter is running at 2.2. This time last year, it was running at 3.7. So are we going to bang our heads against the wall because of monthly gyrations and wiggles in the data, or do you want to take a look at the big picture? So you strip shelter out of the equation, and inflation's already running below target.
On the CPI, not necessarily on the PCE. It's not weighed as much. I think the next biggie is March 29th. That's going to be important.
Same thing with the PCE. For all the hand-wringing over the PPI number last week.
Yeah.
We were just going crazy looking at the month-to-month gyrations in the data, the year-over-year trend. Let's look at the big picture. The PPI, okay, where's it running? With all the anxiety and angst from last week, and as Mike Santoli said, in the run-up in bond yields, I mean, the year-over-year trend in the PPI is the grand total of 1.6%. It was 4.7 this time last year. The core PPI is running at 2% on the nose. It was 4.6% this time last year. So do you want to pay attention to the monthly wiggles in the data, or just look at the fundamental big picture that the disinflation momentum is still fully intact?
All right. It's a view. David, thank you. We certainly appreciate you coming on to talk about it. David Rosenberg, as always, from Rosenberg Research.
Well, after notching new all-time highs, gold did fall a bit last week. It was its worst weekly performance since the end of last year. We're going to look at that move next with the CEO of Wheaton Precious Metals. Plus, we'll break down the company's earnings report. It was an increase in its dividend that went along with that as well.
We're also going to get to Tesla, of course. Goldman Sachs moving its price target on the name. We will share the update. Money movers back in just a moment with the Dow up about 160 points.
Shares of Tesla are up almost 6% so far this morning, despite Goldman Sachs lowering its price target on the stock by some $30. Now it is a $190 price target. That's still above where it is. Production headwinds tied to the Red Sea conflict, that Berlin power loss at their plant in Germany a few weeks ago, the catalyst as well, specifically impacting its Model 3 pace. Shares have had a rough start, of course. We've talked about it often to the year, still down some 30+%. But Sarah, it's having a nice up day after, again, last week, still sort of treading water at best.
Helping the NASDAQ as well. It's not even one of the better. Google, Apple, Nvidia are all doing even better right now as far as NASDAQ performance, which is why we're seeing a big gain. Let's turn to gold. Our next guest is one of the biggest players in mining, joins us after reporting an earnings beat late last week. All as prices keep hovering right around record highs set earlier this month. Joining us now in a CNBC exclusive is Wheaton Precious Metals CEO Randy Smallwood. Randy, welcome back. Good to have you.
Always good to be here, Sarah. Thank you.
So what is driving the price of gold, which is clearly helping out your margin story? Is it about central banks?
Yeah, exactly. We're seeing a lot of central bank buying, a lot from China, but we're also seeing Singapore and Turkey and Poland to a little bit lesser extent, and a number of other smaller countries, but a lot of central bank buying. And we are seeing that because the equities just aren't getting the same level of attention. And so it clearly indicates the central banks are really driving the price here.
They're buying actual physical gold in large amounts. Is that sustainable?
Well, the price is what adjusts to make it sustainable. That's what's pushing the price up. Is that there's a lot of those sovereign banks have pretty healthy U.S. dollar reserves in there, and I really look at it as they're swapping out U.S. dollars for gold, and that's what's pushing gold prices up.
Because they want to get out of dollar. Is it like a geopolitical statement? What do you think's driving it?
Yeah, I think it's probably I think it's more of an apolitical statement. They just like having something in their central bank reserves that doesn't have political influence to it. And that's one of the advantages of gold, is that it can't be influenced from outside. And so it's purely on a demand basis. And I think it's just a shift towards that safety, that security.
We have had a move up. Sarah pointed it out a little while ago in some other commodities, copper and the like. That a part of this as well?
Well, I wouldn't think so. Central banks, when it comes to copper, there's no doubt that good sources and good supply of copper is going to be something that we need as a society for many years forward. And it's getting tougher and tougher to build and operate copper mines around the world. And so existing supplies are going to become even more valuable. And I really do think that that's more of a drive on a statement on the economy in terms of the needs for electrifying the world.
Well, then I guess back to central banks. When are they sated? When have they replaced enough dollars with gold? Do we have any sense for that?
Well, I hope it's. To me, I see a good movement in that direction. I think it's got some good flow. I'm more excited about the concept of having the broader population start to realize the same reasons behind that, and starting to wake up more of a retail investment space. And we are starting to see some movement there. We're starting to see a bit more activity on the equities, and the ETFs are still sort of flattening out. They're not losing as much as they were in time past. So that tells me that we are starting to see a bit broader uptake in the gold space.
So besides gold, which is obviously fun to talk about right now because the price is moving, you also mine palladium, right, and silver. And I'm curious what your strategy is, where you see the biggest opportunity, because I know you've been doing some acquisitions as well to expand the geographic footprint.
Yeah, first we had a really busy year last year, and our first steps into Africa. We invested into the Platreef project in South Africa, and we also stepped into a healthy gold project in Australia. So we definitely have expanded into the space. Out of all the commodities, silver definitely is something that's going to play a role in where we are going as a society in terms of electrifying. Silver conducts electricity better than any other metal. So if we want more solar panels, or we want stronger mobile electronics, whether it's smartphones, smart watches, smart rings, smart cars, silver will always play a bigger role in that. And again, one of the challenges that we're seeing around the world is it's tougher and tougher to supply the materials, to get the permits to operate mines. And so that means that any companies that have good, solid assets is just going to become more and more valuable as we move forward.
What is the difference between a streaming company and a mining company? Because it sounds like that's something that analysts have been focused on as it relates to your acquisitions.
Well, I think the biggest difference is risk. We sign contracts where we get metal delivered to us, a portion of the production delivered to us at a fixed price. And so we don't have any cost risk. That's the huge advantage of a streaming company, is that we deliver all the exploration and expansion potential from a good mine, but we don't have the capital cost risk. We don't have the operating cost risk. Our margins are fixed. Our margins are defined. Our costs are fixed. And so, to be honest, we're about, from a risk perspective, we're not much different than owning gold bullion. But the difference is we also supply exploration success, expansion potential. And so we really are I think, the best of all worlds in terms of owning the metal versus owning the mining company. We deliver the best of the mining company and the best of the metal. So it's a really unique business model. This is our 20th year. We created this business model 20 years ago, and so we're celebrating. It's a new financing mechanism that really opens up, I think, an excellent way for generalist investors to dip their toe into the gold space, into the precious metal space.
Thanks for explaining it. Randy, thank you. It's good to talk to you.
Always a pleasure. Thank you, Sarah.
Randy Smallwood, who needs semiconductors, I guess. Silver going to power smart everything.
Yeah. Conducts electricity well, as you heard
As
there.
we show NVIDIA.
Yeah, of course, really, you may need their chips, too. In fact, a lot of people seem to need them. Nvidia is hosting that developers conference this morning. It will discuss the latest in advances, of course, in AI. It's GPUs that fuel so much of the generative AI programs that are going on right now. We're going to be live in San Jose. We'll take a look at whether this massive surge in demand will continue.
For me, a change maker is someone who forges their own path and makes it wide enough that others can come along with them. One thing I wish I'd known when I was starting my career is that there is a difference between something that is impossible and something that is just hard. And the reason why that is important is people can do hard things. You have to ask yourself, okay, is this just hard or is it impossible? Because impossible is impossible to do, but something that's hard may be a self-imposed constraint, and people can do hard things.
C.
European markets edging slightly lower this morning after CPI comes in line with expectations. Both the core and headline numbers falling on a year-over-year basis from last month. China, a bright spot on the economic front, industrial output beating expectations in February, growing from the last read, though not all positive data there. Retail sales slightly beating analyst estimates, but slowing still by nearly 2% from December, and unemployment unexpectedly jumped. Turning to Japan, some concerns over a sluggish economic picture. The core machinery orders in Japan comes in below expectations in January, prompting the government to lower its view of orders to, quote, showing some weakness from stalling for the first time since November 2022. This all comes as the Bank of Japan kicks off its two-day policy meeting, where it is expected to scrap negative interest rates, raising rates for the first time since 2007. Investors aren't worried, though. The Nikkei went up again, more than 2% today, I think, on the economic weakness that we're seeing in Japan, which may restrain just how much they're able to hike now that they're going to get set to lift interest rates.
Right,
They're
but
seeing
overall,
inflation.
the story has been a positive one on the economy. What are these signs of weakness specifically that we're...
And the GDP has shown weakness. They barely managed to escape recession, two negative quarters of growth. You're seeing it in the... No surprise in the manufacturing sector, because exports around the world have been weak and manufacturing around the world has been weak. But what's strong in Japan is the corporate. First of all, wages and prices have increased, but also these companies have made some big adjustments just in terms of their governance, which has awakened some
more productivity.
Spirits.
Some of the traditions have fallen by the wayside in terms of lifetime employment, for example.
And listening, I think, to outside investors, which we're hearing a lot, more just anecdotally, whereas you would have never been able to do that in Japan. Anyway, all of it has powered this boom in the Nikkei, which is near record high.
Yeah, although it took a really long time for it to get back to its records, let's not forget.
No, it was a few decades of stagnation.
Number 30 years of stagnation. All right, let's get to a news update. Silvana now has that for us. Silvana.
Hey, David, good morning. Donald Trump has not been able to get a bond to secure the $464 million fraud judgment against him. The revelation came out in court filings this morning. The former president and his company would need to post a bond for the full amount by next week in order to stop the New York Attorney General from being able to collect the money while he appeals. The court documents say Trump has approached 30 surety companies through 4 separate brokers. His attorney saying securing the bond is a, quote, practical impossibility. Meanwhile, President Biden is expected to speak with Israeli Prime Minister Benjamin Netanyahu today. It will be their first conversation in more than a month, and their first since Senate Majority Leader Chuck Schumer called for Netanyahu to be replaced in elections after the war in Gaza ends. The first over-the-counter birth control pill in the U.S. is now available to buy online. The O pill costs about $50 for a 3-month supply, or about $90 for a 6-month supply. The FDA approved the oral contraceptive for over-the-counter use back in July. Sarah, I'll send it back to you.
All right, Silvana, thank you. Truist and HSBC, the latest Wall Street firms to hike their Nvidia price targets. Truist is now at 1,177. That's as Nvidia Developers Conference kicks off right now in San Jose. And San Jose is where we find our Christina Hertz. Great expectations for today, Christina.
Yes, great expectations. You find me in a parking lot right now, but that's because the event hasn't started yet. Even though Nvidia was down 4 out of the 5 sessions just last week, it actually grinded out its 10th positive weekly gain. That is the longest on record, and shares are already up today, as you can see in the green, ahead of this big graphic processing unit tech event in San Jose, so GTC. In order for this to not become a sell the news kind of event, investors will be looking for one main theme. That's demand sustainability beyond this year and next. And that includes, yes, product updates on the H200 chip, which is another GPU chip, the newest GPU chip, which is going to be the B100, expected later this year, Ethernet switches, edge products, the growing software ecosystem, all of that could contribute to an increase in their total addressable market, their TAM. So recently, Justin Wong, the CEO, said that AI systems will grow, or that specific market will grow from $1 trillion to $2 trillion in the next 5 years. Today, we're going to be looking for details on what that means per year. For example, I saw one note that said maybe it'll be $500 billion per year. This is the total AI system market. So if Jensen Huang goes on stage in that 2-hour presentation and ups that number, this is going to go beyond Nvidia's stock, and it's going to move and have an impact on other names like Supermicro, Broadcom, AMD as well, since the AI market as a whole is expected to grow, and it's going to reinvigorate this trend. For the demand sustainability theme, though, we're going to also need to hear more about Nvidia's penetration beyond hyperscalers like the ones with deep pockets, Microsoft, Amazon, Google, Meta, etc. And we're going to hear more about governments, sovereign wealth funds, healthcare sector, the finance sector, so that there is continued confidence in this astronomical pace of growth for Nvidia. That's what we need to hear. Instead of just these, catchy phrases of AI palooza, the Woodstock of AI, the gospel of AI, Nvidia is now one of the 3 largest S&P 500 stocks. So any sharp move that we see today will have an outsized market impact on the markets.
I wonder if they talk about China and the chip that they're designing for that market, because that, I feel like, has been a big focus for investors and potential big growth driver if they get it right.
Definitely, because previously, before the export controls came in place, China contributed roughly 20 to 25% of their data center revenue. We know the latest earnings report, that dropped to mid-single digits. So it's actually decreased quite dramatically because of those export controls. There are rumors that, not rumors, Nvidia has said that they've created chips for the market that are able to be shipped and able to be licensed out. So they're in the green so far. To your point, I haven't seen as many notes or as many comments about this. There could be a possibility, but I think maybe it'll be more focused on the launch of the 2 AI chips, the H200 and then the B100 for this year, and then another one for next year that may get more of the focus. But I'm sure China will come up because it is such a large contributor to their data center revenue. And we know if there's a Trump presidency, that could really change in the next year or so.
Yeah, no, I guess your point is the sexier, more innovative stuff is what's in focus today. Christina, thank you. Christina Partsinevelos. A longtime Nike bull downgrades the stock to sell this morning ahead of its Thursday earnings report. We're going to talk to the analyst behind the call next.
Fitbit.com.
A note on Nike grabbing our attention today. Williams downgrading the retailer to sell, saying its strength will continue to diminish, arguing that it seems like it's relying more heavily these days on consultants than company experts to drive strategy decisions. The analyst behind the call joins us now, William Trading's Sam Poser. And Sam, I really wanted to talk to you about this call because you and I have been talking about Nike for years. How long have you been covering this company?
Years. I think it's 2007, 2008, something like that.
So 17 or so years. And you have loved this company, and you're one of the biggest fans. This note has a very different tone. What's changing?
I think they're sort of sitting back on their heels a little bit. We keep seeing more of the same product coming out. We see decisions that to release products. They did some shock drops on the Jordan 11 over Christmas shoe ahead of it. So prior to the real launch in December, the product was already being sold at or below retail on third-party websites. We got a comment from Hibbett the other day that their launch product wasn't as good as it had been. Nike basketball and Nike running have been not as great as they have been. We get the impression that they're pushing a lot of the product into, let's say, Foot Locker, in those categories. Really not demand planning as well as they should be, and we think that using a push model rather than a pull model is a good way for any company, especially Nike, who is sort of the creator of the pull model, to have some problems. And
I was going to say, everything you just laid out,
story.
All those examples are traditionally what Nike has excelled in, what has made it better than the competition, the innovation, the channels, and the going direct to consumers, the new products and the prices they're able to command for that. Is this what do you think has changed internally? Is it a leadership issue? Because John Donahoe, he was on the board. He's been running the company for a while.
Look, I mean, so when John Donahoe took over in 2020, it was great timing. He was able to really jumpstart their direct-to-consumer business. But based on our checks, at the same time, he, really stopped paying as much attention to the multi-branded retailers. We thought that getting rid of a bunch of them was a good decision, those ones that were not representing the quality of the Nike brand. But in certain categories like the family footwear channel, where they downplayed that a lot, they really found they couldn't sell that. And when the consumer came back and started shopping in stores again, he really wasn't ready for that, or the company wasn't ready for that. And unlike the prior leadership, if you showed Mark Parker a shoe, he'd be able to tell you if he thought that shoe would be good or not. And I doubt he was right all the time, but he had a very good instinct for it. And part of the consultant issue that you mentioned is I don't think there's just that instinct for product. So they're using a lot of spreadsheets now versus combining the art and the science, which I believe has made them so successful over the years.
Yeah, I mean, Sam, it's David Faber. You don't hold back in your report. You sort of just encapsulated some of it. But you say, many seasoned Nike executives across many parts of the corporation were let go, left the company, and you talk about C-suite leaders lacking the levels of brand and Nike institutional knowledge. So that would seem to speak to a problem, if you're correct, over not just the short term, but a longer term.
Well, I think we've already seen some of that come out in recent results. And so, yes, I mean, we think this is not just me making a call on the quarter. We think there's something fundamentally needs to be fixed there. And, a lot of the changes were made, a lot of the decisions being made. I mentioned in a note that came out in December that, they hired a woman from Amazon to be their chief technology officer. Now, she certainly checks all the boxes to be able to do that job, except for our checks say that she's not a real brand person. And I would think that anybody you bring into Nike better be brand first. Of course, they have to have the correct operational skill set, but, Nike is a brand. And if you're putting operational stuff ahead of brand for a company like Nike, there's going to be issues.
Well, it certainly is it is notable, especially coming from you, Sam, who I said has been a deep admirer of the company and big fan of the stock for a long time. Sam Poser from Williams, thank you. And David, the Nike reports earnings on Thursday, and Sam expects them to cut full-year guidance again. They did last quarter, remember, on weaker macro trends. China's going to be really key. That's been a
comes up every time, of course, so important to them as well.
Yeah, a big driver. Charles Schwab's chief fixed income strategist on next on the rate cut timeline and what to do with bonds ahead of Wednesday's big Fed meeting. We're back in a few.
Welcome back. Take a look at yields, 2-year, 10-year, 30, all you can see that. That would be right near 1-month highs as we head, of course, into this week's Fed decision. And when it comes to finding value in the bond market, our next guest is telling investors to consider gradually extending duration and look for opportunities in investment-grade corporates. Joining us here at Post 9, Kathy Jones, Chief Fixed Income Strategist for Charles Schwab. Kathy, good to have you. Let's start off with the FOMC meeting. I think you've said you're bracing for a potentially hawkish meeting. Why?
Well, I think what we've seen in the last couple of inflation readings and some of the economic data, things are not slowing down as much as the market had anticipated, probably as much as the average voter at the FOMC had anticipated. So I don't think they're really going off course or going to reverse course or anything like that, but they just don't have that leeway to be as aggressive in signaling rate cuts as I think they might have been before. So we're looking for maybe the dots to indicate 2 rate cuts this year instead of 3. You only need 2 voters to change their estimates for that to happen. So it's a possibility. And then we're looking at the summary of economic projections and saying what the upgrade is to growth, what the upgrade is to inflation, at least near term.
So we've seen Treasury yields move on the back of this. They've been higher in the last few weeks. Is the downtrend still intact, though?
I think so. I mean, I think overall, we know the direction of travel is lower, right, from the Fed. They're not signaling they're going to raise rates. And I think what Powell will probably emphasize in the press conference is there's still room and a plan to start cutting later as they get more confidence about inflation coming down. So even if they're the terminal rate's only going to be 3% or 3.5% instead of 2.5%, there's still 200 basis points in rate cuts to come. So I think the downtrend is still intact, but I think what we'll see in the second half of the year is a bull steepening with short-term rates coming down more than long-term rates.
So where do you think the opportunity is at this point in fixed income? Corporates?
Yeah, we think that corporate spreads versus Treasury is obviously very low and very tight spreads. On the other hand, they can go lower. And if the economy is going to go along okay, if corporations have termed out their debt and they're not sitting on, refinancing risk in the near term, at least investment grade, then locking in a 5.5% yield right here, I think for a lot of people looks really
obviously you can get a higher yield than that with high yield, but you're a bit concerned there, at least in terms of what it might mean if there's a risk-off environment. We just saw that.
Yeah, exactly. So risk-off is obviously a much bigger risk to high yield. Now you're getting a lot of yield, but at this point in the cycle, a lot of these companies do have to refinance in the next year or two, and they will be refinancing at higher rates. So, one of the sayings now is stay alive until 25, right? So there's more risk in high yield, and those spreads are very, very low.
Are you surprised how well that market's held up so far?
Yeah, absolutely. We had really been more cautious earlier, and we still are cautious, but I am surprised it's held up as well as it has.
People are using the stagflationary word, stagflation, right now. Higher inflation, lower growth. First of all, do you buy that scenario? Is that what's happening? And if so, what would it mean for bonds?
No, I don't think so. I mean, we still have a downtrend in inflation, still a disinflationary trend overall. We've gone from 9% CPI to 3 and change. So there's nothing to say that that's not continuing. And actually, growth is doing pretty well. We've had a big boom in productivity the last 3 or 4 quarters. So if anything, we're kind of in a very nice spot right now. The question is, how long that continues if the Fed stays tight. But nonetheless, I think we're in a pretty good spot. So stagflation doesn't strike me as a realistic outcome.
Kathy, thank you.
Thank you.
Alphabet higher today, sharply higher, on a report that Apple plans to use Google's Gemini AI for new iPhone features. We're going to look at what it could mean for that company, for Alphabet. The stock seeing its biggest gain since February of last year.
Market moving report today that Apple's in talks with Google to put Google's generative AI Gemini system into its iPhones. That is sending shares of both stocks higher today. Deirdre Bosa has some details for us, and certainly, I'm sure, some context, as she always does in her tech check.
Good morning, David. So this is really an AI plot twist, validation for Google, and more doubts around Apple's strategy. Their stock movements over the last month, they really do tell this story. Alphabet shares, they fell on that botched rollout of Gemini in late Feb. They've continued to lag broader markets. Microsoft, despite some concerns around Copilot, it's continued to be seen as the lead. But look at that tick up on that blue line, which is Google today. That's today's report, a shakeup. Google leapfrogs Microsoft with that. At one point, it was up 7%. A deal to license AI features on the iPhone. It would be a strong rebuke to the bears who worried that Google's Gemini was falling short of competition and that it would have trouble monetizing its AI. That current distribution deal with Apple that we talk about often, that has helped cement Google's dominance in search. Another AI deal that could give Google a boost in the early innings here. Now, going back to that chart, Apple, you'll see, is the yellow line, remains at the bottom because it's still seen as last among mega caps in this AI race. And this report doesn't help that perception. Apple, of course, it's rarely the first mover, preferring to perfect a product before releasing it. But anticipation has also been building that Tim Cook & Co. would announce something big on the AI front at WWDC in June. That's its big developer conference. Of course, guys, only a report for now. Apple could still quietly be building up that AI strategy behind the scenes. We don't have other details like how it would be branded and even who would be paying who. Does Apple need Google more, or is it the other way around? But all of this reshuffling over just 1 month, that chart I showed you, it tells us how volatile this race is and how quickly winners and losers are perceived. The next few months will provide plenty more catalysts. We've got Google I/O May 14th, Microsoft Build, that's only a week later, and then, of course, Apple's WWDC in June, when many are expecting that big announcement, which could still happen. So we'll see, but this is how it's looking today.
Yeah, and as you point out, Deirdre, of course, there's still much we don't know. This is just a Bloomberg story at this point.
Yeah.
Assume it's well reported. But again, you know, it's certainly possible, isn't it, that in fact Apple could have approached or be in talks with any number of the generative AI providers, so to speak, and even perhaps feature all of them in some fashion, you know, on the iPhone.
And that's been a very good strategy. You take a look at another Gen AI company, which is Perplexity, right, which was kind of coming up on the scene in terms of this user interface replacing some search capability. And it draws on many different models. That is plausibly what Apple could do here. But in that report today from Bloomberg said that Apple did consider an open AI. So it kind of helps with that halo that we're seeing for Alphabet shares today, the idea that maybe it won out over OpenAI. But again, still very early on. You bring up a good point, David, that it's not done. It's not a done deal. We could see more happen here. And my point in showing that month-long chart is just how quickly things move in this space.
All right, Deirdre Bosa, thank you very much. And if we look at some of these mega cap stocks today, it's no wonder the NASDAQ is soaring almost 1.5%. It's Apple, it's Google, it's Nvidia as it gets set to kick off its developers conference. Tesla having I mentioned earlier that the others are outperforming. Tesla's actually jumping more, up more than 6%. But in terms of contribution to the overall NASDAQ at this point,
right.
when
Well,
you have
Tesla,
the big giants,
the $530 billion market value is less than half the others, well less than half.
But it's a good day for all of them. It's actually a broad day rally for the overall S&P 500, which is up 1%. Even some of the cyclical groups and even the more defensive ones, which are lagging like utilities, are in the green today, despite these higher yields. And they are grinding higher into the Fed as now more people are expecting potentially a more hawkish tone from Fed Chair Powell.
We just heard Kathy Jones say, as you've been saying, potentially two cuts instead of three, perhaps in the dots.
Yeah, and what he signals in his news conference, always interesting. Tonight it's going to be Bank of Japan. I know I'm watching it.
Of course.
We'll
well,
be
if you are, I will,
tomorrow.
Sarah. Okay.
Thank you.
So,
love having you here, David. That's going to do it for us here on Money Movers. Over to Melissa Lee and the halftime report. Welcome to the Halftime Report. I'm Melissa Lee, and today for Scott Wapner, the AI trade front and center as Nvidia gears up for its global AI developers conference, and two tech titans reportedly in talks to join forces in the AI arms race. The investment committee is standing by to break down what all of this means for your portfolio. Joining us this hour, Joe Terranova, Jason Snipe,
Steve Weiss and Shannon Sakosha. We're going to go live to San Jose, California in just a few moments ahead of NVIDIA's developers event. But first, we do want to start with our chart of the day. Google rocketing higher, and reports that Apple is in talks to use Google's Gemini AI engine in the iPhone. Take a look at that reaction in the stock, up 6%, showing some signs of life in the AI trade. Joe, what do you make of this news?
Well, this potentially reignites the Mag 7 concentration outperformance, because now Alphabet, Apple, they're participating, and they had kind of been sitting on the sidelines for an extended period of time. Fundamentally, this is a very interesting dynamic. I'm not necessarily sure who is going to be paying who in this scenario.
Right.
Obviously, we know that they pay Apple in terms of search. And this is also a little bit puzzling to me for Apple. Is this an admission that maybe they couldn't bring forth their own AI, Gen AI strategy fast enough? They're outsourcing it, and then the regulatory risk. There's regulatory risk for this as well. But clearly, this is a positive, a significant positive for Alphabet. And I think it's something that's probably been circulating in the market for the last week, because Alphabet's had a remarkably strong bounce over that period.
Yeah, there is a lot we do not know about the relationship. We only know that they are in talks right now, that Apple actually also had talks with OpenAI, according to this Bloomberg report. And so, Jason, how do you read it? I think it's interesting what Joe said in terms of maybe this is a read-through to Apple, that they didn't have their AI act together, and especially in time for the Worldwide Developers Conference in June.
Right. No, I think that makes sense. But in some, just to a certain degree, listen, I mean, Google is a default search engine for Apple. So, you know, this deal, I think, makes sense from that standpoint. I mean, they've worked together, obviously, for some time. And it's no secret, clearly, that the Gemini rollout has been not strong. So I think this is obviously a major positive. We're seeing it in the price action with Google today. Yeah, and to Joe's point, I think it's interesting to see, you know, Apple not have developed this on their own, you know, with all the resources they have in the build out. But I think it could be a short-term deal. We don't know. But I think they can get a lot from this deal and see how it develops over the long term.
Yeah, Weiss, you own Alphabet. Do you think that its AI search engine is fixable? That's why you bought this thing. Does this, I mean, this could open billions of users potentially for its AI search engine.
Yeah, so that is why I added on the decline based upon the poor launch of their AI tool. Look, I mean, the question is, you know, does Apple feel that they're behind and has to outsource it? Guess what? Apple is not an innovator. If you go through any of the tech companies, go through the largest tech companies, Apple has by far the lowest R&D expense. Its R&D expense is about 7% versus Meta at 30%. And you can look at the others that are at least double. So of course they're a follower. And of course they need somebody else to innovate for them. And Google, since it already is a partner, is a natural partner. And I'll clear up the mystery. Apple's going to have to either lower what Google pays them right now, which is like $19 billion a year, or they're going to have a separate line where they'll pay Google for using their search. So to me, it's a great deal for Alphabet. It is a fixable problem they have, and there are only 2 companies right now out there, maybe 3 if you include Meta, but it's for their own purposes, that have these search engines that others could use. One being Google, of course, and the other being Microsoft. So, yeah, so I think it's a great move.
They still have to fix their problems, though, Joe. I mean, and that's sort of the looming outstanding issue. Even if they are, you know, potentially unlocking billions of potential users, they've got to have a search engine people want to use.
Yeah.
People view as accurate.
Credible. And people want to know that it's a reliable source to them. I think clearly the circumstances of the last month kind of call that into question. So there's a lot there for them to still prove. But look, you wake up on a Monday morning. This is almost like when you wake up on a Monday morning and you have a big mega deal. That's kind of what this was this morning for the market. And it took the market away from where it was on Friday, which was in a little bit of a tenuous and tedious position. And it reignited some of that positive momentum. And again, I think the single most important from a strategic perspective element of this story is now do we have the Mag 7 outperforming once again? That kind of had been, that trade, that idea had been resting for the last several weeks.
And we do have the laggard Shannon finally participating. Okay, Steve, you want to butt in? Go ahead.
Thing? Yeah, I do want to butt in, actually, because I think it'll be very instructive for you, Mel. Look, we're talking here like Microsoft and OpenAI have flawless products. That is so far from the truth. The distance they've created in the launch between Alphabet and themselves is just not that great and easily transversed. So that just has to level set the conversation. OpenAI is not a perfect product. It's fraud. Microsoft is OpenAI. Google, Joe, I hope that's not a newsflash to you.
No, I didn't hear anyone mention Microsoft in the first 5 minutes of the show. That's
anyway, I wanted to ask Shannon what she thought of the market today in terms of the participation of all of the Mag 7 in today's session.
Well, I think Joe hit the nail on the head in terms of what the importance is here. And I wouldn't be surprised to see a little bit more of a tail on this for Alphabet, Melissa, than perhaps for Apple. I mean, the second derivative of this for Apple longer term is that if there's a rationale for users to upgrade handsets in order to access AI technology, that's where you're going to get the lift for Apple from this particular type of deal. But I think on the credibility side, Google's really been looking for credibility in terms of the ability for them to show that Gemini can be, a strong competitor or substitute for Microsoft's product. I think across the market, though, I think one of the things that we've been grappling with over the last several weeks has been this dispersion in the Mag 7, which in our view is a positive because it means that people are looking at fundamentals. It's also afforded the opportunity for some lift in some other sectors, but I wouldn't say it's at the expense of the Mag 7. It doesn't need to happen. It's not a binary trade, if you will. Some of the strength we've seen in energy, in materials, in industrials, that feels more as a response to some of the economic data we're getting outside of the U.S., for instance. So I don't think it's a binary trade. I think the lift that we see on the Mag 7 certainly helps from the concentration perspective, but I don't think it negates some of the momentum that we've seen in other parts of the market.
All right, so what does this mean for Apple and its widely anticipated entry into AI? Let's bring in CNBC technology correspondent Steve Kovac. Steve.
Yeah, so Melissa, I mean, at the end of the day, what we really got to think here is what is most important to Apple is selling more phones in this new upgrade cycle that's coming in the fall, and basically convincing folks that whatever AI features they do announce, Tim Cook says they're going to, and this is quoting him, break new ground in AI. We have some kind of hints, I guess, at what Gemini can do. Google had already started putting Gemini in a couple Android phones, their own Pixel phones. Samsung is using Google AI in its latest phones that came out just a couple months ago. But right now, what they can do is stuff like live translation between languages. They can take a voice recording and transcribe it natively on your device. And also some photo editing tools, like if you circle someone or something and tell it to erase that object in the picture, it can do that. Those aren't new or novel use cases for AI. It's not the breakthrough that Tim Cook is maybe teasing. So the question becomes, what else can Gemini do for Apple that they can leverage that language model in order to do what they kind of envision? And again, like so many folks were just saying here on the panel, it speaks to Apple's inability so far, if this is true at least, to come up with their own AI model, and that should cause some concern as well, because 5 or 6 years ago, the company hired a Google executive to run their AI division. His name's John Giannandrea, and this is kind of his baby here, that he needs to be pushing this AI narrative forward for Apple. And right now, it seems to be more leveraged on the Google side and a rival than it is building it in-house, as we would expect Apple to do.
If there is a partnership, Steve, do you think that this will be an Apple-branded AI search engine, or will it be Gemini on an Apple iPhone or Apple
That is
device?
the biggest question, because Apple, Apple obviously has Siri on the phone. It obviously has a lot of AI stuff going on under the hood. But if they all of a sudden need to kind of inject Google technology in there, what does that do? Does that mean it's no longer an Apple product? I mean, I will note, the best analogy we have right now, Melissa, is the search deal. When you go open up your Safari browser on your iPhone and just type in a search term into that bar at the top, that's all Google. That is a Google experience. That's not necessarily an Apple experience, and that is what Google is paying for. And like some other folks here just mentioned, the big question becomes, is Google going to be paying Apple for access to those billions of users for Gemini, or is it going to go the other way and Apple is licensing this from Google? Either way, it's great for Google.
All right, Steve, thanks.
Sure.
Steve Kovac. I'm curious, Jason, what's your take on the up 1.6% for Apple? It doesn't seem like a whole, I don't know. It seems like a kind of response.
Yeah. I think the most important point is I think it helps with the upgrade cycle going forward. You know, like what is the new news? What is the new catalyst? And all the points are well taken in terms of they have been slow to innovate. I think Weiss made that point. That, I mean, that's not really their game. I think it's all about the integration of other technologies and their user base and the user experience. I think that's what makes Apple special. But yeah, it's not getting the lift that maybe some would have imagined, but I think because this deal is more leveraged to Google, and I think that's where the opportunity is.
I think the interesting thing is, and Steve mentioned the lack of innovation at Apple, the bigger question is, Apple scrapped the electric vehicle mission, which was billions of dollars a year. What do they do with all that cash? If they're not paying Alphabet for the AI, what are they going to do with all this excessive cash? So Steve's actually onto something a little bit, not so much in terms of the innovation, but they're sitting on all this cash. At a certain point, the market punishes you for sitting on all that cash. Do they do an acquisition? What ultimately is, what are they going to do? They just can't sit there and continue to buy back stock. That's not enough for the market.
And their hands are tied when it comes to an acquisition. I mean, the regulatory forces are hard at work at this point against acquisitions in tech. Yeah. All right, the other big story we're watching is Nvidia, the company about to kick off its developers conference. Christina Partsinevelos is there live in San Jose with what we can expect from CEO Jensen Huang in just a matter of hours. Christina, the bar is high here.
Oh, it's incredibly high, and we saw that with the stock rise in Nvidia shares, but this is a developers conference, and they are going to want to hear first and foremost about the latest product, specifically specs of its latest AI GPU. How much memory will it have? How does it compare with AMD's latest chip? And its price point. We're expecting maybe about 30% higher than the H100, and this I'm talking about the new Blackwell chip. So we'll want to know a little bit also as well details about going beyond GPUs to include Ethernet cables, storage, and just that entire ecosystem, software as well. Jensen Huang is giving a 2-hour keynote, something we haven't really seen. You know, he's done this in the past, but the fact that 11,000 people are going to be coming to this big arena behind me is something new that we haven't seen in the last 5 years. And we should hear more details about partnerships, maybe some celeb CEO appearances, and examples. Micron's earnings are out on Wednesday. They've alluded to a collaboration with Nvidia, the same for Oracle, the same for Broadcom. TSMC makes Nvidia's chips, so we could hear more about that relationship and see the impact on some of these shares like Supermicro, ARM. You can see up 2% just today. Lastly, the theme, demand sustainability and visibility into 2025 and beyond. Will inferencing be the next major driver for growth now that many large language models are trained? And how will that expansion into other sectors continue to grow, like finance, healthcare, government, sovereign wealth? And if Jensen Huang continues to speak about that, that could help show that the pace of growth is going to continue. And much of these points, to become full circle, Melissa, are priced into this stock. You know, the share price has gone 82% higher in the last 3 months. There's been a lot of volatility just within the last week and a half or so. You know, it was down 4 out of the 5 sessions just last week. But it's the total addressable market, the TAM, which Jensen said would grow from $1 to $2 trillion in the next 5 years. So any type of details on what that means per year for them could reinforce this AI trade and provide confidence in demand sustainability beyond 2025, which is going to be a key theme here. In other words, the best of the AI golden age has yet to come. Or as Jensen Huang has said, we're still in the early innings.
Right. Same thing, right? Christina, though, when you talk about the total addressable market number, it's staggering, but does that also include software? Because this is a developers conference. Yeah, so NVIDIA has to convince people, right, that if they're not just going to be slinging GPUs, it's a whole software ecosystem that they also offer that will be a barrier to entry for others like an AMD. I mean, AMD has made some progress with their own software, but not as far along nearly as NVIDIA.
Precisely. So NVIDIA offers CUDA, so that's their big selling point. The developers are already using this type of software. The switching costs and learning would be very difficult to go on to any other type of software ecosystem. But for that total addressable market, that $2 trillion, it encompasses not just software and not just GPUs, but you also have the CPUs, the Ethernets, you know, the entire data center infrastructure. They believe that every infrastructure out there, the data centers are going to need to be revamped to be able to accommodate the processing for AI. And so that's why that number is so high and can go from $1 to $2 trillion. for here today, I think what would swing the stock is if we start to hear a number per year. So if it's, $500 billion per year for them, then that's going to be a big mover and also reinforce that trade that, hey, okay, AI is sustainable. It's not going to be just a blip in the, a short-term thing. Fixed costs are going to be high right now, and then it's going to diminish in the next 2 years. So that's something we need to hear from him today.
All right, Christina, thanks. Christina Partsinevelos. And do not miss Nvidia CEO Jensen Huang in a CNBC exclusive interview with Jim Cramer. That's tomorrow, 10:15 a.m. Eastern Time. Joe, you're noting that, we should watch the stock very closely considering the key reversal that it showed last week.
So on Friday, March 8th, you had that significant reversal from 974. The stock tumbled down to 874. Something somewhat similar this morning, 946, the stock was up at 924. It's now fallen back below 900, got down to a low of 878.37. The point is the importance of Nvidia on the market. So as Nvidia had that little bit of a rollover this morning, you saw the market pull back with it. Nvidia still is the center of the universe. As goes Nvidia, will go the market. And it's interesting because Jensen Huang probably has more impact on the market than Jay Powell does this week, if you think about it.
Oh.
Which is really a remarkable condition, but it also speaks towards that the market is able to overcome some of the friction and inflation and the treasury market because it sees the opportunity and the revenue growth in the AI story.
And the impact on tech, but semiconductors.
Yep.
I mean, since the launch of ChatGPT last year in early part of 2023, semiconductors have outperformed the S&P 500. I mean, it has ignited this trade here that the market has been so dependent on.
100%, and I think we've run out of adjectives or superlatives for Nvidia. When I think about data center growth, it's quadrupled year over year. And I'm interested to see what this comment. I mean, Christina went over a lot of potential discussion points for today, and I think, for me, it's continued partnerships, but the big question for me is what is the pull forward? How much have we pulled forward already in terms of growth? Are we going into 2026, right? Because we know what the price action has been over the last year and a half. But that'll be a question because we have seen boom bust cycles in the semiconductor space before. I don't think anyone would debate what's going on in the short term, but how much have we priced in? How much have we pulled forward?
Steve, you have a small position in Nvidia. What concerns you about the stock, if anything?
Well, the valuation, but I think they'll grow into it. In terms of what we saw today, the stock was up 35 points at one point, which is not tremendous when you consider what base it's operating off of. But there's a lot of expectation in this speech. To me, it's going to be more of the same. I'm not saying that in a bad way. It's going to be that NVIDIA is the leader, that NVIDIA has new products coming out, and that NVIDIA is going to raise prices. So I think everything's fine for now. I just wouldn't get excited about a 2-hour speech. Probably, if I were there, I'd probably fall asleep during it because I fall asleep during 2-hour movies. But here's what I'd say, that every large tech company, Microsoft, Apple, Meta, are very incentivized to build their own chips, and they will. And they'll do it through ASML, using their tools, and Taiwan Semi. So competition is coming. However, offsetting that is that you've got such exponential growth in AI. This is truly industrial revolution. So I think there'll be multiple winners, but I would not dip down away from the large cap companies because they've got the balance sheets to drive that growth.
Yeah, I mean, the ripple effects, Shannon, are immense. Wedbush had an interesting note out, I think it was today or Friday, saying that for every dollar spent on the H100 chip, there's $10 to $12 in enterprise spending on the back of that to support that chip. So it's not just the chips, it's the whole array of goods that Christina had sort of gone through, the Ethernet, the software, et cetera.
Well, I think the concern is, too, Melissa, if you think about when people are talking about valuation, what they're concerned about is this shorter-term overestimation of the impact and monetization of AI. But longer term, there's likely an underestimation in terms of not only revenue growth that can be derived directly from AI, but productivity enhancement and improvement. And so if you think about it from a longer-term perspective, what you're really hoping for from a market is that we are still cresting that first wave and we don't hit that inflection point where there starts to be perhaps disappointment in what's happening on the enablers from an AI perspective. And we start to see that monetization come through on those ripple effects. So that's really what the concern is, this shorter term concern that we don't see the pickup on the second wave. But longer term, there's a lot of analysts who are likely underestimating the longer term impacts and the fact that they might be able to actually offset some of these higher structural costs that we're likely to see over the next few years.
This is an open question for everyone. I'm thinking of this. Look, there's blue skies for the semiconductor industry. Clearly, it is the strongest industry in the economy right now. But at what point does the market potentially price in election risk for the semiconductor industry? Is there election risk surrounding the supply chain for semiconductors getting weaponized if, in fact, the election were to go a certain direction and we see an elevation in tensions surrounding tariffs?
Do you think that the markets don't see that potential risk even sitting here now, months and months and months before the election? Do you think that for some reason it gets worse once a new administration is elected?
It's a great question. It's clearly not priced in. Maybe if I could see it, everyone else can see the same thing and they're not concerned about it. But I just wonder if it's not a
what
real
sort of risks
dynamic.
are you worried about, Joe?
I'm
Joe,
sorry,
specifically,
Steve?
what sort of risks are you what sort of risks are you worried about specifically?
Well, does the supply chain get weaponized in response to an elevated environment where we start talking about tariffs and?
So maybe TSM gets cut off in terms of being a supplier?
No, TSM is a Taiwanese company. We're looking to support Taiwan. China is a net buyer of semiconductor chips. So if the weaponization to date has been limiting the technology that China could buy, I'm not worried about it at all. What may be a worry, but I don't think it should be, is cutting back on the funding that we've seen so far for building the chip plants in the U.S., because that was bipartisan, very clearly bipartisan. So I don't see any weaponization of that other than potentially being positive.
Shannon?
No, I would say I'm not as worried. I'm certainly not worried about what Steve and Steve. I don't think Steve's reasonably worried about that either in terms of the pulling back on chip security. I think fiscal spend on security in general and thinking about some of the political aspects of this. I think on Joe's point, I think more about just look at what we've seen from a supply shock perspective over the last few years. The impact of supply shocks in general, I think, is much more known and a reasonable concern for investors at this point. It's something that feels much more uncontrollable and, if you will, less able to forecast than changes on the demand side. So I think what we're seeing with shipping, I think that there could be some political concerns as it relates to chips. All of those are impacting cost. And I think from my perspective, if you look at supply shocks versus demand shocks, supply shocks just feel much harder to forecast in this next couple of years.
All right. Well, speaking of the AI trade, Goldman Sachs has a list of AI names that might not be on your radar. You can check out that story right now, CNBC Pro. Scan the QR code or go to cnbc.com/propick. Coming up, our calls of the day. We will hit the trades on Netflix, FedEx, Vertiv, and more. Halftime Report is back in 2.
Are you following the Halftime Report podcast? What are you waiting for? Look for us in your favorite podcasting app. Follow the Halftime Podcast now.
or download the app.
Welcome back. Let's hit our calls of the day, starting with Netflix. A Loop hiking its price target to $700 from $585, saying Netflix remains the streaming leader. Shares actually hitting a new 52-week high in today's session. Weiss, you own this one.
Yeah, look, I mean, they are the winner, just pure and simple. They've been at it the longest, and they'll continue to be the winner. It's a small position for me. I bought it on one of the days that the stock was dislocated. Obviously, wish I bought more because it's done well. But it's also not cheap, and there's only such a large multiple I'm willing to pay for anything.
Mm-hmm. Their strategy on sports, Jason's really interesting in terms of creating the sports events, not getting into the bidding wars, not doing it in a costly way.
Yep.
And that really, I mean, Weiss will probably fall asleep during it because it's more than an hour.
Right.
But that
it's because he's old.
Mike Tyson fight's going to be an interesting one.
No, I think Netflix has been an amazing winner here. I mean, to Weiss's point and credit, I think it has been the undisputed winner. You know, their foray into live sports is obviously a big deal. The WWE deal, you know, we'll see what happens with this Mike Tyson story, fight. I think that'll be fun. But clearly, paid sharing, margin expansion, I like this name. Continue to like it.
Next up is FedEx. Barclays reiterating its overweight rating ahead of earnings this Thursday. Shannon, you think it's all going to be all about execution at this point?
Well, I mean, I think a lot of emphasis has been placed, from 2020 to 2023 on shifting goods volumes and how much the post-pandemic world would really rely more on goods or services or that switch back. And I think if you look at the costs that FedEx needs to be concerned about, it's, increased shipping rates and obviously what they have to pay for jet fuel. And with the recent sort of tick up on the energy price side, certainly not anything overly concerning, particularly if they've hedged out appropriately at some of the lower prices. But I think on the execution side, whether it's FedEx or UPS, analysts are really looking for them to keep their costs under control, to have a better sense of the volumes that are coming in, and really look to be as ruthlessly cost efficient as possible. And that's where it really comes down to execution.
All right. Let's get to Darden Restaurants. Bank of America increasing its price target to $198 from $193. Darden also reports on Thursday. This is one of your stocks, Joe.
Stock is near an all-time high. This is not my favorite name. Obviously, in consumer discretionary for casual dining at quick serve, I would go to Chipotle as the favorite name. But you have to acknowledge Darden has traded remarkably well. It will report on Thursday. And I think what the street sees is that in 2024, they're going to have much better comps to work against. Store traffic down slightly in the prior month. That's priced in already. I think you're going to get a good report from Darden on Thursday, which will take the stock above the all-time high.
All right. And finally, let's get to Vertiv. That stock hitting a new all-time high. Bank of America boosting its target to 90. Weiss, you say you love this one. This is an interesting stock. It cools data centers?
Yeah. And Mel, it's getting kind of boring. You coming to me for winners in my portfolio, but I'll play along and talk about this one. Yeah, Vertiv has a unique product, somewhat unique. Others make it, of course, but they are the leader. Data centers run very hot, so you got to continue to cool the servers. They sell the cooling racks for the servers. And when, as I've said before in this show, AI searches take as much as 20 times the power of a simple Google search. AI data centers are multiple levels, 3 levels versus regular ones being 1 level. So the future for this company is very bright. It's growing earnings in the mid 20% level and EBITDA as well. So it's pretty attractive. It looks expensive on historical standards, but it is a new generation in terms of what they're able to sell their cooling racks for.
By the way, Steve, we're going to dedicate the back half of the show to your losers, so just get ready for them. Let's get to the headlines.
It's going to be a very short back portion.
I think we'll be able to fill 30 minutes. Let's get to the headlines with Kate Rooney. Kate.
So President Biden will sign an executive order today that expands research on women's health care.
Let's get to the headlines.
It's going to be a very short back portion.
I think we'll be able to fill 30 minutes. Let's get to the headlines with Kate Rooney. Kate.
So President Biden will sign an executive order today that expands research on women's health care and will announce more than 20 commitments by various federal agencies. The executive action follows $100 million in funding for women's health announced last month by the First Lady. And in Iceland, a volcano that erupted Saturday is still blowing out smoke and fountains of lava today. For now, authorities say a nearby town and energy facility remains safe. This is the volcano's fourth eruption since December. And a deal has been reached between the owners of Sports Illustrated and digital media company Minute Media that will keep the iconic magazine afloat just 2 months after mass layoffs were announced. In a statement, Minute Media, which is best known for the Players Tribune and Fansided, said it would take on all of Sports Illustrated's digital and print operations. Mel, back over to you.
Kate, thanks. Kate Rooney. Up next, back to tech in today's ETF Edge. The firm behind the Mag 7 ETF has 2 new ways to play the space. The details when halftime returns. We're back on the halftime report. Let's get to Dom Chu with today's ETF Edge. Hey, Dom.
Hey, so Melissa, as discussed earlier, it's a big week for the Mag 7 with Nvidia's big AI conference and reports of a possible Apple-Google AI partnership. But with the hype showing some fragility, could one misstep take down that whole Mag 7 group? Let's ask Dave Mazza, the Chief Strategy Officer over at Roundhill Investments. This firm just launched 2 more ways to actually play that Mag 7 space, depending on your view, with leveraged and inverse products around that Magnificent 7. Dave, Roundhill's original Mag 7 ETF, that ticker MAGS, M-A-G-S, is less than a year old with more than $150 million in assets under management. Now you're offering funds to either amplify the long exposure or short the group overall. So tell us a little bit more about why these products, what's the genesis, and what do you expect to accomplish for investors?
Yeah, no, thank you, Dom. Not a day goes by where the Magnificent 7 stocks aren't in the news. And investors have a view on them, whether that's positive or negative. And you're absolutely right. Since we've launched less than a year ago, our MAGS ETF, ticker MAGS, is up over 58%. But we wanted to offer investors and traders an opportunity to take that a step further. So for those looking for amplified upside, so 2 times the daily exposure of the Magnificent Seven stocks, there's actually MagX for them. So that's MAGX. And then those looking for inverse exposure, or actually to take a negative view on the space, there's MagQ. So again, these are tools for investors with MAGs, and then for traders to express both a positive and negative view on a space that is not being out of the news anytime soon.
Now, Dave, this is important for a lot of folks out there who are kind of new to these leveraged and inverse types ETFs. They need to know that these ETFs, the new ones, are daily return ETFs. They are not really some kind of a buy and hold strategy, right?
No, you're absolutely right. And thank you for emphasizing that point. So for someone looking to take a longer term view on the Magnificent Seven stocks, stick with MAGs. But for those who have the ability to monitor their positions on a daily basis and express views with greater conviction, that's what MagX is for, or even MagQ to take that negative view. So again, a tool for investors and then 2 new tools for traders to take that view.
And really quickly, Dave, before you go, are you seeing more traffic one way or the other, more towards the short side or long side these days?
Interesting enough, actually, even with some of the stumbles that we've seen in the Magnificent Seven group over the last couple of weeks, to date, actually more activity has been on that 2X side. So MagX, people may be looking to actually step in on the dip, take advantage of some short-term opportunities. And you're absolutely right. With Nvidia in the news again today, and actually the market's recovering a bit, maybe we can see some reasons behind that sentiment.
All right, Dave Mazza, thank you very much for the insights there on those new ETFs and much more on that Mag 7 trade and even the weight loss ETF craze coming up on ETFedge.com at 1 p.m. Eastern Time. Dave will be joined by Todd Rosenbluth, head of research over at Verify. Check out the online show 110 today. Melissa, I'll send things back over to you.
Thank you, Dom. Dom Chu coming up. Your energy playbook as oil hits fresh highs for the year. How the committee is playing this space. That's next.
Download the app.
Welcome back. We are watching the energy market. Crude hitting its highest level since November 6th, and energy is the best performing sector so far this month. Joe, you're overweight energy. You've got a lot of exposure through all different sorts of energy.
Yes, for sure. The JOTI ETF was carrying nearly 13% exposure to energy coming into the end of January. That exposure was reduced down to about 7%. That's still carrying it at an overweight positioning. Why? Because oil was in a position where it really needed to prove itself. And that, in fact, is what oil is doing. It's proving itself. It's breaking out above $80. It's carrying the XLE with it. The refiners are a remarkably hot trade right now. Look at Valero. Yeah. Valero's trading more on momentum than it is on fundamentals because the crack spreads on the underlying commodity really aren't representing the strength that you're seeing in Valero. But it's Valero, it's Marathon Petroleum, it's Phillips 66, all very strong right now, pointing towards higher prices. And I have to say, if you're going to do something in the market right now, the commodity trade is back. The commodity trade right now, you've got commodities that are coming off very low levels. The steel trade, whether it's Steel Dynamics or Nucor, that's working well. Materials are right now in a bull market, but the commodity trade, copper, precious metals, all working remarkably well.
Gold at records, copper on fire. Shannon, commodities actually your contrarian play coming into this year.
It was, absolutely. And, pleased to see the momentum, obviously. There are some parts of the commodities market that are a bit weaker, natural gas, ag commodities, for instance. But if you think about the opportunities within commodities, overall, a stronger economic outlook, but also, Melissa, perhaps some glimmers of hope for China, which could be sort of the tip of the spear for this trade as well.
Weiss, speaking of copper, you were in Freeport. You sold it, though. When did you sell it?
I did. And that should have given the market some optimism that copper was going to go up. Look, I sold it around $40 last week, so missed a nice move in it. Look, commodities are cyclical. If you take a look at long-term charts of any of these, including oil companies, and go back 10, 11 years, you'll find them in the exact same place. So these are always trades. And I'm playing Archer Daniels now, more for the accounting issues that I believe will be resolved than the commodity issues. But as I said on Friday, it gives me the bonuses that it gives me a free option on the commodity cycle, and that's exactly what's happening. So I'm going to stay with that one and let that be my commodity exposure.
Yeah, Jason, you're in energy through the way probably most of our viewers have exposure through the XLE.
Yeah. And I sold Chevron in January. I think that was mainly an execution story. But, again, oil is not always a proxy for the price action in the energy stocks, but it is now. I mean, you see oil drifting higher. You're seeing a lot of the oil companies continue to produce. So we like it. We like the energy trade. I mean, it's up 9% year to date and 6% this month.
All right. We will have much more on the energy trade on Last Call. Brian Sullivan is live in Houston at Sarah Week with big interviews tonight and tomorrow, 7 p.m. Eastern Time, right here on CNBC. Up next, Mike Santoli will join us with his midday word. Halftime, we'll be right back.
In the very definition of change is to be different. I've embraced what it means to be a different leader. And as a female in a predominantly male space, I've had to see that as the potential legacy that I get to leave, to change an industry and a culture. For Bobby, that meant doing so much more than powdered milk, to fundamentally change the face of what it means to be a parent in the US today.
Welcome back to the Halftime Report. Senior markets commentator Mike Santoli joins us now with his midday word. Kind of interesting market action today with the Nasdaq leading the gains.
A lot of back and forth. I think most of the market is kind of holding firm, waiting, obviously, for the big events this week. The S&P even isn't back up to where it was on Thursday. So there is this middle zone. And it feels like the process is ongoing. And it's happening in a kind of painless way for an index investor of just kind of digesting and cooling off a little bit. That momentum trade that seemed like it was so unstable really needed a gut check a week or two ago. It kind of has cooled off, and it hasn't really upended other things. So you're very lucky if it lasts this way. You do have yields still leaking higher, though. Right. And so the question is, how much can we kind of get that equilibrium holding for a while, I guess, through the Fed on Wednesday?
Yeah, that's actually session highs.
Yeah, that's the interesting dynamic. The 2-year, I think, is at the high for the year. 10 years close to it. Yeah. Market doesn't seem to care until it actually does care.
Yeah,
Are we
I think that's kind of what it is. I mean, everyone has their own threshold for this. You know, people are using 535 on the 10-year, 4.5 looks like it's a little more where the range has been. Yeah, I don't know. I don't know if does it care, or is it caring in isolated ways as opposed to across the board. The AI trade is not rate sensitive. It's not going to be. It's all about other energy. And I think the rest of the market arguably could be, if you thought it was going to slow the economy. I think what Powell, the suspense about Powell on Wednesday is like, okay, if they take rate cuts out of the forecast, that only really matters to you if you think that means they're making a big mistake and the economy's weakening a lot. And that might be the debate that's going to be coming.
When you say rate cuts out of the forecast, what do you mean by that?
If they go down to, let's say, the consensus feels like there'll be 2 cuts as opposed to 3 this year.
So on the dots, take one
exactly.
out.
If you just kind of remove one, who knows, though?
Yeah. But the higher rates are affecting something. That's the regional banks down once again.
Yeah, exactly.
So.
Yeah, I mean, New York Community Bank Corp is a disaster once again today. I'm curious, Mike, since you're the senior markets commentator, what's more important? Jensen Huang today at 1 p.m. Pacific time, or Jay Powell tomorrow, Wednesday?
I'm of the mind that there's a little more debate and a little more interpretation that's open with Powell. I think that, look, Nvidia's gone up. It's just levitated no matter what anybody says, no matter what anybody thinks, no matter what the street believes it's worth. And so I feel like we're a little more dependent on the broader economy and even the broader market on Powell.
All right. Mike, thank you. Good to see you. Mike Santoli. Coming up, the Tesla trade shares are rallying while one big firm slashes its price target on the stock. We'll debate the call next.
Sit.com.
We're back on the halftime report. Tesla rallying today. The company hiking prices on the Model Y. But Goldman out today, slashing its price target on the stock to 190 from 220. This follows a downgrade from UPS last week. A lot of people taking down their delivery numbers. And the question is, when you're hiking price, Joe, do you think it's coming from a position of strength or a position of weakness?
It's clearly coming from a position of weakness. And I think that Tesla has broken momentum. I think that's very clear. Obviously, we took a position in Tesla at the end of January. We'll address that at the end of April. But I will say this about Tesla. It is oversold. And the distance between current price and the 200-day moving average is very significant. I always cite that, as others do, in the reverse situation where you've got a bullish chart. Well, let's look bearishly. So the 200-day moving average is at 234 for Tesla, current price at 173. Tesla's a little bit oversold here.
Why is you short? How are you short? The old-fashioned way or through options? How?
No, I'm short the equity. Look, that 200-day moving average in 200 days is going to be at 100. This stock is grossly overvalued. They're not raising prices. We don't have proof of that. All we have is Musk with another tweet. Look, if you're a fiduciary, you should not own this stock. There's no other company that trades publicly that I'm aware of that has worse governance, with a CEO at odds with the shareholder and the board being his puppets. So I would not own on that alone. I've got GM at 4.5 times earnings, and I've got Tesla at 75 times earnings. With their markets collapsing, with the EV craze subsiding greatly, and with all the OEMs that came out with these products that are newer, better designed, and more attractive, selling them at a discount because they're not selling. So why would I own it? And by the way, with China being 20% of Tesla's sales and the Chinese government pushing domestic manufacturers over Tesla, there's nothing but a whole bunch of trouble here. So wake me up when they finally put the solar panels on the cars from the Solar City acquisition a few years ago.
By the way, XPeng announcing a cheaper model or cheaper EV in China, so that could be real competition for Tesla. Final trades are up next.
begins here.
Final trade time. Shannon.
We talked about it earlier, Melissa, but commodities. We think that China could become much more important later this year and is a colossal consumer of commodities.
Weiss, you awake? You're up.
Leidos. You haven't put me to sleep yet, Mel. Leidos. Skittish in front of a shutdown of the government, but it'll get through it. It's timing anyway.
Jason.
CrowdStrike, cybersecurity continues to grow.
Joe.
Thank you for being here.
Great to
An
be here.
industrial name, PACCAR.
All right, that
You're
does it for
welcome.
us. The exchange starts right now.
Thanks, Melissa. Welcome to The Exchange. I'm John Fort in for Kelly Evans, and here's what's ahead with the markets off the highs. Don't chase the crowd. Our market guest says we all know how that ends. He is betting on what he calls the most underrated methodology instead. He's going to be here to tell us what it is and the names to buy using it. Plus, shares of Alphabet higher on a report that Apple's looking to license Gemini AI. Is that a desperate move on Apple's part or just smart positioning? We will have the latest. And home builder sentiment just turned positive for the first time since last summer. We're going to talk to one player in residential and commercial real estate, ask if he's feeling the same sense of optimism. But we begin with today's markets and Dom Chu with those numbers. Dom?
Hey, John, it's a bounce back from the down day that we saw on Friday to kind of close out the week. And we are green across the board for the major indices. The Dow Industrial is up about 128 points, 1/3 of 1%. It's the underperformer today for the value blue chip index. 38,843 is the last trade there. The broader S&P 500 is currently just at 5155, up 38 points, 3/4 of 1% gain there. So very respectable. But to put that in context, at the highs of the session, we were up roughly 58 points, down 30 or up 37 at the lows. So again, a very positive session, but tilting towards the lower end of the trading range so far today. And the NASDAQ composite currently at 16,113. That's up about 140 points or maybe just about 3/4 of 1% upside there. So again, green and technology is leading the way. John mentioned some of that Apple and Alphabet dynamic because of that Bloomberg report about a possible partnership or licensing deal. That's got Alphabet as one of the top performing stocks in the S&P 500 and NASDAQ, up about 5%. Apple, meanwhile, up 1.5% as well. Nvidia very much in the news, part of that Mag 7 trade because of its big AI developer and kind of computer chip conference going on in Silicon Valley. It's down 3/4 of 1%. And then Tesla getting some love from analysts again, and because of a price target, or rather Model Y price hike over at Tesla. So those cars going up in price is helping, and Meta Platforms being aimed at top pick over at Mizuho, up 1.75%. That's the large cap, mega cap tech trade. And then just keep an eye on a couple of these stocks. It's Supermicro and it's Deckers. Both of these stocks are spending day one as members of the S&P 500. They both run up a lot going into this, but now Supermicro giving back about 10%, maybe a bit of a sell the news type situation there. Deckers Outdoors just about flat on the session. So keep an eye on those two stocks. John, I'll send things back over to you.
All right, two very different stocks, but something in common today. Dom, thank you. Our next guest says the market is pricing in unrealistic earnings growth at this point, that investors should stop chasing the crowd. Instead, he's looking to some dividend aristocrats to position in from here. Let's bring in David Bahnsen. He's Chief Investment Officer at the Bahnsen Group. David, good to see you. So I guess my worry would be if we're talking dividend growth, you miss out on a lot of young software names. Is that intentional?
It is for us. I mean, we really believe that cash flow is king, and we think that the dividend growers, through time and their avoidance of a lot of the bursted bubbles that happen with the alternative, end up doing far better. And we have tons of track record to prove that. But I think that ultimately, right now, people have actually gotten away with this recovery trade since the 2022 meltdown. There's been some names that have come back quite a bit. Now you see some of them. I mean, I think Tesla's down over 50%, and Apple is in double digits down. All the while, Nvidia is still just climbing vociferously. Those things don't tend to end well.
But at the same time, if you believe that this AI thing isn't just a flash in the pan, it's not the metaverse, it's not blockchain necessarily, that really it's going to change the way business happens, shouldn't you allocate some portion of your portfolio to names that you think have some sustainable advantage there?
Yeah, but I would recommend doing it at something that isn't trading at 50 times forward earnings, or assuming that margins will hold when revenue is up 10 times from what it is now. Margins don't hold with that kind of revenue growth. And so, for example, there's a dividend-growing name called Broadcom that we own. It's gotten expensive. We have a lower weighting, but we've owned it for years now. It's very exposed to AI. IBM is exposed to AI. Texas Instruments. These are dividend-growing names that have real cash flows that don't require you to buy into something that's up, 250% in the blink of an eye. That's what I'm concerned about, is the momentum chasing.
Outside of tech, you also like Amgen, Johnson & Johnson, and Medstream Energy, the ETF. Pick one of those for me and tell me why.
Well, I picked the Johnson & Johnson and Amgen because I wanted to be as boring as I could when we're talking about Nvidia. You talk about Johnson & Johnson growing a dividend for 65 years in a row. It doesn't get anyone excited. But the beta is less than half of that of the market. It may be time for us to get back into more low beta, very dependable cash flow growth. Amgen has grown the dividend double digits for over 10 years per year. I mean, that's massive internal growth. These biotech names have become great dividend growers. Midstream Energy is just absolutely a phenomenal high income, high growth of income story.
Do you think about international in this environment? I'm looking at some of these India ETFs, looking at the growth of the youth population, the big nationwide adoption of digital and payments technology, and wondering, it's had quite a run too, but the demographics don't seem to be slowing down.
Yeah, we view the international story as something that takes a real macro look, meaning is the best way to get international exposure companies that are based there or companies that are perhaps based in the U.S., U.S. accounting, U.S. governance, U.S. maturity and sophistication with capital markets, but nevertheless 50-60% of sales coming from these markets. So there's a very global story with a lot of U.S.-based companies. India is doing great locally, but you have to translate that to a bottom-up story. You can't go buy an ETF for Minnesota. You can't buy an ETF for Texas. But there are companies in Minnesota, companies in Texas. We view it the same way with international markets.
Okay. So back to your call here that you got to avoid investing strategies that simply buy the stocks that go up. Are you at all betting that stocks are going to go down? And is there a thought about what is going to be the catalyst that drives that moment for the markets?
Yeah, no, we're not betting anything. I don't want to bet against the market going higher because Nvidia could go up multiples from here.
Yeah.
I just know how it ends. I know how these trades end. We've seen it over and over again. I've tried to devote much of my adult life to studying bubbles that burst. And I really believe that good companies can get into a bubble. We own Cisco now. I bought it at about $18. It's in the 50s. Cisco is right now 30% lower than it was 25 years ago. And yet 25 years ago, it wasn't like its business deteriorated. It's done nothing but grow. It's improved every year, revenue, earnings. It's a great company. What's the problem? It was just too expensive. I'm a child of the late 90s. I grew up professionally managing money there. I see in Nvidia some of the same risks that played out there, John. That's the story for us.
All right. David Bahnsen, I appreciate you joining us here on the exchange. Let's talk energy now. Oil prices up about 1% with Brent crude hitting the $86 mark for the first time since November. And this comes as the S&P Global kicks off its annual CERAWeek Energy Conference. Let's head down now to Houston, Texas, where our Brian Sullivan is standing by there with Shell CEO Wael Sawan. Brian?
Yeah, John, thank you very much. And in fact, this is really the epicenter of energy in the world right now. And welcoming in Shell CEO Wael Sawan. Wael, thank you very much for joining us. I want to combine two things that we just talked about on CNBC. It's Nvidia. They've got this huge conference today as well. Jim Cramer is going to be sitting down with the CEO. And I bring Nvidia up because AI is everything. And all I ever hear is that AI is going to drive all this demand for electricity. We get most of our electricity from natural gas. You happen to produce and sell a lot of natural gas. Is there an AI discussion to be had around Shell, or am I just completely out of my mind?
No, I think there is definitely, Ryan, a big discussion to be had about just energy demand growth in general, whether that's crypto-related, AI-related, or the multiple other realities around just population growth in countries like China and beyond. And so around the world. So what you currently have is a significant pull on more and more electricity that's coming in, as well as energy in totality. Companies like Shell, as you rightly said, indeed are the biggest players in LNG, but we also have a lot of domestic gas production, which we also sell into the grid. I think we are going to have a bigger and bigger role, both in terms of supplying that energy, but of course also using a lot of the AI ourselves, given we still work on things like the subsurface in the Gulf of Mexico. Those are all great opportunities to be able to become much more productive in the way we work.
Yeah, because when I think about energy, and that's what we're talking about here is energy, okay? There's oil and gas, but we're talking about the need for this. And 10 years ago, it was all about the transition. Now we're talking about energy scarcity, energy security. Yes. We want to build all these data centers. We want to make sure people have light and heat in places like India and these other developing markets. When I look at your LNG, Shell's LNG forecast, you see 50% growth over the next 15 years. Where's that coming from?
Three key areas I'd point to. One is continued growth in LNG that is substituting out coal. That plays out in areas like India, areas like China and beyond. Secondly, you have a few countries, many countries actually, that have the infrastructure for gas because they depended on domestic gas production. With time, they no longer have those resources. So they're having to import LNG to be able to use the infrastructure to keep powers in the home. And then thirdly, it's energy security. The realities of what happened in Europe after the Russian invasion of Ukraine is that now we need to be able to bring LNG from afar. Those three key drivers are critical ingredients to be able to see that 50% bump up in LNG between now and 2040.
You're a global company. You, before this, as the CEO, you ran the LNG business in Qatar and worldwide in the Middle East. We just announced a pause in U.S. LNG exports. Now, we're still planning to double those exports with the projects that are currently underway. From Shell's perch, is that going to hurt the U.S.'s competitiveness in supplying the world with LNG?
I think in the short to medium term, there isn't a specific issue to be worried about. Longer term, there might be, depending on where the pause goes.
These are 20-year projects.
These are 20-year projects, exactly. So it's not a short, medium-term issue. My bigger concern, however, is that LNG from the US and LNG from Qatar, those are the two biggest sources of LNG. Anything that undermines confidence in those supplies will always create some nervousness in the markets. And therefore, what I worry more about is the softer elements of the pause to a market that I think needs confidence and comfort into the long term and not just in the short and medium term. And so we hope that this gets resolved over the coming months into giving the sort of clarity that I think the market will very much value.
You know, it's funny, people that don't come to this conference, they see, okay, oil and gas, and now there's a lot of renewables. We're interviewing NextEra for tonight as well. They don't realize that the climate and climate change is a huge topic of discussion here. People think, oh, you're just ignoring it. No, it's a massive topic. I read a headline in CNBC, you might have heard of CNBC, that Shell had just recently watered down your climate goals, going from 15 to 20% from a hard 20. Have you watered them down?
No, we haven't. So I think we have been very clear we are committed to the 2050 target of net zero. What we have said is in 2030, we have a package of targets and ambitions that allow us to be able to both monitor the pace of our progress and allow our shareholders to know what we're doing. What we have done on the net carbon intensity, the one where we have moved from 20 to 15 to 20%, is we have said strategically we are shifting from selling power to homes, an area we have tried to do but haven't been successful in, and we've sold out of, in particular in Europe. So we are reducing the growth in the power sales we had anticipated, which is why we are part course correcting. We also, by the way, added a new ambition, an ambition to reduce the emissions from our oil product sales over the next 6 years by 2030.
So you're still committed net zero 2050?
Very much so, with interim targets to allow us to get there, but we're going to do it in a way that focuses on the areas where we have competitive strengths, and we're going to make sure that we are focused and not betting too many different plays, focused on the 4 or 5 where we think we have a differentiated ability.
I had the pleasure of going on your huge hydrogen facility in Rotterdam, the Netherlands, which is just unbelievable, by the way. Hydrogen is a huge, not only is it a big topic, Wael, it's also a little bit of a controversial topic. A lot of people say it'll never be economic, it'll never work. Other people say it's the future, right? We've got the Inflation Reduction Act. I'm not going to ask you to dive into U.S. politics. What is the role of hydrogen in the United States? Is there a role of hydrogen in the United States?
I think, firstly, there's a massive footprint already of hydrogen today in the US, albeit gray hydrogen, and that will over time need to get decarbonized into either what we call blue hydrogen or green hydrogen, let's say cleaner hydrogen. So that role is going to continue to be there. I think there's a lot of views that try to polarize the discussion between is there or isn't there a role. The reality is the role will grow. Over time, the more we have green power, the more we have solar and renewables, wind as well, the more you're going to have access to available electrons, which one day can feed into an electrolyzer that produces the hydrogen. So I don't think it's a question of is hydrogen going to play a role? The question is when will clean hydrogen start to become material? I think the answer is more 2030s, if not 2040s.
2030s, if not 2040s, but it's being invested in, I know, billions by you guys as well. I saw it with my own two eyes. Wael Sawan, CEO of Shell, I really appreciate it.
Thank you very much. Thanks for having
me.
me.
Have a successful conference. Guys, by the way, John, we're not done here. Tonight we've got NextEra, we're talking renewables, got Senator Joe Manchin, we'll talk about energy policy as that. We've also got Ryan Lance of ConocoPhillips, Mike Wirth. We got a big lineup later on today. Tonight live on Last Call, as well as tomorrow. And John, did you like how I did that? I wove in Nvidia. We're contractually obligated to say Nvidia in every segment now, I think. So I got that in.
It was like crochet. You were weaving in Nvidia and environment and all kinds of things. And that's not all, Brian. Thank you. You're going to be back tomorrow with the CEO of SLB, the company formerly known as Schlumberger, live from right there at CERAWeek. That's going to be 1 p.m. Eastern, right here on the exchange. And for now, coming up, Google might be the king of digital ads, but one analyst says Meta is coming for the throne. Those shares are up nearly 40% so far this year, but he's going to tell us why he still sees Meta climbing another 25% from here. Plus, homebuilder sentiment turning positive for the first time in nearly a year, but affordability remains a headwind. Later on, we're going to get a C-suite view from one real estate developer. The exchange is back after this.
This is The Exchange on CNBC.
Welcome back to the exchange. Shares of Apple and Alphabet both higher today on a report that Apple's in talks to put Google's Gemini AI system into iPhones. Deirdre Bosa joining us now for today's Tech Check. Dee, some people out there are framing this as a sign of Apple's weakness, that they don't have their own AI ready to play. But if Apple can make hundreds of millions or billions of dollars off of Google, just placing them here, I don't see the downside.
Well, I wonder, John, do you think that's enough, hundreds of billions of dollars, when we're talking trillions here, when we've seen the rise of Nvidia? I guess it sounds like a lot, but I've also heard some people say that if you're not actually leading the way in developing your own AI, you're kind of just calling it in. And is that going to be enough in the next platform shift? I think that we got so few details. We don't exactly know how this is going to roll out. Maybe Apple is leaning on Google's Gemini while it gets its own large language model, Ajax, up and ready and able to handle a lot of that. So we don't know, but I agree with you. I think a lot of folks here, especially in San Francisco, don't think that Apple's just going to sit this out.
I mean, we've seen this before. Apple at first used Google for Maps and then did Apple Maps and really built that out in a pretty impressive way, to the point where now the features are pretty competitive. If they do build Gemini into the iPhone, Apple still gets a lot of data on exactly how people are using it, what kinds of queries they're putting through. It could help them build their own while they're getting paid by Google, could it not?
Exactly. And I think that's what I'm hearing as well, is that maybe this is sort of a temporary solution. Jim Cramer this morning pointed out on the Best Buy earnings call how they said that the Samsung Galaxy AI-enabled phone, the demand was materially more than they expected. So it is potentially that Apple is looking at that and saying, we need a solution right now. But Apple's never the first mover, right? It tends to perfect its technology, its products, and come out there. So maybe this is going to follow the same thing. However, you know, we have a lot coming up in the next few months. I know you're watching closely, John. I showed this chart earlier on in the day, but it was basically Apple versus Microsoft versus Google over the last month. And you can see how quickly the perceived winners and losers in this AI race in the market are changing spots with each other. With Alphabet's huge move today, it was up 7% at one point. It surpassed Microsoft in terms of performance over the last month. When you look at what is coming up over the next few months, you've got Microsoft Build, you've got Google I/O, you've got Apple's WWDC. There's a lot of catalysts that could once again sort of change all the calculus in this race.
Yes, and perception not always equaling reality. Deirdre, thank you.
Yeah.
Let's pivot now from AI to ads when it comes to the digital advertising space. Our next guest says Meta has got the edge over Alphabet. He raised his price target on Meta by $73 today because of that. For more here, let's bring in Ken Gorowski. He is the equity analyst and managing director at Wells Fargo Securities. Ken, does this possible Apple deal change the calculus on Google and possibilities for AI revenue for you?
Yeah, thanks so much for having me. So we don't think it changes our overall outlook in terms of the preference for Meta versus Google and on the advertising side. But I would definitely say that this is a sentiment positive for Google, where I would say post the Gemini release, the sentiment became pretty weak here. But I don't think there's any question that Google has leading AI technology, and they've attracted and retained some of the best engineers in the world. But we see on the ad side real potential for Meta to continue to outperform Google.
What's the driver for Meta now? There was a period a couple years back with iOS's tracking changes and with kind of the resulting crumbling of the direct-to-consumer flywheel around customer acquisition, where it looked to some people like Meta was in trouble. So what's driving their progress now that the methodology for so many companies and how they use Meta's, Facebook's, Instagram's ads has changed?
Yeah, you're absolutely right. There was a period of time there in 2021 and 22 where signal was degraded overall in the ad ecosystem, and Google was actually a net beneficiary at that time relative to Meta. What we've seen over the last couple of years, and this really manifests itself in the back half of 23, and we think in continuing into 24, is where Meta has rebuilt its signal. So it's the best in terms of its ability to target users and to drive conversions and continue to capitalize on these massive audiences they have there. So they've done a tremendous job there. And then I would say second here, and maybe this is underappreciated, is that the engagement gains. So during 21 and 22, we were a period where TikTok was gaining engagement and was gaining share of engagement and was a real driver of social user base engagement and advertising, and those share gains have stopped. Meta has fought back with its Reels short video product, and the interesting thing is this has become a real content. I think it's Meta is less of a social network and more of a content recommendation engine at this point.
Here's my question, though, about the longer-term call on Meta. If you do get Apple building Gemini into the iPhone, if you do get Google through Android becoming one of the main conduits for AI-based search and thus AI-based signal on what people are interested in, does Meta, with Llama and with its existing platforms, but without a mobile device, have enough advantage to keep Google from then accelerating past it?
Sure, great question. So I would say Meta has 4 platforms with more than 1 billion users, right? And that includes 2 messaging platforms that have relatively limited monetization at this point and a ton of signal, right? So I think there's nobody that is better positioned than Meta in terms from data, user behavior. And we know that Meta is building its own solutions and has recently released some Meta AI bots that are garnering certainly some early interest.
Is the metaverse spend ever going to come back as an issue, or has Meta's core business performance been so strong that investors can just forget about that and not worry about it?
Yeah, so I think you're correct in the assessment that the core business performance has been really impressive, and not only from a cost and a margin efficiency, but also from a revenue performance. In terms of the overall costs and the operating losses at the Reality Labs division, we expect them to peak in 24, although we don't see a meaningful decrease. We do think that they will continue to push along this effort. If you saw Mark Zuckerberg's interview post the recent Apple release, he seemed to be in a fighting mood to me.
He did indeed. He fights both literally and metaphorically. Good to talk to you for all that perspective. Ken, thank you. Ken Gorelski.
Thank you.
Still ahead, we're going to go live to NVIDIA's developer conference with a look at the next generation of its AI technology, whether its record demand can continue. The exchange is back after this.
Welcome back to The Exchange, everybody. I'm Tyler Matheson with your news update at this hour. President Biden spoke with Israeli Prime Minister Benjamin Netanyahu earlier today to discuss the developments in the conflict between Israel and Hamas. According to the White House, it included efforts to ramp up humanitarian assistance to Gaza. As a report suggested, almost half of Gaza's 2.2 million residents faced catastrophic levels now of hunger. The call was their first conversation in more than a month. Newly reminted as Russia's president, Vladimir Putin warned NATO that if it intervened in the war against Ukraine, it would mean nuclear war, and that only he could determine peace in Ukraine. Putin's threats come in a post-election speech after he won a virtually guaranteed vote over the weekend, with about 90% of those votes in favor of him. The Environmental Protection Agency today announced a comprehensive ban on the carcinogen asbestos, which is still used in brake pads and chlorine bleach and kills thousands of Americans annually. The ban is a major expansion of EPA's regulations under a 2016 law that tightened regulation of thousands of toxic chemicals found in everyday products. John, back to you.
Tyler, thank you. Now coming up, can office to housing conversion solve the affordability crisis? We're going to look at the numbers and talk to a developer leading the largest conversion project in the country next. Welcome back to The Exchange. The Spider Home Builder ETF, ticker XHB, about flat, slightly positive today, despite sentiment increasing to an 8-month high. Diana Olick joins me now to look into the data. Diana.
Well, John, home builders are calling demand brisk in March, and that's why builder sentiment rose to the highest level since last July, finally crossing back into positive territory at 51 on the National Association of Home Builders Index. That is the fourth consecutive monthly gain, and 50, of course, is a line between positive and negative. Now, of the index's three components, current sales conditions rose 4 points to 56, sales expectations in the next 6 months rose 2 points to 62, and buyer traffic increased 2 points to 34. Regionally, on a 3-month moving average, sentiment rose most in the Midwest and West. Now, the report also said fewer builders are resorting to price cuts in order to boost sales. In March, 24% of builders reported cutting home prices. That's down from 36% in December and the lowest share since July. But the average price cut remains around the same at about 6%. They are, however, still using sales incentives like buying down mortgage rates. And while builders are feeling better about demand, they continue to cite supply-side challenges, including a lack of buildable lots and labor, as well as new building codes that increase builder costs. Material prices are also rising again due to more demand, especially lumber. John?
And Diana, that's why I wonder how sustainable are those incentives, given that it looks like we're going to have higher rates for longer, so the relief's not going to come from that side, and the costs don't seem to be going down much from here.
You know, it's shrinking margins for the home builders, definitely. And we actually spoke to the chairman of Lennar recently about this. But he said you have to buy down the mortgage rates. You have to do the incentives because he believes that the demand is there. And as long as you can get them in the door at an affordable price, at least an affordable payment, then they will buy. And he thinks demand is just going to increase as we get into the summer months as well. So again, it's a question of affordability and what the builders can handle, how much they can cut off their own earnings in order to cut down, you know, whether it's prices or the incentives, and specifically buying down the mortgage rates.
Yeah, I guess the best operators will be okay. Diana, thanks. Let's stick with housing, but drill down on the multifamily space now. My next guest is a developer who says that supply-demand mismatch has created what some are calling the forever renter. Older, more affluent, looking for quality. Joining me now is Michael Pastranac, the CEO of Post Brothers. And Michael, you got the biggest office to residential conversion in the country going on right now in DC area, I believe, yes. Right? The risk, it seems to me, in those projects would be just, do you end up with an apartment that's too small or that feels like an office? Is the conversion price too high because of labor? Have those things come into balance now in this market?
All great questions, and thank you for having me. So, in general, the best conversion opportunities are really not about the existing structure. They're really about the land. Housing prices have, for both for rent and for sale, have gotten very high because of a lack of developable land in the areas where people want to live the most. So the most interesting part of this office conversion opportunity set is not really the structure itself, it's the land value and the ability to get land in these otherwise undevelopable locations. So if you're able to buy the building favorably, which generally is a significant discount to the previous office owner's basis, probably call it roughly a third of what their cost was, then you're able to invest enough in the building to overcome all those challenges you talk about by putting a new skin on the building, by doing ideal layouts, by not being married to existing systems like plumbing or HVAC. You can really start anew. So we've done, coincidentally enough, when we started 18 years ago, office conversions were really our focus. And then over time, we shifted more to new construction. Now office conversions are back. We've done over 3,000 apartments from converted structures. And you wouldn't, if you're in those apartments, you wouldn't say that they're less good in any way than purpose-built.
So when you get them at the right cost basis, you can do some pretty dramatic changes and still make money. So are you licking your chops right now with all of the trouble in office because of, post-pandemic people not coming back to the office? Because I hear that it's not in the newer construction, it's in those older buildings. I'm not sure those are in the locations where you want to build housing, or are they?
They are. If you look at, cities are all different. We've been doing a lot in Washington, D.C. We're in the heart of core Northwest Washington, in the Calorama neighborhood, in the Golden Triangle neighborhood. Here in Manhattan, there's opportunities certainly in very high demand areas. So it is the older buildings, like you say, but for cities that have been built out for 40 plus years, they're in great locations. The opportunities are not as interesting, frankly, in newer cities like Sunbelt areas.
Okay, so in those older cities, are you seeing capitulation yet with, the previous owners willing to say, okay, go ahead, take it off my hands at a third of the price I paid? Or are there still holdouts who are saying, we think that maybe somehow we can make this work?
It's very slow going. I think us and the rest of the industry would have expected to see more transactions by now. There was just a report released by MSCI, which is a big data service. I think it was reported in the Wall Street Journal that only 3.5% of the office transactions last year in the U.S. or distressed sales.
Why is that? Why haven't they buckled?
Well, I think that a few things are going on. One, it's really driven by the lenders. If an office building is not performing, the lender is really in control. The lender doesn't really want to foreclose. They're not really in the business of owning real estate. So they're doing what in the industry is called extending and pretending. They're just giving more term to the borrowers. The other part of it is I think that data doesn't capture all the transfers that are really going on. When a borrower or sponsor of a building has fully capitulated and written down their equity to zero, they've effectively handed the keys to the lender, but it hasn't traded yet. So I think because the lender isn't ready to take the discount. So I think there's a fair amount of that going on. So it's taking a little longer.
Right. It's like when you got a stock that's way underwater. You only lose money really when you sell it.
Exactly.
So you try to avoid that for as long as possible. Quickly, is there a triggering moment that you think is going to cause some of these lenders to have to sell what's in their portfolio? Would it take a downturn in the economy overall, perhaps in employment?
Great question. I think what's more likely to happen is an upturn and the lender is seeing an opportunity set. The capital markets are relatively slow moving right now. All of these lenders and non-bank financial institutions, they're in the business of lending money and they want to be doing business. And I think when they see the opportunity set to lend more, that's actually going to motivate them to get these old loans off their books because then they can replace it with more interesting opportunities.
Okay. We'll see if that happens. I know you're waiting in the wings, Michael Pistronic.
Thank you so much.
Coming up, it's been a volatile month for Nvidia. Those shares are still up by more than 12%. Up next, we're going to head out to the GTC Conference, loosely dubbed the Woodstock of AI, maybe the Eras Tour of AI as well. For the highlights so far and the big announcements to come, we'll be right back.
to learn more.
Welcome back to the exchange. Shares of Nvidia fractionally higher today, pairing earlier gains as its AI conference gets set to start in California. I guess it's already started in a way. Christina Partsinevelos is there. Joins me now ahead of CEO Jensen Huang's keynote later this afternoon in overtime. Christina.
A 2-hour keynote, and it's finally getting busy. People are lining up on both sides. We already have some protesters, a marching band. But what we know from this is just that there's been such a run-up in the stock, and we saw volatility, like you mentioned, in the share price. Last week, 4 out of the 5 trading sessions, the stock was down. But today, and it was up by earlier, above 2%. But investors have so much riding in this and so much expectation, specifically more so with Nvidia's new GPU chip, the B100, which could be at least 2 times the performance of its previous H100 chip. Nvidia tends to not disclose pricing, but I've seen estimates anywhere between $40,000 to $50,000 for this chip. So that means it'll be more expensive, which could help margins, but also hurt demand. Other themes for today. We're going to want to hear about other product launches from CPUs to software. We're also going to want to hear about demand that goes beyond hyperscalers to include government, sovereign wealth funds. Jensen Huang has previously talked about finance, healthcare, all of these other sectors. And then lastly, collaborations with other companies. For example, Oracle. Oracle did allude to a certain collaboration, which is why you're seeing the share price up today ahead of the event. Micron, another beneficiary, since they make high-powered memory chips. Even if they aren't NVIDIA's primary chip provider for those memory chips, just a shout out on stage could be enough to help the stock, especially ahead of its earnings that are out on Wednesday. You can see the share price is up ever so slightly above 0.5%. And then you have AMD's MI300 AI chip, which could see some threat once we get details on NVIDIA's new B100 chip on stage. NVIDIA is also likely to emphasize its Ethernet switches and their capabilities, which would mean headline risk for a company like Arista Networks. So could see some volatility there. And then lastly, there's some rumors of maybe Intel getting an NVIDIA foundry deal. No matter how small that deal is, it could bode some confidence into Intel's foundry business. And we know on Wednesday, Biden, I confirmed that, will be at Intel to provide CHIPS Act funding as well. So there's a lot of other players that could move on this big event behind me. Bottom line, though, today is going to be about NVIDIA's demand sustainability and the transition to AI, since it's only in the, quote, early innings, according to Jensen Huang.
Yeah, Christina, there's a term that AI investors need to be thinking about more and more, and that is inferencing, getting beyond the training of these models, these artificial intelligence models, to what actually happens once people start using them. And Jensen's been making the case that in the inferencing era, they're going to continue to get a significant amount of business, and there's going to be a lot more usage than there is training, right?
Right, because the last earnings report, we actually were surprised by the inferencing demand. It was about 40% of total data center revenue, which was a lot higher than anybody anticipated. The concern was that companies were going to shift away from NVIDIA when they were using the chips for training and then go elsewhere for inferencing. So that 40% number bodes quite well for that sustainability of demand. Does not bode well necessarily for AMD, because AMD is seen as the likely competitor in the inferencing stage. Also, a lot of these in-house chips too, from Amazon, Google, Meta, they're going to be big competitors in the near term. But I can assure you that will be a topic that Jensen Huang will be speaking about on stage. And that's going to add to that theme that, hey, you know, even if you spend a lot of money on those training your large language models, inferencing's next, and we're going to be at the forefront for that. So that's what we're expecting here, just based off of the last earnings report. Yeah, even this Apple-Google story today plays into that, especially if the AI calculation is done on device. Of course, Apple's devices don't use NVIDIA chips anymore. They use Apple's own. So we'll see how that plays out. Christina, thanks. Speaking of NVIDIA, Jim Cramer is going to speak exclusively with NVIDIA CEO Jensen Huang tomorrow morning, 10 a.m. Eastern, on Squawk on the Street. And by the way, if you missed NVIDIA's big rally but still want to buy some AI beneficiaries, well, CNBC Pro crunched the numbers, found a dozen alternatives that some say are expected to see huge earnings growth going forward. One of those names is Seagate, but for the full list, you can scan the QR code right there on the screen. Go into cnbc.com/ProPick. Coming up, there's one expense more correlated to insurance demand than anything else, says the CEO of John Hancock. The bad news, that expense is going up. What it is and the other trends he's seeing next. The Exchange will be right back.
Welcome back to the exchange. The FOMC meeting starts tomorrow, and rates are widely expected to hold steady this time around, with the market seeing the first cut coming maybe in June. Joining me now to discuss what this means for his business is Brooks Tingle, CEO of John Hancock, part of Canada's Manulife Financial and one of the largest life insurers here in the U.S. Now, longevity insurance, life insurance, what's the difference? Is that just a better way of saying it, so we think about living longer instead of thinking of dying?
Well, thanks, John. Yeah, I mean, for the longest time, our industry, like hundreds of years, would issue coverage on people and say, geez, John, I sure hope you live a long, healthy life. Because that's a good thing for us, actually, right?
Yeah.
Good for you, too, presumably. For those that don't know, we make money in a really simple way. You pay us premiums, we invest those premiums. The longer we get to do that, the more money we make. And it occurred to us that it's profoundly odd that we never tried to help our customers live a longer, healthier life. So several years ago, we introduced a new program called John Hancock Vitality, and we actively partner with our customers now, providing them with education tools and, interestingly, incentives and rewards, discounts and goodies and things, for taking steps to live a longer, healthier life, basically promoting their own longevity.
Okay, what's the impact of a higher rate environment then on your business?
Well, generally speaking, higher rates are good for the insurance industry. We lived through a very long period of time. I can remember post-financial crisis, we would sit around in meetings and say, now when interest rates go back up, we're going to do X, Y, and Z. After 2 or 3 years of that, we stopped having meetings where we talked about what are we going to do when interest rates go back up. So we don't spend a lot of time now thinking about what we're going to do when they come back down. But it looks as though things are going to be fairly uneventful this week, I think, with the Fed, with perhaps some action heating up in June and beyond. It does seem clear, I think, that certainly somewhat higher rates are here to stay for a bit, even if they tick down some. And as I said, that's generally a positive for our industry.
Now, what is the relationship between gas prices and insurance?
This was quite fascinating. A couple interesting things happened during COVID. I mean, I'm always looking for the silver lining. COVID was an awful time in our history and for many of us personally. But it did spur a lot of demand for life insurance. Go figure. People, global pandemic, things can happen. What happens if something happened to me and I did not have the protection of life insurance? So we saw demand really shoot up during COVID for life insurance. But interestingly, when inflation started to really tick up, we started noticing that applications for life insurance below a certain size dropped quite quickly. And I had somebody on the team plot the retail price of gas at the pump with life insurance applications below, say, $500,000 death benefit amounts. And you'll never see, John, a chart more perfectly correlated. And it kind of makes sense, right? If, middle America, you sit there and say, geez, I need life insurance. I want life insurance. But if it costs, 30% more at the grocery store or 40% more at the pump, you're going to say it becomes a nice to have rather than have to have.
Got to get this question to you before we have to close, and that's about artificial intelligence. It seems to me like the insurance industry is a prime candidate to do well if they can harness this correctly, no?
100%, and serve our customers better, too. Like I was talking about us playing this unique role in our customers' lives where we try to help them live a longer, healthier life, and we're doing that both in the U.S. with John Hancock and our parent company, Manulife, globally. And you think about what AI could do there as it relates to interventions is a strong term, but if we notice something going on with a client, less physically active than they were, perhaps digital nudges and things like that, and using AI to say, geez, we should prompt Brooks to do X. We spent a lot of time and energy doing what we call underwriting people. Somebody applies for insurance, we look at their history, medical history and otherwise, and decide what rate is appropriate. You could imagine AI playing an important role in improving the efficiency there. So quite excited. We're being cautious, as many are, and prudent, and want to do it in a way that serves our customers well, but enormous opportunity.
Yeah, I like the idea of having those prompts that are good for everybody. A lot of times we think about insurance companies wanting to know a little bit too much, but if you can make some correlations that actually help everybody out, that's better. Brooks, thank you.
Great.
For coming in. Great to have you here on the Exchange. And that's going to do it for the Exchange. I'll see you back here at 4 p.m. for overtime, but Power Lunch starts after this quick break.
Cologuard.
Welcome to Power Lunch, everybody. Alongside Courtney Reagan, I'm Tyler Mathisen. Glad you could join us. The markets this week waiting to hear from two big names. One, Nvidia CEO Jensen Huang, and two, Fed Chair Jay Powell. Which one has greater market-moving potential?
Plus, March Madness officially kicking off this week, and the game has changed dramatically. Now players are allowed to make money, which cleared the way for EA Sports to bring back an old favorite and pay players for their names and likenesses. We will get to that, but first let's do check on the market. Stocks bouncing back strongly today after consecutive down weeks. 2 straight losing weeks, in fact, hadn't happened since October. You can see the Nasdaq is leading the way higher by about 1%. The S&P 500 not too far behind, and Dow Jones Industrial Average up, but just 0.3%. AI optimism boosting tech stocks, and not just Nvidia, which we've already mentioned. Google and Apple may be working together. Those reports both helping those two stocks as well.
And now to the two big events that markets will watch this week. First up, Jensen Huang, Nvidia CEO, delivering the keynote at the company's GTC Conference. That is today, 4 p.m. Eastern. And everyone wants to know what he's going to say about demand for AI chips and what they've got in the pipeline. Coming up on Wednesday, Fed Chair Jay Powell, we'll hear from him, 2:30 Eastern Time, following the Fed decision on interest rates. What will he say about the timing of rate cuts and the tone and tenor of the economy right now? And which of these has the greater potential to move the markets? For that, let's bring in Mike Santoli. What do you say, Mike? I mean, I suppose this is one of those low suspense moments for the Fed. No one thinks they're going to do much, but what they say could be important. Maybe there's a little more suspense in what Jensen Huang might say.
You know, I think there's suspense in some of the details of what Jensen Huang might say, but I'm actually going to go with Powell on this, mostly because we're pretty sure Jensen Huang is going to reaffirm the huge vision for the future and NVIDIA's role in it, in AI, in the next stages of it, and multiple years' worth of demand. The other piece of it is NVIDIA stock does its own thing, even in the absence of fresh news. So if the stock, for some reason, were to go down off of what Huang says tonight or today, it could just be that it was a sell in the news event and the market needed to correct a little bit. In other words, what he says is for the long term, not the short term. When it comes to Powell, I think there's a lot of room for interpretation. How tolerant is he going to sound about this little uptick in inflation? How might he view the recent rise in longer term Treasury yields? Is the economy really in good enough shape to withstand all of those things? Are they going to take away one projected rate cut or something like that? So I do think that as the real economy and people try to sort through what the rest of this year might be, I think Powell might have a lot more to say, even though we don't think they're going to do anything at the Fed.
Is there a case, if I accept your premise there, that Powell may be the more important speaker this week, and I don't want to dispute that, is there a case that may be taking root a little bit that there might be no interest rate cuts this year, that rate cuts may go off the table if there continued to be these little wobbles in the inflation numbers?
I do think you have heard some folks say that basically things are not tracking in a direction that would necessitate rate cuts. I do think, though, that the Fed itself will be very slow to get to that point, just because their broad framework says they're very restrictive with rates above 5%, even if inflation stays where it is. They may have something more to say about what the ultimate neutral rate is. Maybe it's higher than they thought before. That would indicate less room to cut. But I do think that they'll probably move in increments and probably also hope to get lucky in the next couple of months on the inflation data so that maybe it looks like a summertime cut is going to be more time.
All right, Mike Santoli, thanks very much. For more on the big week for the markets and what matters the most for your money, let's bring in Richard Bernstein, CEO and CIO of Richard Bernstein Advisors, LLC. Rich, good to have you. I assume you just heard my question to Mike and his answer to it. What do you think there? Is there a case, maybe it's a low probability case, that the Fed might not cut interest rates this year and just let things sit where they are?
Oh, well, Tyler, good afternoon. First, I would say I think the probability is much higher than people think, or even higher than the Fed thinks, that they will not lower rates this year. The economy is healthy. The monthly inflation numbers, the CPI troughed like last June or July. If you look at that, they've actually been accelerating since then. Financial conditions are easy. They're not easing, they're easing. We see that in things like credit spreads. So one would say that the Fed should ease in a situation where the economy is suffering, where there is too much tightness in the financial markets, that liquidity is drying up, that lending is drying up. None of the above is happening. So rather, if you look at things like copper, if you look at things like lumber, you'll find that it looks like the economy is actually getting stronger. So I would argue the Fed's not cutting this year.
Okay, so that you answered my question. You said, number one, that the likelihood that they don't cut is much higher than people are acknowledging at this point. But there you just seem to say that your base case now is that the Fed won't cut rates this year. Am I right?
Well, I think for me personally, I think I think as the year progresses, and if they're not lowering rates, I think it'll be more difficult to lower rates in front of the election. I know the Fed is not a political entity, but they don't want to be viewed as a political entity either. So I think given the tenacity of this election, shall we say, that we have to be a little careful about what happens as we lead into the election, and the credibility of the central bank might be at stake in that case. So I think it gets harder. So, I would argue that if they're going to lower rates and they don't do it soon, it's probably not happening this year.
This is all very fascinating. And I tend to sort of be more in your camp, Richard. I feel like with every economic data point that comes out. And so if we use your base case as our scenario, how would you suggest investing in the markets when we've got the 10-year above 4.3 right now? What would you do? What would you advise your clients in an election year, in a time where rates are still quite elevated?
Yeah. So, Courtney, we've been trying to invest in the parts of the market, and our portfolios are very heavily weighted in the parts of the market that are causing rates to go up. Right. So I mentioned like copper prices are going up, lumber prices are going up. We're very much and even oil has started to go up as well. So we are overweight energy. We are overweight industrials. We are overweight material stocks. We're overweight small caps. We're overweight emerging markets. My argument would be that if the global economy is stronger than people think, you want to invest in stocks that are going to benefit from that unanticipated strength.
What about the Magnificent Seven, as we spend so much time today talking about Nvidia?
Well, I would say what's unanticipated about the Magnificent Seven. I think it's going to be pretty hard to find something that people are not anticipating for the Magnificent Seven, and I think that's pretty well known. But I think the Magnificent Seven, and there's clearly a speculative side to the Magnificent Seven. We could argue how much. We could argue, are they in a bubble? But there's clearly a speculative side to what's going on, right? Are there really only 7 growth stories in the entire global equity market? Of course not. There's many more, but the fact that we have a name for 7 of them shows how speculative the environment has gotten. And so I think that if the Fed can't provide more liquidity, which I think is what people are banking on, that argues that speculation is more likely to subside than to grow. People, I think, want the Fed to ease as quickly as possible because Wall Street, we're liquidity junkies. Mm-hmm. We can't get enough liquidity, and so we'd love to have the Fed ease. I just think with credit spreads and everything else I mentioned before, as positive as they are, why would the Fed be rushing to ease? I don't understand that.
So you mentioned speculation, and that brings to mind Bitcoin. How do you characterize what's been going on there?
I view it as it has all the classic signs of a financial bubble. Every single one of them is in cryptocurrencies. Even the notion of scarcity, which people talk a lot with Bitcoin, that's been talked about in every financial bubble. There's a scarcity, and what happens is you just have more and more other things come about, which we would call other cryptocurrencies. And you're seeing that when people can't trade Bitcoin, they go trade other cryptocurrencies. I think it's about as bubble-ish as you can get. I think that is a divining rod for the Fed, if you get the pun here, the divining rod for the Fed in terms of how much liquidity there is. And the fact that Bitcoin is, 65 to 70,000 is telling you there is too much speculative liquidity in the economy. And why the Fed would want to ease when there's that much speculative liquidity is beyond me.
All right, Rich, clearly stated. Thank you, sir. As always, good to see you. Rich Bernstein.
Good to see you
guys. Rangers are doing well. I see that jersey back there. Go Rangers.
Rangers are great. They beat up the Islanders yesterday. It was great.
Good stuff. Thanks, Rich.
See ya.
And sticking with Nvidia, all eyes on its developer conference dubbed the Woodstock of AI that's kicking off in San Jose, California. It's stock up slightly as investors await the debut of its new B100 GPU. The company is expected to release information on pricing, performance, and customer demand. And this all comes, of course, as we're hearing about a potential AI tie-up between Google and Apple. So for more on all of this, we're going to turn to Daniel Newman, CEO of Futurium Group, who is at the GTC conference, and our own Steve Kovac, who joins us on set. Daniel, let me start with you. Obviously, we've been going to our own Christina Partsinevelos all day long with her expectations. I know we're going to hear from Jensen Huang later in the afternoon, but what is it that you want to hear about this specific chip or anything else NVIDIA, frankly, going forward? This is the IT stock.
Yeah, there's a lot of people out there right now that are kind of thinking, speculating, has NVIDIA topped off or is there more room to run? And if you're an investor, you want to hear, do they have the technological moat? Do they have the software lock-in with the developers with what they're going to build for CUDA and for hybrid architectures that are going to be able to keep investors and keep the market churning with GPUs based on NVIDIA? We know the B100 is coming. We know it's more powerful. It's going to compete with AMD's new MI series that had a lot of excitement. But really, they have 99% of this GPU market, and all the demand is going their way. Can they keep it? Do investors and do the users and developers walk away from this conference and say, this technology has it? It is where it needs to be, and the competition is going to stay locked out. I think that's what we want to see from this conference this week.
Daniel, earlier in February on Power Lunch, you said that you believed that NVIDIA had reached some level of a trade peak. Obviously, we've seen a little bit of a pullback, but where are your expectations of where this stock can go? Or does a lot of it hinge on what we're going to hear about this new chip, this new B100?
Yeah, so my concerns tend to be about the competition that's coming in. It's coming in from multiple places. It comes from AMD. Of course, Intel wants to have a play here, but it's also coming from the cloud providers, its own partners that are building these ASICs that are offering training and inference capabilities, in some cases with less power or at a lower cost. And as these start to enter the market, does NVIDIA still have the ability to grow market share and also maintain these incredible margins? And so without having the absolute superiority in technology, I start to see some of these new entrants coming into the market and potentially putting risk on that margin and risk on that growth rate. And as we hit 4 quarters of this incredible growth rate, at some point, those numbers are going to be, mid double digits, not triple digit growth. And will investors start to worry at that point?
So, Steve, I was going to ask sort of a similar question there. How deep or wide is NVIDIA's moat in these kinds of chips? And are they vulnerable, as Daniel seemed to indicate, to potential competition?
It's also quite wide, though, because also what we're expecting NVIDIA to talk about today is the software side of things. That they have that kind of locked up, too. So that, in essence, is the moat. Like AMD doesn't necessarily have those same software tools to play around with its AI chips. Intel, we have really very few details on what it's doing here. It announced the chip. It says it's going to come this year. That's about all we know. But so right now, it still is just NVIDIA. We see the big tech giants kind of messing around and making their own chips, but there's no one else. I mean, there's really no one else doing it. So the moat is huge right now.
Let's switch a little bit to this possible news of a tie-up between or collaboration between Google and Apple on the one hand, involving Google's AI offering. And on the other hand, I feel like I'm going back to the 1980s. Right. You've got Microsoft and its partner in AI, which is OpenAI or ChatGPT and whatever. What do you see happening there? And what's the potential for Google? Right. And what's the use case for Apple?
There's a lot. So, and I'll just start here. Apple, I asked them. They're not saying anything. They're waiting to announce when they're ready to announce, likely in June. That said, I can see it going 2 ways on the spectrum. One way, this is very simple and just an add-on to the search agreement these two companies already have. Google pays up to $19 billion a year to Apple to be the default search engine on its devices. We know that. That's been established. It's been working out in the DOJ case against Google. Great. Maybe this is just an add-on to that, adding what Google calls search generative experience. That's AI search. Maybe it's just that. Or it's totally the other end of the spectrum, and all this AI natural language stuff that Apple wants to eventually put in the iPhone, it's all powered by Google. If that happens, it's a bad sign for Apple. What have they been doing all these years while their competitors have been taking advantage of this consumer-driven, front-facing AI? And then for Google, it's great news either way for Google. For one, they're going to get if this does work out the way it's been reported, they're going to have access to 2 billion Apple devices. Over 1 billion of those are iPhones. That's where all the money is being spent. That is where Google depends heavily on those users today, just for search activity. That's why they pay Apple so much. And it's also validation of their technology. If it is that other end of the spectrum, and Apple is relying more heavily on these Gemini models, that's validation for Google that, hey, we got something good here. Apple took a look at our thing, they took a look at OpenAI's thing, they took a look at other startups, and they liked ours the best. That is really good validation, especially so many blunders since last year.
They've been slow out of the gate.
Exactly. Not even, slow, but also just bad out of the gate. Fumbling out of the gate. So over a year ago, they showed Bard, which is now called Gemini. It messed up. Last year, they kind of got caught in their Gemini demo, fudging the demo video a little bit. And then just a few weeks ago, the woke images that everyone was complaining about, and they had to pull that generative image tool. So a lot going on here, and but the idea that Apple would look at that and say, hey, we want that. Maybe they're seeing something that we haven't seen yet.
Daniel, before we let you go, it seems like other companies were taking the opportunity to try to mention Nvidia in any chance they got in their earnings call. I know Oracle sort of alluded to some kind of tie-up. There's a number of layers that are involved in AI, of course, and then Nvidia on its own. What are you expecting to hear? What have we heard? Do we have any more details on some of these sort of teased out partnerships from this GTC event today?
Well, there's going to be a lot of focus on these vertical solutions. So we're going to see healthcare partnerships. We're going to see partnerships in retail and financial services. I'm looking at the software space. Companies like ServiceNow that have made big commitments to partnering with NVIDIA to continue to build on this momentum, to talk about how they're going to build hybrid environments using NVIDIA's hardware architectures and to deliver AI to the future. And this is just one of many, but I like the Oracle, Salesforce, ServiceNow. These are the next plays in layer of abstraction of where customers are going to get value, and we're going to see monetized AI coming from the vendors and software providers in the space.
All right, gentlemen, thank you very much. Daniel Newman, Steve Kovac. Appreciate it. Thanks. Coming up, caught in an AI lie, the SEC accusing 2 advisors of exploiting the hype around AI to lure in customers under false pretenses. We will get the key details. Plus, getting back in the game, EA Sports relaunching its popular NCAA football game for the first time in a decade in what could be the highest spending NIL program to date. We'll discuss all of that ahead on Power Lunch when we return in 2.
Download the app. Welcome back to Power Lunch. AI is going to be everywhere eventually, but not quite yet. Eamon Javers has the story now of two investment firms who got a little ahead of themselves and ended up in trouble with the SEC. Eamon, Inspector Eamon, what do you got?
Hey there, Courtney. There's a lot of hype out there about AI, but today the SEC is saying that two investment advisory firms took the hype too far, making false claims about AI driving their investment processes. And the SEC says there's a term for that, AI washing. The commission prepared a video about their announcement today featuring Chairman Gary Gensler.
Public company execs, they might think that they will enhance their stock price by talking about their use of AI. Well, here at the SEC, we want to make sure that these folks are telling the truth.
Now, the two firms are Toronto-based Delphia and San Francisco-based Global Predictions. According to the SEC, Delphia allegedly claimed it puts collective data to work to make our artificial intelligence smarter so it can predict which companies and trends are about to make it big. But that wasn't true. And the SEC said Global Predictions falsely claimed to be the first regulated AI financial advisor and that its platform delivered expert AI-driven forecasts. But that wasn't true either. So, guys, the SEC said the two firms agreed to settle the commission's charges and pay a total of $400,000 in civil penalties. So the lesson here, I guess, is that making false claims about artificial intelligence isn't, well, all that intelligent.
That's so good. I love that. I mean, AI washing, it's like the new greenwashing. And I feel like so few people really understand all the intricacies because we don't really know the limits therein, right? I mean, it could be limitless that maybe this is an easy false claim to make, but be warned, right?
Yeah, look, I mean, it's just like any of those other buzzwords that you see out there in the market. When people start applying them all over the place, just, buyer beware. Take a look at what you're actually buying into and whether there's any substance behind some of these claims that people are making.
All right, Eamon, thank you very much. Eamon Javers reporting. Still ahead, some tax facts. We're less than a month away from the April 15th deadline to file. I'm visiting my tax guy tonight. We've got some tips to help lower your tax bill and save more of your hard-earned money. Stick with us.
BC.
Welcome back, everybody. Oil prices rising again today, up 5% in the past week. Pippa Stevens is at the CERAWeek conference in Houston for us. Hi, Pippa.
Hey, Tyler. Well, it's a really fitting time to be here at CERAWeek by S&P Global because oil prices are at their highest level since November, and they're really now in this sweet spot range between the $80 and $85 level on WTI, where companies are still making a whole lot of money, but not too much money to draw the ire of Washington. And they're also not high enough yet to kill demand. And so this latest leg is thanks to Ukraine stepping up its attacks on Russian infrastructure, which did lead Morgan Stanley to raise its Q3 Brent target to $90 today. That's on the supply side. And then on the demand side, we heard from Exxon CEO Darren Woods, who earlier said that demand is very, very healthy at a record despite some challenges on the global macroeconomic front. So in other words, saying that we are not at this oil, peak demand that people have been talking about for a very long time. And that speaks to one of the key themes here at the conference, which is this multi-dimensional energy transition. For a long time, oil and gas companies were sort of left out of the conversation, but now they are saying, hey, you need us. We have the balance sheet, we have the R&D, we have the spending and the know-how to meaningfully participate in things like hydrogen and carbon capture. We've also heard from a number of executives that they are very supportive of the Inflation Reduction Act and working to build out their low-carbon solutions. Still a small portion of their overall spending compared to what they're putting into the fossil fuel divisions. But nevertheless, they are touting their accomplishments there and the fact that you can't just go from system A, which is fossil fuels, to system B, which is renewables, overnight.
Good stuff. Enjoy your time down there. Bring us back something good from Houston. Let's get over to Julia Borston. She's got a CNBC News update. Hi, Julia.
Hi, Courtney. Well, a majority of Supreme Court justices appeared skeptical today of arguments the Biden administration violated the First Amendment. Republican attorneys general in Louisiana and Missouri, along with 5 social media users, filed a lawsuit accusing the administration of coercing platforms to remove misinformation on topics such as the COVID-19 vaccine and the presidential election. Some of the justices questioned whether plaintiffs could prove they were directly harmed. The CDC issued a health alert this afternoon to warn about the spread of measles across the U.S. So far, health officials have tallied about 60 cases this year in 17 states. That's more than all of 2023. The CDC is urging parents and anyone traveling internationally to ensure they're vaccinated. And Paul Manafort may be on the political circuit again soon. The Washington Post reports former President Trump is eyeing his former campaign chairman for a new role in his 2024 campaign. Trump pardoned Manafort in 2020 for bank and tax fraud convictions. Courtney, back over to you.
Thank you very much, Julia. Well, coming up, Game On. The rise of name, image, likeness rights has been a boon for college sports, and now one video game giant is looking to cash in and spread the wealth too. We'll discuss when Power Lunch returns.
Welcome back, everybody. A little over 10 years ago, EA Sports stopped making its NCAA football game amid lawsuits over the use of player likenesses and names. Now, in light of the new name, image, and likeness rules, the video game, returning with what may be the largest scale, highest spending NIL program yet. Here to discuss the deal and the rapidly changing landscape of college sports is Cam Weber, president of EA Sports. Cam, welcome. Good to have you with us. A wonderful start to this game. I've been seeing, I think, Chris Fowler talk about it on websites. 134 teams opted in, 10,000 players opted in. What do those teams get, and what do those players get for, quote, opting in and letting you use their name, image, or likeness?
Yeah, so I mean, this is a broad range design of a deal. So we obviously we have deals with all the individual teams across the country. We have, as you mentioned, 134 FBS schools across 10 FBS conferences, and then 85 player rosters across 134 schools. We get those rosters from the schools, and then created a design of a program that would allow all of those players, every one of them, the opportunity, if they so choose, to opt in, get paid to be in the game, and they would get $600 plus a $70 copy of the game sent to them as well. And in return, we will put them in the game and have them, as themselves on that team, represented by their number, and do our best to do a likeness for them as well.
Is $600 what everybody gets regardless, or do some players who are high-profile players, like the quarterback at Texas, the quarterback at Southern Cal, who's going pro, do they get more?
Well, we had to do a multi-tiered design. So to be inclusive, we went broad across those 11,000 players, yes. So that would include all of those players. And we've had over 10,000 opt in just the first week after we announced it, which is incredible. But we also are doing what we're calling ambassador deals. So we have over 100 athletes that we are signing these ambassador deals, and they will have individual set deals based on the relative value and the social media reach each of those players has. So yes, there will be different deals for some of the biggest athletes in college football. On top of that, we're signing some other college athletics stars as well, even from women's sports like volleyball and basketball, and allowing them to be ambassadors to promote the return of college sports to kind of AAA gaming.
And that's exactly what I was just going to ask, because I understand women's sports are part of this too. So it's not just men's college football. Do you have Caitlin Clark on the platform?
I don't have anyone to announce today, but we do have a list of players and athletes that are signing up. And we'll have more to share in the month of May when we roll out more on the game.
How do you keep up with the transfer portal movements that are affecting college athletics, whether it's men, women, basketball, football, volleyball, whatever, baseball, where players are moving? And I would think that a player's value could either be enhanced by a move or decreased by a move. In other words, if you've got a star at a Big Five conference, like a team like Washington or Oregon or Alabama, that player might be worth more there than if they were to transfer to Cincinnati or Louisville or some maybe lesser team.
Yeah, so I mean, all of this is complex, which is why we had to build systems in building our games so that we can dynamically adjust and change rosters. And even like, the incoming class of freshmen, a lot of them haven't decided yet or have not arrived at their schools and been part of those rosters yet. So we're gonna have to be constantly dynamically changing these rosters. The program itself will have to continuously evolve over time. So we're going to launch the game this year, update those rosters and those player pools over time. And then as we move to update the game the following year, we're going to have to take a look how it all performed, look at the relative value of players, and we'll have to design the next step of the program as we go forward. But we're going to learn a lot. This is kind of unprecedented what we're doing.
How do you respond as part of this ecosystem of players and payments and so forth, and the fact that colleges technically are not allowed to pay athletes? I guess some kind of organization is able to do that. But I want to get your reaction to what Nick Saban said in front of Congress last week. Nick Saban, Gino Auriemma, other high-profile coaches in different sports have been very critical of the direction college sports is taking by saying, for among other things, all they care about now is getting paid.
Yeah, it's an interesting one. I'm a former college quarterback myself, and I'm a bit of a purist, and I do love what the sport teaches individuals. And my son also plays high school football, and that element of hard work and loyalty and kind of building character through lessons. And I think that's all really important. But I also believe that, you know, these players, especially in big-time college sports, are becoming huge stars. And so I think it's finding the right balance, finding opportunities for players to share in some of the opportunities that might arise from what they're doing. But, you know, also we need to figure out how do we teach some of those other values. And I'm not sure if jumping from team to team every single year does that. I'm not sure how we do that, other than I think it's just a challenge for leadership. And I think it's coaches finding a way to connect with this next generation of player to get the right messages across.
And then what about another challenge if you see players at some schools unionize, like what we're seeing happening at Dartmouth right now? How would you deal with that?
Yeah, I mean, I'm glad I'm not leading a college football program myself right now to deal with that. I mean, those are challenges. I think we'll just have to see how the space evolves. And, you know, when it comes to what we're doing, once again, we're trying to just create an opportunity to make the most authentic game possible for our players and give individual players the opportunity to opt in or opt out based on their own individual choice. And I think from our standpoint, if we stick to that, I think we're in good shape.
Cam Weber, EA Sports President, thank you for being here with us. This is fascinating. I love college football. I'm also a purist. The transfer portal and the NIL and all kind of...
It's a big change.
Yeah.
It's a big change.
I'm not sure I love it, but anyways, go Bucks. Well, we're just 4 weeks away from tax day. We'll tell you what you need to know to take advantage ahead of this year's deadline. We'll be right back. Welcome back. Can you hear the clock ticking? We're exactly 4 weeks from the April 15th deadline for Americans to file their 2023 income tax returns. Senior personal finance correspondent Sharon Epperson is here with us now for what you need to know. Can you make it be less painful?
Oh, it's your favorite time of year, isn't it?
No,
well,
it's not.
If you're like many Americans, you probably have yet to file your taxes. But if you're a do-it-yourselfer, the IRS has a new way to file for free. This year, the IRS began rolling out Direct File. It's a free filing program that can be accessed right on the website, and the pilot program is an online tax preparation service that does not use a third party. Now, Direct File is available to taxpayers in 12 states, including California, Texas, New York, and Florida. It's a simple option for taxpayers who's earned income from an employer and who also get a W-2 form. You also need to claim a standard deduction and have lived in the state for the full 2023 tax year. Another key perk, though, is there's no income tax on using Direct File. Now, IRS Free File is another option to get access to several online tax preparers that the agency partners with at no cost, but it caps out at $79,000 in adjusted gross income. Still, you can still file for free at any income level using the fillable forms that are available on the IRS website. If you're looking for more ways to save on your taxes, well, if you did a home improvement project that saves energy, you may qualify for a tax credit worth 30% of the project's cost, up to $3,200. Now, if you want to avoid an audit, make sure any tax breaks that you take are reasonable. Account for all of your income, including 1099s, and avoid round numbers. Those are all red flags that may trigger the IRS to do an audit. And if you think you owe, well, it pays to pay up by April 15th, before late filing and late payment penalties and interest kick in. This year, you'll have to add an extra 8% annual interest that's compounded daily on the overdue tax that you owe. So
8%
you do not,
is high.
8%.
And compounded daily.
Yeah.
Yikes.
So are there ways I can still cut my 2023 tax at this late hour?
At this late hour, you're going to look for all the tax credits that you qualify for because they're going to lower your tax bill dollar for dollar. And then you're going to look at some ways that you can take deduction if you qualify. If you have a high deductible health plan, you can make a contribution to a health savings account and have that contribution still be deductible for the 2023
I can do that today
you
if
can
I
do that
qualify.
today all the way up to April 15th. And then also, if you have an IRA, if you're eligible to contribute to an IRA, you can also take that tax deduction all the way to April 15th and make that contribution until April 15th, having an account for the 2023 tax year.
Just because I'm always thinking about this, always. Which is better, Roth IRA or conventional IRA? General.
Well, I mean, if you want to take a tax deduction, if you qualify for a yes, but the Roth IRA, that tax-free. I love things that are tax-free when you take it out,
when you pull the money out.
Free when you pull them out. What I like to see is whatever number it says is my balance. I want that to be all my money.
Right.
Yeah. You don't want to have to pay.
I don't want to have to pay anybody because that's not a real balance then. And I think people don't realize that a lot of your IRA money, your 401k money, if it's in a traditional account, is not your money.
Right, you could do a Roth 401k as well.
Yes, you can do a Roth 401k also. Yep,
Right.
Roth means yours.
Sharon, thank you. Like that. That's simple. All right, coming up, we're going to check the charts on some names on an upswing to start 2024 and another heading in the wrong direction. And as we celebrate Women's Heritage Month, we share the stories of some of our newly named CNBC changemakers. Here is Itasha Cave, 12 co-founder and chief science officer.
I think what others can learn from my journey as a female leader is really resilience and perseverance. Many steps along the way, I've experienced challenges and roadblocks, and having the ability to move past them, to celebrate the small wins, and take the challenges as they come has been a key part of getting me to this point.
a trial.
Welcome back to Power Lunch, everybody. Time now for some technical support. Our chartist today is Jay Woods. He's the Chief Global Strategist at Freedom Capital Markets. First up, let's talk about Cloudflare, cybersecurity name up more than 50% over the past 6 months. Does it have more room to run, Jay? What are the charts showing?
It not only has more room to run, but it's at a good setup technically. Let's take a look at what it's done. It had a nice gap here after its last earnings. Stock was actually up 19%.
Wow.
It faded, and we call this flagging, after reports that were disappointing from Palo Alto Networks, Zscaler within the group. But what is it doing? It's setting up perfectly from a risk-reward point of view, which is what we care about. It's holding this taupe line. You said taupe last time I was here.
I like these colors. The nice Easter lavender,
yes,
the taupe. It's very nice.
It's a rising 50-day moving average.
Yeah.
This is positive. It's actually rallying a little bit today. And the story is great. It's trending higher. It has a lot to reverse. So what I think it's going to do is get back on that upward momentum over the next 2 months into its next earnings cycle. And you're going to see it rally towards this 115 area, which, where's my line here? 115, which is where it peaked out before it reversed. And the stock is set up to look, pretty good from a risk-reward setup. If it does fail this 50-day moving average, look at the old resistance, now support, at the 87 level, and put a stop in there. So risk-reward, it's set up, and that's how we like these things.
Taupe means hope. All right, let's move to Micron. The semiconductor stock set to report its results on Wednesday. How can investors trade this before it announces results? I'm not sure your device is working, but you just talk us through it.
So we're going to adjust to it.
Here we go.
This is John Madden-esque is what we're going to go. This is Micron over a weekly basis. This goes back 5 years. And you can see it has a line of resistance right here where we have failed to go above.
Right.
We had a little peak above it there. It's around $95.
Boom!
Boom!
Whap.
But yes, what did it do?
Hits the ceiling.
It failed. That's fine. We want to see a close above it. But what I love is this setup. We've seen this setup where? In the S&P 500, in Nvidia, in Microsoft, in Meta. And it's nice rounded bottom. If it can break out, and guess what? We have earnings on Wednesday afternoon. You have room to run. And with a setup like this, the longer the base, the higher the space. We could see a run 40, 50% higher here. So look for a target between 135 and 150 on a breakout. So you play the earnings, but you wait to them. You don't gamble before the earnings. You wait till after the earnings.
All right, let's move on to Nike now. Shares down double digits from a year ago. The company is expected to report third quarter results Thursday. Your take? Oh, look at that. That's a limp noodle there, boy.
Yeah, this is trending lower. We've had some interesting pops in Nike. Let's look at gaps. I like to see gaps in the charts. We had a gap up there on a nice earnings. And what did it do after the gap? It trended higher. Guess what happened here?
Gap.
Bad earnings. And what's it done ever since? It's trended lower. So earnings are on Thursday. Let's be careful, but let's know what we want to do if it gaps one way or another. Now, it's trending under the 200-day moving average. Bad things happen under the 200-day moving average. I wouldn't jump into this, but if it does gap lower, let's see if this area around 92.5 holds. If not, we'll probably test where we were back in October. Those could be good entry points because over the long term, I believe in Nike. Do you believe in Nike?
I believe in Nike.
I
My
do
son
too. So
only wears Nike.
I think it would be a good long-term opportunity to jump into the stock. And then what if it gaps? If it gaps and it clears the 200-day moving average, I would actually chase the name. Because what have we seen on gaps higher? It trends higher the next 3 months during that earnings cycle. So look for Nike to play it either way, but you have to be postured after the earnings. If you play before the earnings, you're just kind of gambling. I like to have the risk-reward setups in my favor. And, given the gaps, we may get setups that are in our favor after Thursday's earnings.
All right, Jay, thanks.
Thank
Appreciate
you.
it. Good to have you
No
here.
problem.
Jay Woods, Court.
Well, so many stories to get to, but so little time left. This always happens. We're going to power through as many of the headlines as we can in closing time. It's coming up next.
We have just about 3 minutes left in the show and several more stories that you need to know, so let's get right to it. Amazon striking a deal with one of the biggest social media stars. Mr. Beast will host his first traditional TV series, a reality competition show featuring 1,000 contestants competing for a $5 million prize. Tyler, I have to admit, I don't know who Mr. Beast is.
I do not know Mr. Beast. I'm sure my son knows Mr. Beast. It just shows that when you build a following on social media, whether it's YouTube or Instagram or the questionable TikTok, you can really build a business.
You really can build a business and turn it into a traditional media platform here, I suppose.
All right, let's move on. An analysis by the New York Fed highlights the worst-paying college majors. You know what they are? Top 3 worst-paying 5 years after graduation. Here's the worst. Liberal arts, you make $38,000 in there. And at number 2 is performing arts. Average, again, is about $38,000. And theology, $38,000. We need more theologians, Courtney.
We do. I was also surprised that the miscellaneous biological science was only $40,000.
Yeah.
As was nutrition sciences. And, of course, we know elementary and early childhood education.
Anthropology majors, they don't make that much. Yeah.
Teachers are so important. I think every parent learned that during the pandemic, even though
Fine arts, you only make $40,000. But you know the difference between a Manet and a Monet, I guess.
Which is, powerful stuff. I'm not sure I do, unfortunately. Well, Sports Illustrated getting a lifeline. The owner of the brand says it's chosen a new company to publish the magazine. The deal between Authentic Brands and Minute Media runs for 10 years, could be expanded until 30 years, at which point the magazine would be 100 years old. Authentic Brands owns a whole bunch of different stuff, including a bunch of retail brands, but also licenses the names.
Licenses the
like
names of Marilyn Monroe, I believe, and maybe Joe DiMaggio. I can't remember, but a lot of them. One of the co-owners of Authentic Brands is Shaquille O'Neal, by the way.
Yeah.
I am betting the under on whether Sports Illustrated will be around as a magazine in 30 years. I don't think so. All right, inflation-busting Costco staple. It is going to stick around for now. The outgoing CFO, he's been there forever and ever, Richard Galante, says the membership club's $1.50 hot dog and soda combo is probably safe for a while. There it is, onions and relish right there. It remained the same price since Galante took over his post in 1985. Congratulations to Mr. Galante, who I believe is stepping down, getting ready to retire after 40 years and countless hot dogs he's due.
Yeah, so many. And then good luck to him in his next endeavor. I'm sure the hot dogs are going to stick around for a long time. Well, I think we're out of time for our last story, but look at the Dow. It's moving higher, 0.4%, but it still counts as gain. NASDAQ again leading the way as we are getting ready to turn over the reins. Thank you for watching Power Lunch.
And Closing Bell starts right now.
And welcome to Closing Bell. I'm Mike Santoli in for Scott Wapner. This make or break hour begins with stocks working hard to hold gains with the help of Alphabet and Apple for a change as the street waits for a pair of crucial events in coming days. Nvidia shares up pretty small, especially for Nvidia, ahead of CEO Jensen Huang's keynote in the next hour. You see it up less than 1% there, while Treasury yields push to 3-month highs as suspense builds over a Fed meeting that comes after an uptick in inflation has stoked more uncertainty over the outlook for rate cuts, 4.35 on the 10-year. So here's your scorecard. The S&P 500 has been higher all day. It is definitely a top-heavy move. You see it there, up 0.8%. The equal-weighted S&P is up about 0.5%. NASDAQ is ahead by a full percent. And otherwise, mixed tape. Alphabet, though, as mentioned, popping this morning. It is now up about 4.3%. It actually has been the biggest upside contributor. Apple is ahead as well, 1.4%, on reports that Apple might use Google's Gemini AI capabilities in iPhones. So with the 10-year in the 430s and WTI crude up another couple of percent to its highest price since Halloween, that is behind part of the Fed suspense. This all leads us to our talk of the tape after a 4-month rally based on a Goldilocks economy, AI excitement, and the prospect of an easier Fed. Is the playbook changing as the first quarter winds down? Let's ask Adam Parker, Trivariate Research founder and CEO and a CNBC contributor. So, Adam, yeah, those have been the narrative threads. It's worked pretty well. Been almost no pullbacks. Been a little attention on some frothy pockets in the market. In the last couple of weeks, things have cooled off, but not fallen apart. Where does that leave us?
Well, I think the bull case is still intact, right? If the average company can have gross margin expansion, if I start thinking earnings are going to be up for the next few years, they'll be ahead 25 versus 24. And if I ultimately think the Fed's going to be accommodative, I think that's a pretty good three-legged stool for optimism.
Yeah.
So the things I'm monitoring, I guess, to get cautious, three things. Does China continue to look bad, not improve? The fundamentals erode. The U.S. companies with exposure there look bad. Maybe I've gotten positive data points on a relative basis lately, but we'll see. U.S. consumer, does that really slow? I was worried about it when Discover reported, then they got bought. Then, there's been some pockets at the subprime where you get worried, but I'd say in aggregate, the consumer's in pretty good shape, even if it's eroding a little. And the third thing is maybe you don't worry about the front end with the Fed, you worry about quantitative tightening and sort of the balance sheet. But that's how I'm weighing it, and it's still skewed to the positive as far as I can see it in terms of risk taking.
So does that mean also on a tactical basis you would just kind of stick with what has gotten us here? I mean, you have seen things, for example, I mentioned the frothy pockets. I mean, crypto had this huge ramp. Everything related to it, it's backed off a little bit. So you've seen a few little hints that the market is sort of saying enough for now on some of the hot stuff. But what about tactically?
Most of my clients are institutional investors trying to beat the S&P 500, so they're never going to be too big in Bitcoin miners or uranium or whatever. I think they are focused on how to play AI, and so to me, that trend isn't in the price over a 3 to 5 or 10-year view. It may be a little ahead of itself tactically. So for me, I think there's lots of stuff to own. If you're going to say, hey, this is going to last 3, 4, 5 more months, there's fear of missing out, and I don't want to, I'll run toward the bubble as opposed to away from it, then you still want exposure to AI semis, to software where revenue is accelerating. And if you want to balance it, which is what we do, we offered a note this week, 5 ways to find stuff that's not correlated to the AI trade in semiconductors, or maybe you own some energy and copper where, as you pointed out in your preamble there, crude's up a little bit. So I think there's ways to balance the portfolio, but I don't think you want to run a fund and say, I don't own anything related to AI. That doesn't seem right to me.
Yeah, arguably, that's kind of what the market in aggregate is doing in a way, right? It's not quite as all in on one trade. Well, we are less than an hour away from Nvidia CEO Jensen Huang's keynote at the company's big GTC event. Christina Partsinevelos is there in San Jose, California, with more on what we might expect. Christina.
With more people as well, because this used to be, a few hundred people that attended this event, and now we're expecting 11,000 in this SAP arena in San Jose for CEO Jensen Huang's 2-hour keynote. It's, yes, a developers conference, but Huang's words could help add sustainability to the entire AI ecosystem, which is why so many people are paying attention to it. Investors, first, expect Nvidia to launch a new GPU chip. Well, more details, I should say, about the B100, which could be at least 2 times the performance of its previous H100 chip. Nvidia doesn't usually provide pricing, but I've seen estimates anywhere between $40,000 to $50,000 for this chip. We'll also hear more about products ranging from CPUs to how they're going to better monetize their software, going up against big tech companies, some of which are going to be in the audience. Other key themes: demand extending beyond the typical pockets of Google, Meta, Microsoft, and into the pockets of finance, healthcare, government, and sovereign wealth funds. And then lastly, inferencing. So that's where you use trained large language models to spit out answers to your queries, and it's the next step of the large language model train. Inferencing contributed roughly 40% of Nvidia's data center revenue, and demand is expected to grow and be a major driver for the years to come. So the bottom line, though, today is about demand sustainability. Investors want to know, is the pace of demand going to keep up, 1 to 2 years from now, even beyond that? They'll also want to see how that $1 trillion total addressable AI market can go to $2 trillion in just 5 years, and in turn justify owning this soaring stock, which I know you pointed out too. It was up over 2% earlier today, now down ahead of Jensen Huang's speech, which is coming up soon.
And Christine, it's gone a whole 10 days, I think, with a new all-time closing high. So yeah, it's been a rough patch on a relative basis. You mentioned, though, a couple of times that Huang is expected to at least give some kind of hints on the sustainability of demand, looking out, toward the horizon. I mean, the company's only a few weeks out of from its earnings report last time. Is there a likelihood that he's going to have, things that are very tangible about that supply-demand dynamic at this point?
Honestly, I would say no. We already heard that $1 to $2 trillion TAM. He mentioned that in Dubai not too long ago. So there are some analyst notes that are guessing maybe he'll say, oh, it's going to be roughly $500 billion per year, which would obviously be a number we can work with. But in terms of putting financial targets, usually this event is about new products, right? And about how that demand is expanding to other facets of the economy. And I think that's where they're going to lead with, and the collaborations, which I didn't even get to, the collaborations with other companies like Micron, like Broadcom, perhaps Intel. Again, I don't know. I'm going to get the information as everyone else in just an hour. But these are all big movers for other names within the space. But last point, Mike, you talked about the stock. It was down 4 to 5 sessions just last week. There's concern that maybe this is a sell the news kind of event. You saw some selling heading into this event. And yet the stock keeps climbing 10 weeks in a row, weekly gains, even with those drops last week.
Yeah, for sure. I would expect big picture vision, and we'll pick it apart once it's out there. Christina, thanks very much. Adam, you mentioned before that you didn't think that maybe all of the upside for AI across the market is sort of in the price. In what way would you say that?
Well, I mean, there's the revenue side where NVIDIA is clearly the biggest beneficiary, and then there's the cost benefit side over the next decade. You're just starting to see companies talk about it. So I think that's what I mean when I say it could be a decade long. Anyone who's got a lot of data about their employees and about their customers is going to try to get more efficient, and that'll take years to unfold. So I think I think the other thing about NVIDIA, I wrote this a few weeks ago called the NVIDIA God trade. Like, if you don't own it, what you're saying is you're God. That you're saying you think it's really close to the peak, and you know that, even though you probably missed most of the first $2 trillion, that it's then going to go down 30%, which everyone suspects at some point as soon as they're 3 months away from meeting demand. Then you'll buy it again at the bottom and ride it for the next ways up, as if you're God the next 3 moves, even though you weren't the previous one. I think there's like an inherent arrogance by saying I don't own it based on current valuation. I think you have to say I'm running a fund. I want exposure to the biggest investment theme over the next decade. This is the best product from the best company in the early phases of deployment. You can do all you want to say who are their customers and how's it going to happen, but it's still early days. So we all think it's going down 30%, but it could be 30% from another trillion higher. I mean, that's my stance.
You sound a little bit like a passive indexer. I mean, I could buy the S&P and $1 out of every 20 goes to NVIDIA right now.
I think for the biggest 6 or 7 names we've written a long time, you should be pretty close to market weight. Right. You don't know anything about the stock that nobody else does. They're pretty macro. If I know if the market's up and large beats small, growth beats value, I explain 60, 70% of NVIDIA's returns. And I think it's awfully arrogant to say I know something about NVIDIA that nobody else knows of the hundreds of buy-side analysts and 60 sell-side that's not in the price. So, yeah, you should be pretty close, pay low fees for that, and then make your alpha elsewhere. That's probably prudent, long-only strategy.
Yeah. I mean, I guess even if you were active, we've talked about this too. I mean, a 5% position is pretty substantial.
It's pretty chunky.
Right. Yeah.
It's pretty chunky, yeah. Yeah, that's right.
Let's bring in Jordan Jackson of JP Morgan Asset Management. Broaden out the conversation. Jordan, good to see you.
Good to be here.
Let's get to some of the macro setup that we've got going on here. We mentioned, the Fed 2-day meeting starts tomorrow. A little bit more play maybe in what comes out of that in terms of the pacing of rate cuts, the tolerance for this uptick in inflation. But before that, Bank of Japan really expect it to have kind of a signature landmark move. What do you expect out of it? And then what are the market implications?
Sure. So we actually think the Bank of Japan's got enough ammo to finally get out of negative rates. And we think they do that tomorrow. You've got really strong wage negotiations that are happening. So a lot of the big steel companies, the big auto manufacturers have increased wages at some of the highest levels that we've seen, multi-decade increases. The largest labor union just last week just agreed to some pretty significant wage increases. And this has been one of the criteria that the Bank of Japan has been looking for to finally get out of negative rates. Also on the growth side, right, they've got fourth quarter GDP that was revised slightly higher, so they avoided that technical 2 quarters of back-to-back of recession, and they finally got inflation after 3 decades of not getting any inflation. And so I think this is a backdrop in which they can finally exit negative rates. The big question mark will be the direction for the currency.
It will be, and I guess the other question is, I mean, it's been one of the best markets for months and months in Japan, best equity markets. Is it as good as it seems, and can you actually buy that news?
Yeah, so the big risk for a while there was this negative correlation between the value of the currency and the stock market performance. It was very negatively correlated. There's a lot of multinationals, and these big multinationals generate a lot of their revenues overseas. And so you just had this roughly negative 0.6, 0.7 consistent relationship between the yen and the market from 2007 to roughly 2019. Then the pandemic hit, and that correlation kind of broke down. It's actually roughly around flat today. And when we look at underneath the hood, right, inflation, while for consumers it's your foe, if you're a business, it's your friend. So you've got some pricing power now. We're expecting roughly 10% earnings growth coming out of Japan this year. And so I think, again, there's things to finally be excited about in not just in the equity market, right?
Yeah.
So while there is scope for, again, rates to finally move higher, you've got to look at what's already in the price, what's already in forward markets. And forward markets have about a 0.25%, 25 basis point policy rate by the end of the year.
Yeah.
Unless the Bank of Japan surprises hawkishly or the Fed surprises dovishly, I still think you've got maybe some modest upward pressure in the yen, but not enough that's going to derail equity markets.
I was going to say you could envision a world in which Japan looking to exit negative rates and get tighter at the exact moment the rest of the world is looking for an opportunity to go in the other direction. And that could cause a lot of friction. You don't think that's going to happen this time?
I just think a lot of that's already in the price.
Yeah.
So again, and that's kind of the risk if we, kind of shift back towards the Fed.
Yeah.
I think there's greater risk that the Fed leans towards maybe the dot plot showing 2 rate cuts this year versus sticking to the 3 rate cuts. Again, while over the balance of the last 18 to 24 months, things have gone in the Fed's direction. Growth has stayed firm. Inflation has gradually come down. Labor markets haven't toppled over. But since December, since their last FOMC meeting, things have kind of stalled out, right? We're seeing wage inflation that's proven to be a bit sticky at 4 to 4.5%. Job growth, arguably, we did get some downward revisions, but on a 3-month moving average basis, kind of re-accelerated to start off the year. So maybe the Fed has to lean into being a little bit more patient here.
And Adam, I mean, I've been of the view that this bull market, this rally since October, was not mainly or even like a top 3 reason was that Fed's got to cut rates soon and deep, right? It seems like if the economy's okay, like bull markets don't tend to end because the economy was holding up well.
Right.
But how do you see this, though, after we've had all this kind of low volatility upside in the market and bonds at least sniffing out the possibility of higher for longer back on the table?
Yeah, I don't even know if I'm qualified to understand 3/4 of what you just said, because Japan, not cool. I don't know anything about it. And Japanese monetary policy, I know even less about. I traded the yen 6 times in my life. My PA lost money all 6 times. So on the Japan part, you
must have bought it.
I'll defer to the gentleman to my left. The part that I could debate a little, and I don't have a strong view, is just whether if they go from 3 cuts to 2 in the consensus view, if it'll matter for equities at all. I could see somebody saying, hey, you know what? Good news is good.
Sure.
Let's forget all this stuff we invented after the financial crisis. Bad is good and good is bad. And how about just we're in this pocket here where decent economic news means the Fed doesn't have to be as accommodative. We're all guilty of using the last 3 cycles as part of our average, which include TMT, financial crisis, and COVID, none of which have anything to do with the current conditions.
Yeah.
And so, all right, if the economy is a little bit better and they only do it twice, like maybe that's actually pretty good. I don't know if they go 3 to 2. It matters that much. I get what he's saying, which is, all right, if they get a little directionally hawkish, you could get a couple days where it trades off around that commentary.
Right.
But holistically, I think it could be pretty good. And I still think earnings are going to be up. So maybe that's the only thing he said that I'm even qualified to respond to.
I mean, and Jordan, I mean, I guess the other question is the reason that you might be concerned is if you think that a lot of the stronger economic numbers have been a bit of a head fake. In other words, the Fed's going to stay too tight because they're going to be focusing on, they're sitting here waiting for shelter inflation to come down like everybody expects it to come down. And while they wait for that, the underlying economy maybe struggles a little more, but it's hard to find the evidence of that.
Yeah, but importantly, they situated themselves where they're not going from, 3 to 2 cuts, so long as they're not going back to hikes.
Yeah, sure.
Right, that's really the key from a macro standpoint. So so long as the Fed remains in this sort of cutting bias, and that's 3, 2, 1, I think that's generally pretty supportive. They think rates are restrictive. And actually, interesting enough, if you go back to 1980, there have been 14 calendar years where the Fed cut rates and there wasn't a recession in the U.S. economy. 13 of those 14 years, the equity market was positive by about 15.5%. The only year outlier was 2002, and I think we had a little bit of a hangover from the tech bubble. So this is a micro environment that Adam talked about that's very supportive, earnings growing, and then you've got a macro environment that's supportive, that the Fed's got a bias towards easing. So I'm with Adam. I'm bullish on the market.
I agree with you. If the Fed hikes, I think we're selling. We're selling off. I agree with that. Yeah, but I think look, our at Trivera, we don't.
But it would also take time for them to get to that point of making that move.
They need different data on jobs and inflation. Our website, you search Powell, it says 0 search results. That's how we do. We look underneath it, and I just see so many opportunities to buy things underneath that to me it feels very optimistic about security selection, active security selection, and I think the risk reward is still positive.
And to your point, Jordan, I was looking back at 1995. Everyone, I've been bringing it up as the ultimate, soft landing year. If everything went perfectly, Fed cut twice, July and December, after a long tightening cycle. So I'm sure that's in your data set of markets that treated it well.
Yeah, but there was still scope for the unemployment rate to keep coming down.
That's right.
I don't think the unemployment rate can push down any lower than what it's at right
that's
now.
A lot of the other stuff doesn't match up exactly, but we'll pick and choose as we can. All right, guys, thanks a lot.
Yeah, good to
talk to you, Adam and Jordan. Let's now send it over to Steve Kovac for a look at the biggest names moving into the close. Hey, Steve.
Hey, Mike. Yeah, PepsiCo shares, they're popping about 4% today after analysts at Morgan Stanley upgraded the stock from overweight to equal weight. Morgan Stanley predicting fundamentals that the company will hit bottom in the first half of the year and rebound from there. And then shares of Shift4 going the other way, down about 7% or so here after Bloomberg reported yesterday. The CEO told employees on Friday that outside offers to buy the company weren't enough to make a deal. According to the report, the Shift4 board thought the offers did not, quote, sufficiently value the payments processing company. Mike.
All right, Steve, thanks very much. We are just getting started here. Oil prices climbing to a 4-month high today. Up next, we're drilling down on that big move. RBC's Lori Calvasina forecasting even more upside for the energy sector. She'll tell us why and the other parts of the market she's banking on. That's just ahead. We're live from the New York Stock Exchange. You're watching Closing Bell on CNBC.
.com.
Welcome back. AI-related tech has been in the spotlight for most of this recent rally, but energy stocks have quietly moved into a leadership position, with the sector becoming the best performer over the last month. Our next guest sees more upside ahead for the space. RBC Capital Markets' Lori Calvasina is here at Post 9. Lori, good to see you.
Good to see you. Thanks for having me.
So this in the context of a broader market, it feels like a lot of your work is pointing to kind of fairly valued, perhaps, but there are things to do. Maybe unexploited areas. Why does energy get into that category?
So it's funny, Mike. I was talking to some of my salespeople earlier today, and I said sectors just haven't been that interesting of a discussion lately. And all of a sudden, energy got really interesting, and it just sort of had this big move. We've been overweight. We viewed it as an inflation hedge in the portfolio, and guess what? Everyone's gotten worried about inflation again and interest rates, and so it's kind of doing what we hoped it would do. It's serving the right function. But putting that issue aside, I mean, it's cheap. My analysts like it much more so than my analysts in other sectors, so I think that's an important read on fundamentals. And money flows, if you look at the EPFR data, is starting to shift back in areas, commodities, materials, energy, industrials, kind of these cyclical areas that should benefit if the economy really is running hot the way everyone's worried. So,
and is that your read on it? Because, I mean, obviously the underlying commodities have had a move as well. You feel like it's kind of a global demand overlay?
I think it's the U.S. is running pretty hot. Obviously, there's geopolitics when it comes to energy and some of these commodities. But I do think there is a begrudging acceptance that we're not on the brink of recession and things are not that bad. And maybe not so much the last couple weeks, but maybe about a month ago or so, there was a conversation about a bottoming in China that we were hearing a good bit about. So I think we're kind of in this weird healing process, and energy's benefiting from that right now.
You do mention the general acceptance, this embrace of the not just no recession, but things look like they're humming along pretty well. It felt like that motivated a lot of people to allow equity exposures to go up and buy into this market as it went higher. Are you struggling to substantiate possible further upside in the index?
So there are conflicting cross currents right now, and in my meetings, this is a big thing we talk about. So on the more constructive side, my valuation model's been pointing to upside to say 5,400 or so, multiple of around 23.3 times on a trailing basis. That's if you buy the idea that interest rates are going to moderate, the Fed's going to do a certain amount of cuts, and inflation's going to come down, 10 years going to come down. And maybe those are a little bit aggressive. We wrote about that in our weekly today, and we said if you just leave interest rates where they are, and depending on your earnings view, it's more like 5,000 to 5,200, so right where we're stalling.
Right.
But sentiment is a problem. Now, people don't feel all that great when you talk to them. They're in kind of a bad mood. But if you look at the positioning data on CFTC, it's pretty scary, and it's starting to retreat. So I think we're going to have a pullback. I've been saying that since January. It hasn't happened, but it's going to come sooner or later.
Yeah, no, it's I mean, the part of the market that has, I guess, prevented that from really taking hold is so hard to handicap, right? It's kind of like the big growthy stuff, a few of those working at any given time, and the index is going to move away from it.
Yeah, and I think it's an interesting debate, right? Because there's this view, if those stocks break down or stop leading, it's going to be a disaster for the whole market. And I can see that argument, but I also, sort of view it as like raindrops and buckets. And if I'm an old small cap strategist, right? So if you take a little bit of money out of some of these Mag 7 names and put it into the Russell 2000, that's a lot more meaningful to the Russell 2000 or your average regional bank than it is to some of these big cap names. So I think it's a question, do they really run into problems and fall? Do they just take a breather and stop leaving? Do people just divert a little bit money, and kind of reallocate their portfolios? The latter camp, I think the market can still do fine.
Yeah, I mean, I was pointing out, Tesla lost $700 billion in market value, peak to now.
Yeah.
And, it got absorbed somewhere else.
And remember, November and December was a pretty violent leadership rotation, and the market surged.
That's true.
If you look at February, small caps outperformed, and the market held on pretty well, and we've had a good start to this year, even though you have had some rotation underneath the surface. So I think the market can handle rotation. Does it contribute to some of those speed bumps that might, kind of be nasty for a short-term period of time? I think that's possible too.
Right. That's been the focus on just the momentum factor and whether that unwind really destabilizes something else. Now, you've mentioned small caps a couple of times. What is your stance in terms of large versus small right now?
So we've, and it's funny, maybe happened a little bit earlier in February than I anticipated, but we basically said coming into this year, small caps got 2 consensus in December. I was talking about it in too many of my meetings with non-small cap people, and I said, I'm not used to being the popular girl at the dance. And so that just felt a little uncomfortable. So I think it was natural to take a pause. I think that basically that November-December move was all about the Fed cutting rates. And we said, our positioning data, our valuation data looks middle innings. We think there's another leg to this trade, but people need to really get convinced that the economy is running hot for that to sustain. And you probably just need to actually get to the cuts, because until we get to the cuts, I don't think people are going to be convinced that the Fed, can do what they're doing and the economy is not going to take a bad hit.
So with that said, what are you expecting out of the Fed, and maybe where's the market leaning?
So I've witnessed just like so much angst over the Fed. I mean, just this dialing down of March cut expectations was really weighing on people, pretty significantly the last 6 weeks or so. So I think a lot of that's, kind of worked its way through, to be honest. I think it's all about the commentary. I'm not going to sit here and try to predict exactly what Powell is going to say. But I do think we're in the part of the market where the reasons why they're doing what they're doing matter a lot. And so, any kind of discussion of a hot economy, sort of how things are trending in the labor market, what they need to see, I think those things are going to impact my world. I'm fortunate at RBC. My guys were always looking for June cuts since last summer. So they're now looking for 3 cuts in the back half instead of 5, so they've dialed down like everyone else. But it hasn't been as much of a journey, so it hasn't really caused us as much angst.
Yeah, presumably he's not going to go back to, we really need to run this economy cool to do the job on it.
And I think I at least, look, I'm not the expert on the Fed, right, but I feel like that's what I'm hearing in the commentary. And I was always confused. People who thought that the Fed needed to destroy the labor market to justify the cuts, that, again, was never our house view. And I felt like I was never really hearing that, so...
All right, we'll see where it goes. Laura, good to see you. Thanks a lot. All right, up next, your Goldman Sachs market playbook. Elizabeth Burton is back. She'll explain her approach to diversifying your portfolio, plus the 2 I's she's excited about. Closing bell. I'll be right back.
SEC.
Welcome back. Stocks bouncing back today with Alphabet leading mega cap gains. This comes as the Fed prepares to meet on rates this week. Joining me here at Post 9 with her investment playbook is Elizabeth Burton, client investment strategist at Goldman Sachs Asset Management. Good to see you.
Good to see you too, Mike.
I need to focus on, to some degree, on what the big asset allocators are up to and what the market might be giving them right now to work with. Just in terms of trying to achieve their returns, you have stocks massively outperforming bonds recently. I've been hearing a lot about, being able to lock in returns at attractive levels for the first time in a long time. Is that still an active dynamic? How do you see things?
Right. I think that's very much true. The average public pension plan in the U.S. has about a 7% return hurdle, somewhere between 6.25%, 7.5%-ish, but let's call it 7%. And for a decade almost, there wasn't the fixed income book to really pull from to get some of those returns. Now you have more asset classes to pull from to generate lower risk returns potentially. So you can actually pull back from some of the more growthy areas or high risk areas. I would say that we're still at Goldman bullish on equities, potentially over credit right now. But you can start to look at your portfolio and say, how much do I need to have in some of these riskier assets? And can we look at new sorts of investments? A good example of this is infrastructure, right? So we all know what infrastructure is, but actually it's really only 20 years new in institutional and portfolios and really still nascent in most. And if you think about private equity, which in some public pensions in the United States is now just getting off the ground, some of them aren't even at target, that's been around 50 years. So to say 20 years in infrastructure, that means you really have about maybe 30, 40 more years for that to really get off the ground and become a bigger stronghold in portfolios. And one of the reasons I believe that institutions are looking at them are there are a lot of tailwinds, but it also might be a good diversifier to portfolios right now. I was going to say, we all know generally what infrastructure is, but as an investable asset class, it can be, there's infrastructure funds, hydropower or pipelines. What does it comprise? And I guess what are the return characteristics and how does it diversify away from other things? So you went right to hydropower, which is great, but I think most people think steel, concrete, or the road I drive every day. Gosh, it has so many potholes. But you're right. It's not just steel and concrete anymore. It's a lot of things. It's fiber, it's renewables, it's data centers. And it has a lot of the same themes that we've been talking about in our 2024 outlook and even our 2023 outlook, which is the 40s, deglobalization, demographics, digitization, and I'm forgetting the fourth one here. But yeah, so it has those tailwinds. We have regulatory tailwinds. These also are typically asset heavy. Some have, pretty strong cash flows, and they have inflation protection, either regulatory or embedded in contracts, or they have such a market share they can pass some of those onto the consumer. So, really this is a position of strength for infrastructure, and we see tailwinds going on for decades.
All right, so infrastructure is the first eye. India is the other one. This is a market a lot of folks have had high hopes on for a while, but why do you think it's timely?
Okay, we're not novel here saying that we're constructive on India, but we are bullish on India, and it doesn't have a lot of place in institutional portfolios right now, right? And we've seen a pretty good run. But one of the reasons we like India, we like emerging markets in general, and we think there's a lot of opportunity there from a growth perspective. But in India, you get a lot of visibility into earnings, which you may not get into other emerging markets. And it's been consistent over time. So when we say we think there might be double-digit EPS growth there, we have more confidence there than we might have elsewhere. And similarly, it has a lot of tailwinds behind it as well.
Is that because of just transparency of reporting that you have that visibility into earnings, or just because of the fundamental drivers?
I think it's a combination of both of those things, which should give investors increased confidence to look at those markets. We are seeing a lot of interest in emerging markets. That would be one that we think has particular opportunities here.
The traditional way of thinking about emerging markets when it comes to central bank policy is that Fed eases, emerging markets get a tailwind. Is that equation still in effect?
So, I do think this year we should be less concerned about what the Fed is going to do with respect to these markets, because there's a lot of uncertainty, particularly in the last couple of weeks. We think the general trajectory is the same, right? We're going to end up in the same place, but the pace of that. So if you're going to look at these emerging markets, I'd be thinking more over the long term. I think in the shorter term, look, we usually look at emerging markets when certain things happen with the dollar, right? Yeah, sure. But I think we could be in a scenario in a year or two where the dollar's position has changed. And do we want to, in a year or two, start thinking about where we want to be in the world, or do we want to think about it now? And do we want to get in before, there's massive flows going into that area?
Sure. And India, I guess, is not really an export driven. I mean, it's obviously what's going on there in the domestic economy.
Right. And you've got some other things there that may help diversify your portfolio. So I think if I added together what consumer discretionary and infotech in U.S. markets, it's 42, 43%. In India, that's closer to 27%. So it can add diversification, if not just, an outright bullishness on the market itself.
Sure. Elizabeth, great to see you. Thanks
a
lot.
See you.
All right, up next, we're tracking the biggest movers as we head into the close. Steve Kovac is back with that. Hey, Steve.
Hey, Mike. Yeah, we got two executive departures sending shares of two very different companies lower today. We'll reveal those names when Closing Bell returns after this.
18 minutes till the closing bell. S&P still up about 0.8%. Let's get back to Steve Kovac for a look at the key stocks to watch. Hey, Steve.
Hey, Mike. Yeah, shares of computer accessory maker Logitech falling better than 6% today after the company announced its CFO was leaving the company for another job. Shares still fell, even though Logitech reaffirmed its guidance for the 2024 fiscal year, which ends this spring. And then let's move over to Hertz, also slipping today. Shares down about 5.5%. That's after its CEO, Stephen Scherr, announced he would step down. Gil West, a former GM and Delta Airlines exec, he's going to be the next CEO at Hertz. And Scherr took over at Hertz as the company tried and, of course, failed to transition to electric vehicles. The company was forced to sell thousands of its EVs last year due to lack of demand, Mike.
All right, Steve, thanks very much. Sure. Still ahead, a big tech double play. Meta and Netflix shares on the rise. We'll tell you what's driving those stocks, giving those stocks a boost, and what it might mean for the mega caps in the long term. Closing bell. Be right back. Welcome back. Nvidia's massive run-up might have some investors feeling some FOMO. If you missed out on the Nvidia bonanza, CNBC Pro is laying out some other investments that could see huge earnings growth going forward. Just head to cnbc.com/pro-pick or scan the QR code on your screen. And speaking of Nvidia, don't miss the highly anticipated keynote from Nvidia CEO Jensen Huang kicking off at the top of the hour. Up next, Alphabet shares popping on the possibility of an Apple AI tie-up. We've got all those details. That and much more when we take you inside the market zone. We are now in the closing bell market zone. Deirdre Bosa is here to break down the big moves in Alphabet shares today. Julia Borston on the Analyst getting bullish on Netflix and Meta. And Phil LeBeau on what's behind Tesla's big rebound today. Deirdre, obviously a big report here on Alphabet and Apple. How do you think it fits into the whole story of AI?
Well, it kind of shakes up the rankings, or at least the perceived rankings, and it's essentially a plot twist that you can actually see playing out in mega cap stock movements over the last month. Alphabet shares, they fell back in late Feb on that botched rollout of Gemini. But on today's report, look at this, popping. They were up as much as 7% at one point, putting it ahead of Microsoft's performance over that time frame. Now, a deal to license AI features on the iPhone, that would be a very strong rebuke to the bears who worried that Google's Gemini was falling short of competitors' products and that it would have trouble monetizing its AI. Its current distribution deal with Apple, that has really helped cement Google's dominance in search. So an AI deal could give it a boost in these early innings here. But of course, there's a lot more that's going to be happening over the next few months that could reshuffle these perceived winners and losers again. Google I.O. is on May 14th. Microsoft Build is just a week later. And then you've got Apple's WWDC in June. You know, a lot of people are talking about where this puts Apple, but I don't think anyone's counting them out just yet.
Sure. I guess a couple of things come to mind. I guess, first of all, I mean, to the degree that this is something like this is going to happen, it definitely suggests there's no kind of winner-take-all situation when it comes to these AI tools, even if it's specifically for search. And I guess the other one is it's a kind of vote of confidence for Gemini, but is it just because it might be a little bit ahead of where Apple is? I mean, that gets to your final point, I guess.
No, it's true. And is this really validation for Gemini? Like, on one hand, yes, it would give it huge distribution. Like I said, that was so pivotal for search being on the iPhone. But at the same time, right, this is like a race that's so up and down. And that report said that Apple was also looking at OpenAI and it was considering partnering with them. These language models are coming out so quickly and getting better and better that who's on top is just this constantly evolving thing. And again, like looking to those three massive events over the next few months, everything could once again change.
Yeah, I mean, there's obviously such a sense of urgency for all these companies to kind of be there where it's all happening. Thank you very much, Dee. Julia, more street bullishness on two popular names here, Netflix and Meta.
Yeah, that's right. Netflix shares are up about 2.5% after Loop raises price target to $700 with a buy rating on the stock. Now, Loop raised its estimates for subscriber additions as well as EPS, saying near-term engagement and long-term macro and competitive trends are positive